If I could ask everyone to take their seats in the new age of web streaming, or at least chew a little more quietly. Right. Are we on? Okay. Hello, everyone, and welcome back to the Peterson Institute for International Economics for our full day joint conference today with the Fiscal Affairs Department of the IMF on rethinking fiscal policy global perspectives. We're honored and uplifted today by a keynote coming in 9 minutes by the first Deputy Managing Director of the IMF, Professor Geeta Gopinath. We will turn to trying to properly introduce her in a moment. I just want to take this occasion to say two quick words. First word about why we're doing this conference. Roughly a year and a half ago, Vitor Gaspar, the director of the Fiscal Affairs Department, and I were separately asked to brief the APEC ministerial about fiscal policy after COVID. I won't misrepresent Vitor's views, but at the time, my views expressed to the assembled finance ministers or their factotums was that you should believe the good news on fiscal policy, that we were able to borrow large amounts in a large number of countries for the emergency that was COVID. These funds could be used meaningfully and usefully in a rapid fashion, and that markets were not horrifically punishing people at that time for so doing. That looked like the right response in contrast to the excessive austerity seen in Europe and elsewhere in response to the previous global crisis. In the time since then, the believe the good news picture that I presented has come to be seen, I think rightly, as partial at best. We have seen an inability to roll back some of the fiscal policies that were there, although with notable exceptions in the opposite direction in Europe. We have seen an erosion of fiscal positions around the world, and we have seen challenges emerge for developing lower middle income economies in this context. And so at the instigation of Paulo Moro, the Deputy Director of the Fiscal Affairs Department, we came together to try to bring a global perspective and bring an evaluation, not an overall direct assessment, but a in-process thinking of where we stand now in light of the huge fiscal swings and efforts that were undertaken and the aftermath that we are still trying to assess. The IMF, of course, has done important work on this, both in terms of research published by the Fiscal Affairs Department, by the Research Department, by various country teams. We also, of course, and regional departments. Here at the Peterson Institute, we have had much discussion coming out of the seminal work of Olivier Blanchard on debt sustainability, as well as other efforts, particularly on the US, by Karen Dinan, Jason Furman, and others. But today, we're able to convene with gratitude, thanks to the intellectual leadership of Karen, Paolo, and David Wilcox, another PIIE colleague, a great assemblage of leading academics, policy practitioners, and some people who are or were both of those, to talk about today's topic and to try to get us to a little better understanding of where we might be. So I want to explicitly thank David, Karen, and Paolo for providing the intellectual backbone for this conference, and to the many distinguished speakers who've joined us last night for a rousing, if somewhat depressing, conversation with Larry Summers about the long-term fiscal situation of the US, or I should say medium term, and who are joining us this morning for the important address from Professor Gopinath. Just to say, in terms of academic practitioners, for the generation and for everyone, Geeta Gopinath is at the top of the list. She is, of course, the first Deputy Managing Director of the International Monetary Fund, has been in that role for a year and a half now, since January of 2022. In that role, she oversees the work of staff, represents the fund at multilateral forums, maintains high-level contacts with member governments and board members, the media, As many of you, of course, have seen and focused on her important statements of both substance and policy through the last year and a half. Prior to that, she served as chief economist of the fund from 2019 to 22 with distinction, and I believe she is the first chief economist to ascend to become first deputy managing director. Of course, previously, she was the John Zwastra Professor of International Studies and Economics at Harvard's Economics Department, where she, along with a number of colleagues, including the current economic counselor and director of research at the fund, Pierre-Olivier Gorinchas, have developed important work rethinking monetary and financial connections throughout the world, in a world of dollar dominance, in a world of debt, in a world of large capital flows. She's authored numerous research articles on exchange rates, trade and investment, international financial crises, and monetary policy. But today, we're fortunate to have Gita with us to talk about the fiscal policy challenges globally that the world faces after COVID. Professor Gombadev, please.
Thank you, Adam, for that very kind introduction. And let me join you in also recognizing the importance of having this conversation after a time when fiscal policy has made unprecedented moves, especially during COVID-19. And I want to thank Vitor and Paolo and Karen and David for putting this together. I think there was a lot that we can learn, and it's an ongoing process, as Adam said. Okay, just to quickly set the stage, governments did respond very quickly to COVID-19 and at an unprecedented scale in many countries, especially in the advanced economies. And owing to that, we did have the positive result that households and firms bounced back quickly. I think that we should recognize that, and I think Adam made that point, that all that support helped a fast recovery compared to other kinds of recessions that we've had in the past. But I want to talk about the current context and what it tells us about the actions that were taken in the past. Now we're in an environment where inflation is high, debt is high, interest rates have gone up as needed to bring inflation down, monetary policy is tightening, and the risks to financial stability are significant. So it's a good time to pause and think about what fiscal policy can do and what lessons we have learned. This is an incomplete exercise at this point, but it's worth getting into it. I'm going to basically make 6 points, and those 6 points will cover what I would say some are somewhat new lessons, but some are basically us having to remind ourselves of some old lessons. So let me kick this off. The first point, we've learned through COVID-19 that fiscal policy can be decisive, quick, and innovative, at least in a major crisis. So it used to be the case during the time of the Great Moderation, even before that the view was that fiscal policy was a slow boat to steer, and it relied heavily on monetary policy in providing the stabilization to shocks. And fiscal policy did have an important role to play, but mainly as an automatic stabilizer. I think what this crisis has shown us is that at least in a major crisis, political consensus is easier to reach, and fiscal bills can be signed speedily. So you see that in the graphs over here. It's very stark. You can see that, for instance, in the left graph, which has transfers as a share of GDP in the US. The series goes back to 1970, and clearly the only thing that stands out are those two peaks that you have in 2020 and 2021, where you have it shooting up to 28% and 27% of GDP. Now, this was not just the US that did this. Many countries around the world did it to different extents with different instruments. But you can see that in the right graph too, which is the speed with which there was a fiscal policy response was strong of a large scale. That was good. There was a lot of innovative measures that were taken around the world in trying to get this money very quickly into the hands of households and firms. And that clearly was important to do in a crisis where there was the fear that the whole fabric of the economy could collapse. Of course, with the benefit of hindsight, but also, I would say, some of it known at the time, some of this support was poorly targeted and has lasted too long. This was true during COVID-19, even though we had a time when we were starting seeing the recovery, vaccines were there, the support continued. And I think it's fair to say, again, maybe with the benefit of hindsight, but I would say some of it was known even then, was that we could have had much more stringent eligibility requirements, both for households and for businesses. It took a long time for this support to be unwound. That was during COVID-19. And then you have 2022, Russia's invasion of Ukraine, the energy crisis that came on top of the fact that energy prices were already going up. And that led to a call for large amounts of government support again. Of course, the right thing to do, as during COVID-19, would have been, especially once you have some more recoveries, the sense that you have to be temporary and targeted. But that was not the case. And you could see that in the chart that you have in front of you, which is that the most of the support that came was mainly untargeted. So ideally, you would have cash transfers that go to households and maybe some support to some businesses. But then you'd try to have the price mechanism work as best as possible. Now, there are creative ways of providing support while tempering the price mechanism in some ways while still providing incentives for people to reduce consumption. But those were not the strategies that were mainly adopted. Most of the strategies was a blanket price cap. What that did also was then increase the cost of the support measure. It also kept the demand for energy up, which then also kept world prices up. So in a sense, some of it was self-defeating. But this is the second point I wanted to make, which is that it has been hard, very difficult for fiscal policy to be targeted and temporary, even though that is like the holy grail of how we would like to do it. And that's something that we have to keep in mind. And I find it to be particularly stark at the current juncture, where despite the fact that we are in an environment where economies are clearly overheating, inflation is too high, the fiscal deficits in several countries are too high and projected to stay too high into the future. You can see that on the left graph. You see the fiscal balances that went deeply into negative territory during COVID did come back. So it was the case that some measures were taken off. It was the case that the recovery helped bring deficits into much more narrower, smaller territory. But the basic point is, looking ahead, if you look at the fact that these are countries, I mean, the US and the G7 countries, where inflation is well above central bank targets and has to be brought down, it is, these are high levels of fiscal deficit. So this is kind of, for me, this conveys the sense that this is a lesson we need to remind ourselves, that when you are no longer at the effective lower bound, when inflation is very high, when you do have to bring down fiscal deficits, and fiscal tightening can play an important role. It plays an important role also because there are limits to how much interest rates can go up in an environment where there are financial stability risks. If central banks have to raise interest rates by a whole lot more, it will slow down the economy, but you could enter into some very nonlinear dynamics with financial market turbulence, which is why it's so important for fiscal policy to play a role. And as the right graph shows you, if you're looking at projections of debt going into the future, these are very high levels of debt that is expected to stay high and keep growing. You do have the decline in debt that happened as a combination of the recovery and inflation, but the basic trend is one of debt going up too high. So I think what we have to remind ourselves is that government's abilities to rebuild buffers in good times has not been great. The record of doing this has not been great, which is why you can see that, again, in terms of the debt graph on the right, that you had the GFC. The point was after the GFC, there would be some moderation in this debt, but that wasn't the case, and it's projected to rise. So question is how to get to temporary and targeted, and this is my fourth point, which is how to withdraw support once the emergency is over. We really need to figure this out, because especially if we are going to do large amounts of support, provide large amounts of support in really bad times, we need the offsetting effect too. We need to have savings happening in good times. So I'm going to have just 3 quick points on how to get temporary and targeted done. The first, I think we've learned that the bar for exceptional interventions must be set high, and especially so for when it comes to supporting firms. Second, it does help for targeting if you have a good digital information infrastructure that helps enhance targeting. And third, based on the work and the research that's been done in the Fiscal Affairs Department, that the evidence supports having a medium-term fiscal framework that combines rules with pre-specified criteria and escape clauses. That provides the necessary flexibility, but also helps with maintaining credibility on government's abilities to run deficits and in terms of the level of their debt. Now, the next point I want to go on to, because this has been a big topic of discussion, it was a big topic of discussion for sure before the pandemic struck, was when you think about debt sustainability, it matters what is the cost at which governments are borrowing, and it matters what that cost is relative to the growth rates in this country. At that time, when you looked at what was R minus G, R being the real effective interest rate on government debt, G being the growth rate of the country, that was in squarely negative territory. So this is a graph, this is a distribution for 2019. Important thing to note, most countries are to the left. This is weighted by world GDP. So as you can see, the vast majority of global GDP had R minus G that was negative. US, squarely negative, minus 1.5%. China, even more negative, minus 6.6%. So I guess the question is, are we returning to this world? What does it look like? Where are we headed? So I'm going to give you our recent estimate on R minus G. This is for projecting out to 2027. This is what it looks like. It basically has about 80% of the global economy to the left of zero, which is we're still in our negative R minus G. But a couple of things. One, as you can see, the size of how much lower R is relative to G has shrunk quite a bit. So if I flip back, China was minus 6.6. Now it's minus 3.5, mainly because growth has come down. The US was minus 1.5, and it's now at minus 0.9, mainly because our R has gone up over this horizon. What does that mean? I think what it means is that R minus G being less than zero provides limited comfort for multiple reasons. One, I think we're getting very close to now the region where, given the reasonable bands of uncertainty, we could be on the other side of the zero line. There was a lot of uncertainty about what R could look like and what G could look like. And we saw that. People point to during the GFC and what happened in the euro area when interest rates shot up really rapidly during the euro crisis. I'm showing here something a little more recent that happened a year ago or so in this fall, when you had the US gilts that jumped up by 200 basis points in response to a budgetary package that looked like it would rely very heavily on government borrowing. So you could be a reserve currency issuer, but you could still have your interest rates jump up by a lot. And again, importantly, I think the chart to keep in mind is this right graph here, which is that even if R minus G were sort of mildly negative, we are looking at debt to GDP projected to increase over time because deficits are projected to go up over time. In the case of the US, larger deficits that come from health and other age-related spending are projected to rise fast, while revenues fall behind. In the case of China, it comes importantly because of a growth slowdown and through population aging. And also, from a welfare perspective about whether government spending should be as high as it is and government debt should be as high as it is, what we've known is that, at least in terms of the returns to capital, the marginal product of capital, that has been consistently higher than G. Now, of course, there's a question of whether it captures some premium and so on, but the point is that I think R minus G being less than 0 gives limited comfort at this current stage. And lastly, I just wanted to flag that there are, when you look at more low-income countries, we certainly see many in debt distress. These are just an example of 3 countries, Angola, Ethiopia, Ghana, but there are many others. We have about 60% of low-income countries, which we categorize as either already being in debt distress or in high risk of debt distress. So this is, globally, this is a bigger issue, not a broad emerging market phenomenon, but there are some emerging markets for sure where we are seeing distress. And I'm going to end with my absolute last point, which is kind of, I think, something that we need to think about more, given that fiscal policy, of course, wears many hats. It has to contribute to bringing inflation down, but it also needs to make resources available, provide the right environment for there to be investments in the green transition, and so on. But what we're seeing recently is a revival of industrial policies. We've had industrial policies for a very long time in the past, but there was a period, between 1990 and 2009, where I would describe that as being a period of skepticism about industrial policy. I think recognized it as being distortionary and ineffective. On the one hand, yes, market failures provide a reason for governments to step in, but then on the other hand, there is concerns about government failures that go in the opposite direction. And then you have to 2010 to 2019, following the GFC, the job destructions that follow that, China's growing share of trade and the rising tensions that came from it, that led to some reversal in this, a kind of renaissance of industrial policy. And now that's been, I think I would say, supercharged especially after Russia's invasion of Ukraine. There are very valid concerns that countries have about economic security and national security. That is leading them to make certain kinds of decisions on protecting certain sectors, ensuring that certain kinds of technologies don't get on the wrong hands. All of that is there. But we do run the risk of all of this escalating and going down a very slippery slope. Industrial policy for climate, I'm going to just stop with just a little bit on the green transition. Without a doubt, given the externalities that are involved in climate mitigation, there are grounds to provide subsidies. I don't think anybody can dispute that. It is clearly the case that we need much more innovation in this space. A lot more has to happen, and accelerating that through providing subsidies can help. But I just make 2 points. One is that we cannot think of these subsidies as a complete substitute for carbon taxes, carbon pricing. And I feel, unfortunately, we are in that space where the only conversation seems to be about subsidies and not pricing. Pricing is good for 2 reasons or more. One, it's very effective in channeling investment to where it needs to go, in providing the right kinds of incentives for buyers to switch from one kind of energy to another. But fiscally, it makes a huge difference if you do it through carbon pricing versus subsidies. So carbon pricing helps in the current situation in terms of raising revenues, in terms of using those revenues to help households and firms that are going to be hit by this transition, in terms of bringing down debt. So I think we really need to, put carbon pricing squarely on the table, despite all the political issues surrounding it. And then the second point is we really have to avoid a race in subsidies, which is, I think, the other risk that we face right now. Countries that have the fiscal space, seem to have the fiscal space at least for some time, are deploying their resources pretty strongly. We might end up with much more costlier, much more distortive subsidies than what's needed. And there are other smaller countries of the world who don't have the fiscal space to do this, who are left on the sidelines. So I think we need to fix that, something we have to think about. And I believe there is a conference on climate that's going to be here very soon at the PIIE, so that's going to be fantastic to learn from. So just to conclude, the global economy did bounce back quite a bit, especially in the advanced economies after COVID-19, thanks to the very generous, quick support that was provided. I think we have to recognize that. But that said, I think it's also fair to say that it's very hard politically. I mean, there's the administrative capacity part, but I also think politically it's become very hard to be targeted and temporary. And you see the signs of it most strongly that in an environment with inflation as high as it is, we have the kinds of fiscal deficits. And in fact, pro-cyclical policies in some countries. So we need to rebuild the fiscal space to be ready for the next crisis and to face up to the challenges of sustainable and inclusive development. I think it is difficult. These are difficult decisions for policymakers to make, and they are politically hard, but it needs to be done. Thank you.
Yes. Well, thank you very much, Geeta. You covered a huge amount of territory, obviously drawing a lot of your own insights and your whole staff's work. We all read the WEO and the Fiscal Monitor and the series of papers that come out. On a personal note, thank you as well for your statements about industrial policy and subsidies race on the last point, something I'm very concerned about. But in our limited time, I'd like to return to a couple points, one of which taking you a little more short-term from the long-term perspective that you put out there. You mentioned on your point 5, the right chart, you showed Angola versus 2 other emerging markets, or rather developing low middle income economies. You mentioned about interest rate jumps moving economies into debt distress. There are obviously a number of economies suffering debt distress or near it right now. What are the policy measures to tackle that challenge? And given your role at the fund in the G7, in the G20, what hope is there for some international cooperation on relieving some of that debt distress?
Thank you, Adam. So there is what needs to be done now. And as you said, we have a fair number of countries that are in debt distress, which means that our assessment is that they need their debt to be restructured. It has been a long-standing problem of the international financial architecture is that we don't have a simple way of getting this done. I think a lot of progress has been made when it comes to privately held private creditors, but we have a much trickier problem with official creditors. The G20's common framework, was a solution to this hole in the international financial architecture, and I think we have to recognize that this was, an important thing to accomplish for the G20. That was the good news. Of course, what has been somewhat disappointing is the fact that restructurings through the common framework are taking a lot of time. Now, I would recognize some successes. Chad was the first country that we actually had a debt restructuring done. For the first time, we had everybody, the official creditors, the private creditors, come together. And that is important, never happened before, so this is an important marker. But that said, we have many countries at this point, Zambia, Ghana, Sri Lanka, who need relief, their debt restructured very quickly, and it's taking time. Now, efforts are being made to move ahead. Now, Sri Lanka, of course, is not part with the common framework. It's a side of it, but we think it's important for middle-income countries also to be a part of the common framework. So what next? I think the process of learning for a lot of official creditors is getting us maybe a little bit into a faster momentum. At the IMF, we are working with the World Bank to share information on a faster basis so that creditors can arrive at a decision much more quickly. We have the Global Sovereign Debt Roundtable, where we came to a common understanding on the role of MDBs in providing concessional net financing to countries that need restructuring. There are many technical groups on things like comparability of treatment and so on. So we're making progress on that front. I think we have to give it a good chance, but we need to push harder.
Thank you. Given the time is limited, I'm going to switch back to another core point of your presentation, which is thinking about how much comfort we should take from R minus G being negative. Our colleague, Olivier Blanchard, of course, has made the extended argument for why that's the key variable, not the only variable, but the key variable to debt sustainability. As you point out, as we published in a critique by Orzag, Rubin, and Stiglitz a couple of years ago, and others have said, this may not take adequate account of the possibility of interest rates jumping. When I say this, I mean, as you put it, taking too much comfort from R minus G levels. There's also the issue of what we think the safe rate of interest, the long-term R in this equation, is going to be going forward. As you're aware, we held a sort of debate between Blanchard and Summers on this. The fund, you and some of your colleagues came out with some projections or arguments for what you think the rate will be going forward. So could I get your comments on those two aspects of this central R minus G question for fiscal planning? How much should the risk of jumps in interest rates be taken into account when setting policy, and what should be the working assumption about R going forward, obviously with huge confidence bands? And if I could get in just sort of what's the feedback loop between the two? How much does our uncertainty about what R is going to be affect how much we should worry about the stability of R minus G?
I mean, so firstly, I mean, completely agree with Olivier that an important component for debt sustainability analysis is R minus G. I think it was an important argument to make to push those who were thinking that austerity was the only way to go and that you had to base it, without recognizing that we're now in a world where interest rates are much lower than they've been. So I think that is a point to be taken. The question, of course, is that how much does that then influence decisions on fiscal policy given the current landscape that we're in? I think for now, at this moment, it's not just a debt sustainability issue, it's an overheating economy. So regardless of what you think about R-G, how it influences debt sustainability, given this is an overheating economy, it is important for fiscal policy to tighten. No, I think there's no ifs and buts about that. There is this big question about where are we headed on R, right, in the long run. And yes, we have some very nice work from the research department of the IMF that looks into this question and looks into the drivers of R. I know that Larry has moved to raising R to almost 2% at this point, from 0.5% to 2%. Our best guess, subject to uncertainty, is that we're likely over the medium to long term to, once inflation is conquered, we can't mess that up, once we bring inflation down, then we would likely to return to an environment where interest rates are, the safe rate, is fairly similar to what it was pre-pandemic. Now, let me tell you why. Two important drivers of that, from what the empirical analysis shows, is one is demographics and aging. And yes, at some point when people get old, they start running down their savings. But I think we're now in the phase where, because of longevity and life expectancy being quite large, we do think that the negative effect on interest rates will be one of the main drivers. The second is productivity growth. And productivity growth, traditionally an important driver of R, is also expected to stay low. So those are two factors. But there are forces that I think go in the opposite direction. Right now, based on our best guess projections, they don't offset the main forces. But I would say that one, as this research shows, if we live in this environment where we have fiscal deficits that stay high and debt that keeps growing, I think we have a problem. We could see interest rates going up much more, safe rates going up much more. It depends a lot on how we finance the green transition. Do we do it through borrowing, or do we do it through carbon pricing? It's going to make a difference. If it's done mainly through borrowing, then we're going to again have pressure on the safe rate. And lastly, and this is, I think, a little more uncertain about the direction we should move, which is the impact of all the fragmentation that we are worried about on trade and on financial fragmentation. Obviously, on one hand, it could reduce productivity growth, and that could have the effect of dampening it. But if the world moves into rival blocks and everybody is relying on their own domestic savings to run their economies, that will certainly raise interest rates. So again, overall, we think our best guess at this point is we return to the R's that we were used to pre-pandemic, but I would say with a bigger band of uncertainty and risks that could play out. In terms of what governments need to do, I think the important thing to keep in mind is, even looking forward, assuming we get through inflation, is that there are many other unfinished tasks that we need to do. We have to have the green transition happen. We have, we're living in a world that tends to be more shock prone, and it is essential, therefore, to build up buffers. And so that's where I'll stop.
Great. With that, given the limits on her time and our busy conference schedule, we'll close the opening keynote of this conference on rethinking fiscal policy globally. And for that global and analytic perspective, please join me in thanking the first Deputy Managing Director of the IMF, Geeta Gopinath.
Thank you.
Thank you.
All right. So I want to thank everyone for coming. We're about to start the first panel of the day, which is on the topic of using fiscal policy to help households. Before I get started with the panel, I wanted to say hi. I'm Karen Dinan. I'm a non-resident senior fellow here at the Peterson Institute. And I wanted to thank the Peterson Institute as well as the IMF for sponsoring this conference. And I want to thank my co-authors or my co-organizers, David Wilcox and Paolo Moro, who really gets the credit for conceiving of the idea to have this conference. Working with them to organize it has been a pleasure. I was really excited to be moderating the panel on helping households because the interventions that we did during COVID just were so bold. As Gita Gopinath said, they were decisive, they were large, and they occurred so quickly. And I think both the nature of the interventions, but also the outcomes that we saw just stand in contrast to what we've seen in so many historical episodes. And I'm thinking in particular about the Great Recession here in the United States, where we did do interventions to help households, but really we saw very persistent both hardship and scarring in that episode because the interventions weren't as large. So anyway, I think it's essential that we have this panel to talk about what was done right and what could have be done better, and really take stock of the benefits of these households of these policies, because when the next recession comes around, that's going to be an important part of deciding what we should do to help households then. So with that, I'm going to introduce our panelists very briefly. You have lots of background material that if you want to learn more about them, but just in order in which they're going to be doing their opening remarks, we have Raphael Lamb, who is here from the IMF. He is Deputy Division Chief in the Fiscal Affairs Department at the IMF. We have next Diane Schanzenbach, who is the Margaret Walker Alexander Professor in the School of Education and Social Policy at Northwestern University and Director of the Institute for Policy Research there. Then after Diane, we'll have Marcelo Neri, who is Director of FGV Social at the Getulio Vargas Foundation in Brazil. And finally, we will have my colleague from the Harvard Kennedy School, Rena Hanna, wrapping up. She is the Jeffrey Shea Professor of Southeast Asian Studies at the Harvard Kennedy School. So with that, I'm going to turn things over to Raphael, who is going to offer a few minutes of opening remarks.
Yeah, thank you, and good morning, everyone, and thank you for Karen's introduction. As mentioned in Dieter's opening remark, the pandemic led us to rethink what is the role of the fiscal policy in the shock-prone world. One relevant area in these sessions will be to talk about how to build a resilient society to help people in the event of a large adverse crisis. For this talk, I will focus on two main aspects. One is what are the lessons learned of the specific fiscal instruments that were used during the pandemic, and what have we done well, and how can we design it even better for the next round of shocks. We in the IMF has been working or thinking on these issues, including the recent publications of the October 2022 Fiscal Monitor on helping people bounce back, focusing on how to help people to build resilience in their own world. Fiscal support was stripped and basically very decisive, particularly if monetary policy is constrained over the last couple of years, particularly in the advanced economies as well as many emerging market countries. However, the low-income developing countries were kind of muted in their fiscal response, partly because of the limited fiscal space, so that they were not able to fully protect people during the crisis. One of these options to improve or to protect people that were very visible during the crisis in terms of protecting the people was the use of the short-term work or the job retention schemes. These schemes essentially aim to help workers to get paid for reduced hours, but not getting laid off. So it can protect the fabrics between the workers and the firm, and especially they were widely adopted in the European countries. At the peak of the crisis, maybe over a median of 13% of the working age populations in the European countries were under such schemes. However, for the US, it's mostly relied on the unemployment income support, whereas the job retention schemes appeared in some states were less used. So in the analysis, we made use of the very rich household level data at the European countries to understand to what extent they were able to protect households during the crisis. We find that based on the simulations at the household level, the job retention schemes were very significant. They were able to protect, on the right side of the chart, the green bars. They were able to protect a significant portions of the market income job. For example, the tax benefit systems as a whole, including different types of pandemic measures, absorbed an average 75% of the income of the market income shocks for the European countries. And certainly, this is much higher level than about 40% before the pandemic for the automatic stabilizers that were in place before the pandemic. The income stabilization across Europe countries, of course, varied, as you can see the left chart, but on average, the job retention schemes were very powerful. They were able to absorb most of the income losses. Particularly, it seems that evidence finds that they were fairly well targeted. As you could see on the left chart, the lowest income households were able to getting protected for their market income losses and were able to stabilize maybe over 85% of the market income drop. Whereas even the fifth quintile, the highest income households, they were still able to protect over 2/3 of their income market shocks based on the pandemic measures on the tax benefit systems. At the same time, we see that the job retention schemes were fairly well targeted. On the right chart, it focuses on the workers with low skills, and particularly those workers who are in contact-intensive industries such as retail and hospitality sectors. At the same time, as Geeta has mentioned, there were large cash transfers in many countries that helped protect the people during the pandemic. We look at two cases. One is on the Brazil case that were able to provide some extraordinary income support during the shocks during the pandemic. For instance, the emergency aid program during the 2020 and 2021, they were very broad and sizable, covering almost everyone in the lower 40% of the household, of the populations. And the transfers were about 4% of GDP in 2020. So we take advantage of the household level data, and we find that the cash transfer provided relief for the population at large. But the majority of the population actually see an income rises during the pandemic, increasing their disposable income. As a result, you could see that the poverty level as well as the income inequality fell temporarily during the peak of the crisis. And Marcelo probably will be an expert and talk a little bit more on the details. In the United States, also many cash transfer programs were dispersed very quickly under the pressures of the crisis and fairly quickly reach a political consensus. For example, the economic impact payment programs reached the recipients in just 2 to 3 weeks after the legislative approval, which boosted the household consumption on the right chart for the lower income households As you could see that they rise fairly quickly, even during the peak of the pandemic. So the cash transfer program seems to be effective initially, particularly boosting the consumption and reducing the otherwise very adverse impact on income inequality. But as government prioritized some of the speed when facing the large uncertainty, it was very difficult to target in the real time without prior planning, which means that in hindsight, some programs could be overspent or overly generous and may incur extra fiscal cost. And the social protection system or the social safety net, they are fundamental to help protect people. And we can also see that many countries have expanded the social safety net in order to help people during the crisis, including the developing countries. Many of them often leverage the digital technologies for rapid expansions of the social safety net to support households. The digital technology were mainly used in three fronts. Number one, to identify the people who are in need. Second, basically to verify the eligibility, who qualifies, who will not. And then the third will be to disperse payment in a very quick and timely manner. So we have seen in the table some examples how countries make use of the digital technologies to do that. For example, in some cases, they make use of the mobile money apps in order for people to register and get the benefits. In some of these countries, it will be important to look at or to make sure that the social safety nets will be able to cover the people that are in need. So maybe as a conclusion, let me quickly summarize some of the things that we have learned maybe during the pandemic in terms of rethinking the fiscal policies. Number one, I mean, certainly as Gita mentioned in her opening remarks, there were trade-offs at the forefront in rebuilding buffers, given that we are in a high debt and many countries face limited policy space. It is the prime actions for many countries to rebuild buffers and to think about how to do it by gradually undertaking fiscal adjustment. And it certainly involves some trade-off in the process, given a lot of the competing development needs in many countries. Second, it will be important to prepare the fiscal strategies so that, I mean, countries will need to know how to act in order to get ready, deployable tools to protect people. So making the policies more predictable, as well as attuned to the nature of the shocks and economic conditions will be important. In the fund analysis, developing a credible medium-term fiscal frameworks will be important, which foster the actions how to build buffers. Some of the fiscal tools, as we mentioned, the job retention scheme could be a useful fiscal tools to protect workers, particularly for temporary severe shocks. During the pandemic, there were some discussions whether those schemes were useful or they may have impeded some of the structural reallocation on the labor market, particularly if the shocks were kind of more permanent. But it turns out from the pandemic, given that it's a relatively short-lived temporary shocks without major structural transformation, the job retention schemes could be a useful tools to further develop and be used in the next crisis. We learned that targeting is challenging, as also Gita mentioned in the opening remarks, but still need to be done, even that we may not be able to do it in a perfect way. It will still be able to do a little bit more on the targeting so that making sure that the fiscal actions will be able to reach out to protect the right people. We see that the social safety nets are the cornerstone of the building resilience and protect people because it is very compatible to different types of shocks, regardless of the nature of the shocks, whether it's coming from the business cycles or from the pandemic or different fronts. So expanding or making the social safety net readily scalable will be important to overcome the next crisis. Maybe I'll stop here. Thank you.
Uh-oh. Shouldn't it just come up, the slides? Okay. Fantastic. So thanks for having me. I'm Diane Schanzenbach, and I'm a microeconomist among you, here to talk about the safety net response during COVID. There we go. Hopefully, if the slides come up, because the slides are fabulous. So I wanted to show you how we responded in terms of the big 4 programs in terms of helping people. First, here in green, this is new monthly spending from April 2020 through the end of 2021. And first, you can see the green bars. These are those economic impact payments. I listed how much they were, $1,200 per adult, then another $600, then another $1,400 per person. You can see that overwhelmingly that is where we spent the money in the first 2 years of the response to this pandemic. About 70% of people received economic impact payments during the first round, and there were lower rates for some categories of people. For example, Hispanics had lower receipt rates because any non-citizen in the household made you ineligible. And also the lowest income families who don't normally file federal income taxes had to fill out more paperwork to get these, and so many of them fell through the cracks. And then, of course, this was broad. I wouldn't give this an A for targeted, but at least it was temporary. So people were eligible up to about 600% of the poverty line. The next that I want to highlight is unemployment insurance. And of course, this is targeted to people who have lost jobs. The amount that we spent on unemployment insurance is in blue here. And we did a lot of, I think, smart reforms to unemployment insurance in the midst of the pandemic. In particular, we patched some known holes in this unemployment insurance system, expanding eligibility to people with part-time jobs and gig workers, et cetera. And we also topped up the level of benefits, which were seen to be inadequate, and also extended the duration of time that people were eligible for these. This, I would also say, this is new monthly spending, so it's aggregate less the baseline, which is about $2 billion per month. Now, to be sure, if we made some smart investments in technology the next time, I think we could target this even better. We don't have to raise everybody's by 600, et cetera. But you can see unemployment insurance payments were a big part of this, but really dwarfed by the economic impact payments there in green. I've spent a lot of my academic career studying the Supplemental Nutrition Assistance Program, which is a food voucher for low-income families that were generally paid monthly. And during COVID, it was actually often paid twice monthly across that period. On average, payments before COVID were about $340. And then COVID increased these on average by $110, and then a second bump, another $154. So you sort of think about it as we increased SNAP spending by 50%. Also, because people lost jobs, many more people were eligible for SNAP. So we also saw the rolls rise by about 20%. Spending altogether more than doubled, and this is shown in orange. You can see, even though we more than doubled spending on SNAP, it's just a very small amount relative to the total spending that we did. And this is money that's targeted to low-income folks, not all of which face the shock directly, but they have very high marginal propensities to consume. So generally, we think this is a good way to spend. And then finally, if you recall that refundable monthly tax credit, usually we have a child tax credit that is an annual tax credit that is only available to families that have paid a certain amount of income tax. So what that means is the bottom 20% of children, if you line them up by income, get nothing from the child tax credit during normal times. And then that next 13% only receive a partial amount. This was changed during COVID. A number of things happened. One is that we made it universal, and so those kids at the bottom third of children finally got the full amount. We increased the level and then also made it refundable so that it was paid out monthly. So you can see that in the yellow, the last 6 months, which, well, I'll show you, did a lot of good for children and their families. Now, I want to show you this on the right-hand side is the cumulative total spending during COVID on those 4 programs, the stimulus EIP payments, uninsurance, SNAP, and then the child tax credit. On the left-hand side is the same programs, although not the child tax credit, during the first 2 years of the Great Recession. Of course, they're inflation adjusted, and this Great Recession response also included payroll tax cuts, which aren't shown here, but you can see just the difference in the size of the fiscal response. Now, last night I got the advice to start this a year later and push it out that way because you recall at the beginning of the Great Recession, it kind of was a little slow going down. It doesn't change the picture here. And we spent at least 4 times as much per capita through these programs during COVID compared to the Great Recession. So then I want to finish up by explaining a little bit about what we know about the impact of this fiscal response, also how it differs by race and ethnicity. And because we really blew it with children during the COVID recession, and that is, we'll talk a little bit in the Q&A time, is going to scar our economy for decades and decades going forward, how do things look different for children? So just in terms of the general fiscal response, most money that went out wasn't targeted to either job losers or the poor. It was through these economic impact payments. And we did some really smart things. We patched many known holes in and shortcomings of safety net programs, like the workers that weren't normally covered by unemployment insurance, the fact that we've got typically a pretty low food allowance benefit, and we leave many people out of the child tax credit. And what I'll show you is there were important impacts of this. There were sharp declines in poverty and food payments every time money went out, and there were very large protected impacts for Blacks and Hispanics, which is important for a number of reasons. So I'll show you a few estimates of the impacts. So first, I'll show you what happened to poverty rates. And of course, poverty rates are just measuring how much income you have compared to a threshold. So let me walk you through this a little bit because I've got 2019 and 2020 on here. The 2019 levels are, you have to add the blue and the orange bars, and then the 2020 levels are just in blue. So you can see a number of things. One is poverty rates declined across all groups in 2020. Now note, we don't even have the data available for 2021 when we spent even more money, but the poverty rates dropped. You can also note here that Blacks and Hispanics have much higher poverty rates in general than do whites and Asians. And as a result, the impact of these payments had a larger percentage point decline for Blacks and Hispanics. You can see children on the other side. I should note that this is the supplemental poverty measure approach to measuring poverty, which is the one that takes account of social programs, which of course is what makes sense because we're measuring the impact of social programs. And you can see largely similar, a little bit larger positive protective impacts reducing poverty for children. I'll note that with the aggregate data, we can say that the 2021 payments, which included those child tax credits, had an even larger impact, and child poverty dropped to 5.2%, the lowest ever on record, which was an astonishing policy achievement, and it's going to be really sad to see it go when child poverty increases again. Now, I picked out a few of my favorite graphs on the impacts of these payments. Most of our evidence is on the impacts of payments when they go away because kind of everything was a mess right at the very beginning. Here is the first one that I will show you. This is data from the Census Household Pulse survey, and it measures the share of families that say that they we could call it experienced hunger. They said last week we sometimes or often didn't have enough food to eat in the household. The upper line here is households with children in blue, and then households without children. So what we can do is measure how does this gap change when the child tax credits were paid out, because only the group on the top received child tax credits. And then, unfortunately, we can also see what happens at the end of that, because then we stopped paying the child tax credits. And you can see before the child tax credits, there was the difference in rates of food hardship was 6.5%. That dropped almost to 50%. To 3.5%, and then started to open up again. And as we continue going forward, regrettably, we have entirely opened back up to where we were before. There's a lot else that we know about how people spent this money. People report spending the money on necessities, on children's goods, they're kept up on their rent, et cetera. Because we expanded how much we paid out on SNAP, and then stopped that, we can also measure what happened when we took away that extra 50%. A few states took that money away earlier. And so this is from work in progress, and I apologize that, that these aren't a little bit better. So this shows the impact of taking away this additional SNAP money on food insecurity, and you can see food insecurity goes up. We also measure, do you have trouble paying your normal expenses? Because resources are fungible, of course, also people have difficulty paying their normal expenses. And then down here, we can look using the current population survey and look at employment rates. And what you can see is ending those additional SNAP payments didn't have an impact on employment rates. So it doesn't seem that it was holding back the recovery, but on the other hand, it was helping the lowest income households make sure that they could make ends meet. So just to conclude briefly, the economic shock we all know was large and it was disparate. And the fiscal response was also large, and I would just call it less targeted. SNAP had a large spending increase, but that was a small share of the total relief package, and it did real good. It reduced food insufficiency, it improved other economic outcomes. And these economic impact payments were the lion's share of our spending, and they drove a lot of the poverty reduction, and in particular, disproportionate for Blacks and Hispanics. The child tax credit, without question, reduced child poverty and children's hardship. And something that that as a social safety net researcher found interesting was that this universal money had a particularly strong protective impact for Blacks and Hispanics. Now, of course, during the Q&A, I've promised to talk a little bit more about children, but I just want to sort of leave you with the depressing statistic that the learning losses that were induced during COVID are projected to result in lost productivity on the order of $14 trillion to our economy over the coming decades. And we need to do what we can to remediate that. So we can't declare victory over this and go home. There's still a lot that we need to keep working on. Thanks.
Thank you very much for this great pleasure to be here. I'm talking about the Brazilian case during the pandemic and afterwards. The main point I would like to make here is the actions during the COVID crisis generated a permanent impact on how we deal with poverty on our everyday policies today. So there is a permanent impact of the actions on how we fight poverty today. And I think this is the main message. So I start with a series of inequality in Brazil. As far back as we can go. So basically during the pandemic, we faced the lowest ever inequality ever measured in Brazil in 2020. Inequality was falling since the beginning of the century. It's still very high, among the 10% highest in the world. And so there is plenty of room for redistributive policy. And the point I would like to make here is the fact that 222, which the latest data available just came out, is very similar to 220, not only in the terms of the figure, but what is behind the figure. Then going to extreme poverty on a monthly basis, and on the left side, on the right side, the level of social transfers, cash transfers. So basically, they are very correlated during the pandemic. Extreme poverty also in that single month, September 2020, is the lowest ever measured as well. But there is a lot of, so basically the measures were 1/3 of the population, including children in the denominator, received these emergency benefits, 67 million people. So you basically multiply by 4.5 the Bolsa Familia beneficiaries, our CCT program. The level of benefits were multiplied by 4.5 as well, so it was a very generous policy. But the point is, left graph suggests that perhaps a lot of, it's like a roller coaster shape. So we were very erratic in the way we did the policy. So maybe you should announce that would be transitory, so people save. But in fact, there was a clever measure taken, which was the new beneficiaries were paid in savings accounts deposits. So these nudged some savings accounts inflows, which help people, probably, we don't know how many, in the next year. So in 2022, when the crisis was, pandemic crisis was heavy, we faced period where there was no benefit there. So some policy-induced fluctuations is perhaps an undesirable feature of this graph. Looking again at the longer horizon in terms of poverty, here I emphasize elections. We just had elections in Brazil. The green points are electoral years. The red points are post-electoral years. So in 11 elections, poverty fell in 10 of them. So we should have elections every year. And in particular, the last 2 points in the series, the 220 and 222. 222 is last year. And there was also electoral cycle within the year. You started the year with 11% poverty. You end up, when the elections were being done, with 8% poverty. And this is the lowest. And when you simulate what was the impact of social transfers, instead of being 8, and I will stick to this 8 because I think that this is our best predictor of current poverty today, because the measures taken during the pandemic were kept there and are still kept today in spite of this changing government that we had. So poverty was 8 and would be, without transfers, 13%, so a 5 percentage point. So it's much higher than it used to be before the pandemic. So, so the pandemic left permanent marks on social policy. First, the size. Brazil used to spend 1% of its GDP on anti-poverty policies. Now we spend 2.5 and more likely 3%. And this is likely to continue. And I don't think so we spend more or less what Spain used to spend as a share of GDP. I don't think this is problematic. The thing is, other spending is also growing, and that's the problem. It's also good in terms of multiplier. You spend with the poor, each Bolsa Familia real you give generates a spending impact, a multiplier, 50% more than other policies and 4 times more than pensions. But within these, Brazil had a good social policy, well-targeted, Bolsa Família, etc. And what we have today, not during the pandemic. The pandemic, we lost targeting power, but this, I think, is part of the game. You rather don't miss people instead of including people who don't need. But the problem is that today, the 222, which is a good sign for 223 and perhaps beyond, we have a targeting loss of 45%, which is a big loss. So, so the problem is that during the pandemic and afterwards, we decide to transfer a fixed amount per families, for not by people, but by family. And this, of course, what we were doing before was to give more money to those with lower income and those bigger families, which is, of course, the right thing to do. And what this induces a rise of single-person households, which increased 73%. So in kind of mess around with our social registry in a bad way. More recently this year, we created additional benefits per children, which somewhat improved the targeting power, but keep still the family splitting incentives. So adults, wife and husband, they apply as different families, and this is because of the design of the policies. So I will. One point that's worrisome is the fact that although monetary poverty is in a good shape, food insecurity is not. And there are other measures of food insecurity. So now today the country goes back to the old time where food against hunger was the main challenge of the country, etc. So in-kind transfers are back. Full course now. So there's this concern about, so maybe the monetary incentives or transfers didn't impact so much food insecurity. And if you see some groups like, for example, females, food insecurity rose 14 percentage points during the pandemic. The children are with females in general. So, so in general, what I think is that Brazil is a good or perhaps a bad example in this sense of a country where actions taken during a crisis, something similar happened in the credit crisis. We had a very strong action against the crisis, transferring income, public banks, etc. And this created a permanent problem in our economic policy. And perhaps something now is happening, not so much in this sense for the poverty efforts, alleviation efforts. I think 2.5 of GDP is okay, in my opinion. But the way we design, so we had a sound social policy, and the way we attack poverty during COVID affected it in a wrong way, in a loss of efficiency. We lost efficiency in this process, and I think this is my main concern with respect to the Brazilian social policy. Thank you.
So while the slides are getting up, I just want to say thank you for having me here. It's really great to be part of this panel. I've really enjoyed the talk so far, and I know at least I'm really looking forward to the discussion we're going to be having in a bit. Great, thank you. So, during the pandemic, many of us were having Zoom dinners, and it was really interesting because in the past, dinner conversations with friends would hit many topics, and fiscal policy was not necessarily one of the topics that would come up at the dinner table. But in the pandemic, it was at the forefront of everybody's mind. And so as an economist, suddenly everybody wanted to know my views on what was happening with the targeting in the US stimulus package, what I think of it. Everyone wanted to know what an automatic stabilizer was. And for me, particularly since I work on low and middle income countries, my research focuses around these kind of programs in low income countries. The biggest question I got asked was, what does it look like in lower and middle income countries? Do they have the same programs that we have here in the US? Do they have food stamps policies? Do they have unemployment insurance? Do they have cash transfers? And so the first thing I want to say is yes. These programs actually look very similar around the world to the types of programs we have here in the US. And so, for example, more than 120 low and middle income countries run cash transfer programs. More than 70 run social pensions. There's health insurance schemes, subsidized, targeted and subsidized for poor households, lots of other types of programs. But also, sadly, like in the US, there's a lot of challenges running these programs. And for me, why I think it's an interesting policy problem to work on is that I think the policy problems are even more stark in low and middle income countries due to the budgetary issues, due to informality in the labor market, and given institutional capabilities. Now, it's worth noting that when we think about these programs, we know that as countries get richer, they develop more established safety net programs. But even within the lowest income countries over the last few decades, the number of countries that have instituted safety net programs have grown. The problem is that these programs tend to be very underfunded, and they don't really cover the full need in these countries. And so I'm giving you a little of that history because this is exactly what we saw in the pandemic. We know that fiscal policy was extremely, extremely important in many countries worldwide. And, the World Bank estimates that poverty would have been much, much higher had it not been for the fiscal policy response we saw across the globe. Yet at the same time, if we look at the numbers, we've also seen that in some of the earlier presentations as well, the level of spending in low and middle income countries was a lot lower. Low and middle income countries spent a lower share of GDP than high income ones. And as a result, the level of spending did not offset the poverty impact of the pandemic as well as in high income countries. Okay, so taking a step back, what can we learn from the patterns we saw across countries during the pandemic? So first of all, one clear fact was that countries that spent more covered more people and had a much bigger effect on poverty. And so, for example, there was a really interesting study that was done in Colombia. What the government did was they randomly assigned cash transfers to a subset of people who missed the eligibility requirements to get the pandemic transfers. And so they used that to be able to say what was the impact of getting these cash transfers during the pandemic. And what they found were, well, people in the treatment group, they bought food and they were much less likely to sell off assets. And so it really showed you that expanding, having more generously funded programs and expanding the pandemic aid even further to the next set of people could have had large effects on livelihoods. A second clear finding across countries, and I think Gita mentioned this a bit in her talk this morning, was that those with existing systems in place that could be readily expanded just did much better. They were able to move faster. They were able to identify who were the right people. They were able to have the correct distribution mechanisms to get aid out to those who really needed it. And so these investments in safety net programs during good times really pay off when there is a crisis. Okay. So what should we be taking away? How should we be thinking about the kind of policy issues moving forward when we start thinking about safety nets in low and middle income countries? And so I'm going to offer, there's so much to talk about, but I'm going to try to be brief and offer a few thoughts. The first is we really do need to find better ways to fund these programs. I mean, part of the problem is tax to GDP ratios are much lower in developing countries. And so, there's a lot of research that's been emerging about how we can improve tax systems in low and middle income countries. And I think there's a lot of work that needs to be done there, and they'll have real implications for the solvency of the social protection systems as well. But at the same time, it's not just about raising money, it's about using the money we have better. We really need to get rid of these inefficient programs. We have a lot of energy subsidy programs across the globe which are really inefficient. And we need to think more carefully about the program designs because they can have real effects. So for example, in my own work, I evaluated a reform that the government of Indonesia did, where they moved from the same people were targeted, the same amount of money was going out the door, but they moved from in-kind subsidies to food stamps. And it had large effects on poverty just because the aid was more likely to get to the right person. And so it really tells you that just thinking more carefully about the way we design programs and thinking about evaluation, we could actually do much better with what we have. Second, we need to improve the responsiveness of programs to have more adaptive targeting systems. It's very interesting listening to Gita talk this morning about targeting and temporary. It's really hard to do targeting in low and middle income countries just because information about income is just so hard to get. As a result, many countries have set up social registries. I mean, this is a huge step forward relative to what there was before, but these systems are very static. They're based on a household's assets, and so they're not necessarily capturing. I suddenly have a shock that's the main income earner in my family has died. I have a health emergency. They're not really capturing the bad times. And so as a result, we need to be thinking about how to make systems that are less static and more responsive to shocks. And here I think we can, and we could be a lot more creative. So for example, during the pandemic, the government of Indonesia actually used community information to help turn block grants to municipalities into targeted transfers, and did so very successfully to try to fill in gaps in the safety net system by using that soft information from communities where people know who needs help today. There's a lot of new data and technology that's going to help us try to predict climate shocks and know that these are areas that are going to be hit, and we can think about how do we get aid there faster and better. And so I think there's a lot of excitement going on about how we can actually do this better, and I think this is an area where we can innovate more. Okay. And then finally, my last slide, I also want us not to only be thinking about how to help, but who needs help. And I want to offer two thoughts. The first is, one issue that is just very stark in many countries around the world is that a large share of the global poor live in conflict zones. I think last estimates are about 40%. And it's very challenging as we think about, when we talk about in the US having these safety net systems in areas where there's a lot of conflict, in areas where there's a lot of displacement, it's just even more challenging. And so thinking about how we could better improve our systems and particularly think about how do we bring in the displaced into the existing systems, I think is incredibly important when we think about strategies that low and middle income countries should be taking. And then finally, I do want to offer one last thought. In low and middle income countries, we're often focused around the extreme poor. Many of us were focused on thinking about how do we improve the lives of those who are below $1 a day, below $2 a day. And here it's really amazing. We have made such huge, huge progress in reducing extreme poverty over the last few decades. It's really, to me, it's very inspiring. And I think we have the knowledge, and I think we have the tools, and I think with some creativity, we have the resources that we could really bring that down further. But we can't just say that we're going to end extreme poverty and then call it a day. As a result of this growth and development in many countries worldwide, we've seen the rise of the middle class. One health shock, one unemployment shock, and you can knock people back into poverty. We saw this particularly in the pandemic, as it was a very different type of profile of people who were being affected. It wasn't the rural poor, it was urban workers in the mega cities of emerging economies. People who were above the poverty line prior to the crisis, but really needed our help and assistance. And so it reminds us that even though when we think, people think developing countries and they often think about basic subsistence and they think about the extreme poor, I agree that's hugely, hugely important. But we should also have an eye to the future and think about how do we have more effective safety net systems that are also including the middle class, particularly when there are shocks, and having this kind of more comprehensive system that is there for all. Thank you.
Okay, am I on? I am on, right? Okay. I want to thank all our panelists. Thank you for those opening remarks. They were terrific. What we're going to do now is I'm going to kind of ask you a few of my own questions, and then we're going to turn to questions from the audience. Okay, that's better. Okay, so I'm going to start with a few. Thank you, panelists. I'm going to start with a few of my own questions, and then I'm going to turn to questions from the audience. So this was great, and I loved hearing about all the kind of benefits that we're getting out that we got from all these interventions. But I thought kind of the responsible thing to do was to start where Raphael left off, which was you talked about the need for countries to rebuild their fiscal buffers. And I know we're going to have a panel on fiscal sustainability later this afternoon, but I just was wondering if you could expand a little on what you were saying about rebuilding fiscal buffers and whether the IMF has figured out kind of the kind of magic tool for doing that without reversing some of the progress we've made.
Okay, sure. Yeah, thank you, Karen. Yes, this is an important issue about how to rebuild buffers. I think we need to think about, what is the objective of the rebuilding buffers, first of all? Certainly, we have seen a lot of the crises of the last and a half decade. The government is really being called to respond and to protect people, and that certainly need resources. It will mean that to have the enough resources, one need to kind of accumulate some of the resources in good times or in normal times. So that would be the major importance of it. And then if we think of the current landscape, certainly we are in a highly uncertain environment. There may be greater needs of the resources that are needed to protect people. And Gita mentioned in this morning, given the high inflation, there needs to be a coordinated policy mix between the fiscal and monetary policy, and a tighter fiscal stance or even some fiscal restraints will be helpful, not just to rebuild buffers, but also help the monetary policy of central banks to bring inflation closer to the target. And that in turn would help people because a more targeted or more stable on the price level would actually help the cost of living crisis and therefore help the people overall. How to achieve it certainly would depend on the country's circumstances. Country with fiscal space could do it more gradually under a medium-term fiscal framework. In the fund, we have looked into different type of scenarios, episodes, as well as country experience to kind of chart the optimal path. For most of the cases, it would require some spending restraints. And for countries that face long-term challenges such as demographics, climate transitions, those would need to prioritize the spending to the amount of competing needs so that the efficiency of the spending could be improved, the quality of the spending could be improved. For many developing countries, like Rama mentions, there's a need to mobilize more revenue through direct taxes, through moving the populations towards the formal economy so that it could improve on the tax administration as well as tax collections. So maybe I'll stop here. Thanks.
Since you ended with tax collections, I can't resist asking Rima, who's done a ton of work on making tax systems more efficient, whether you think there is room to move the needle in that regard.
I actually do think there is. I think right now there's a ton of great research that has been done, some by myself and by other researchers, showing how different policies and programs you could do can actually raise revenue. So for example, in my own work, I work a lot in Indonesia, and Indonesia a while ago changed the structure of how they monitored firms, particularly middle-sized firms, and we evaluated that reform and showed how it led to really large increases in tax collection. And as a result of that evaluation, it led to further changes to restructure the tax offices to move that tax structure across the country. And so I think if we think creatively about different ways we can do it, I think there is space to do so.
Great, and also on the kind of fiscal prudence front in getting to households. I mean, a number of you talked about the achievements, of these interventions, but also the need for better targeting. So I just would like to kind of hear from folks about why is targeting so hard, and kind of what can we do to better target aid to households, and what are the limitations? So Diane, you're nodding, so do you want to jump in on that?
I'll start. I think we've spent a lot of untargeted money for political reasons, which I don't know how to fix that. But I do know that we could have been much more surgical in terms of unemployment insurance. What would it take to do that? Investments in infrastructure to run the unemployment insurance programs better. We had a lot of fraud in it as well. I think we'll claw a lot of that back over time, in the fullness of time. But no one gets excited about saying, aha, let's invest in a modern computer system for the state of Illinois so that we can run better unemployment insurance, but it would be fiscally prudent. I want to say one other thing, which is when the expansions to SNAP were sunset, and they were sunset a little bit early, a lot of advocates, really yelled and screamed. And I kept wanting to make the point that, the emergency assistance that we were giving was not a policy for normal times. There were large cliffs, other sort of problems with that. But if we don't let emergency assistance sunset, that means in the future we won't be able to use it, and it was a really effective policy.
And can I just ask you quickly, while you're on the U.S., you talked about this, the economic impact payments, or the COVID checks. The whole design was, to fill, or an argument you often heard was we're filling the cracks. Is that always going to be something, no matter, are we ever going to be able to target well enough such that we kind of won't need those?
I think we could do better than we did.
Yeah.
Right. It's, I sort of think of, instead of, plugging the cracks, we just flooded it, something like that. So,
So
we could do better, but the way to get us to be able to do better is not exciting. It is, investments in boring stuff that adults should do.
Rima, targeting?
Oh, I'm jealous of how great the targeting is in the U.S. I think for most low and middle income countries, there's just a lack of information. Many people are in an informal economy, and so there's no records of I've lost my job, no records of what I've earned. People are saving money in various ways, and not necessarily in bank. There are no bank records. Very few people are in the tax net. So in Indonesia, where I work, about 11% of the people are captured by the tax net. So you can't do an earned income tax credit. And so most of the methodologies used for targeting in many countries is going across the countries and doing these periodic surveys where you go survey a large share of the country on their assets, and then you use that to predict who is poor. Now that's great. It's better than nothing, and has huge benefits, but it's also not very timely information. Targeting error remains high. and it doesn't capture shocks very well. And so a lot of, at least this is a topic I'm very passionate about, a lot of my own research focuses on trying to think about how can we make this targeting better by bringing in different sources of information. And so I mentioned the case of Indonesia, for example, during the pandemic, based on some previous research we had done actually in good times, looking at the efficacy of community targeting, tried to use community targeting to bring in all sorts of soft information community members know, to fill in the gaps of people who are missing from the roles. Other countries try to use cell phone and SIM card data. So Togo is a very famous example of that. There are self-selection mechanisms that other countries were experimenting with as well. I've also been doing some work on Indonesia. Another program that they put into place, particularly for urban workers, was allowing people to apply through websites for the first time for transfer programs. And so these kind of self-selection programs are happening in place. And I think there's going to be a lot coming up with new data and new technology, particularly as we start thinking about climate shocks and whether or not we can use predictive weather models to try to help thinking about how we could direct aid better. I think there's a lot that we can do to improve the system, but it's not necessarily going to look exactly like the US looks. It might look very different.
Let me ask a little bit, a lot of your presentations were quite naturally focused on our success avoiding kind of hardship in the moment. And of course, when we think about fiscal policy, we think about that as one benefit, but we also think, well, another thing you're trying to do is to avoid permanent scarring. I don't think we have the data we need to really assess fully assess scarring at this point, but based on what you're saying, it looks like maybe we're going to avoid the financial scarring, the scarring to household balance sheets that we saw during the Great Recession that was so damaging. But a type of scarring that you brought up, Diane, and Marcella, you touched on, were the kind of the learning losses, the kind of impact on education. And so I was wondering if I could get you, Diane, maybe you could start to talk more about what we know and kind of what that means for designing fiscal policy going forward.
So there is data coming out. We're able to see how much children lost during the pandemic and then how they're rebounding. And what I can say is there were large learning losses across the board, highest income kids, lowest income kids. To be sure, it was worse among the lowest income kids, but every child was hurt. This is important for a number of reasons, but one of the reasons is because human capital is productive. And so this will impact our productivity as these children grow and become part of the labor force. And it's also going to, I believe, increase poverty because the kids at the bottom were hurt so much. Now, that said, we know that we have some tools to remediate this. We don't have any tools that can close the learning loss that we have seen in 2 or 3 years, even at the average, let alone at the bottom. So what this is going to take is a sustained effort. Now, we did some smart things. Like, I really will give, a good A or maybe an A- for all the creative ways that the government found to prop up fiscal needs. For example, usually during recessions, schools have to cut back on their spending because of the way that they're funded. That didn't happen this time. We pushed money into the systems. And left that in there for some time so that we could continue to invest in remediating what was lost. It sure seems like we're going to run out of attention to that problem or steam for doing that before we have closed those gaps, and we shouldn't.
Our estimates for Brazil in terms of, for example, time of studies, not only dropouts, but actual time. You went back from 220 to 250% what you had in 2006 in terms of time. Math proficiency went back 14 years, Portuguese 10 years, so it's a great loss. vaccination gaps, overall vaccination gaps increased from 7 to 29% of the children. And this is something that we had a system there of conditionalities for the poor people in the Bolsa Familia that we were not able to hold this wave, but perhaps the Bolsa Familia can help to move forward. And first, we had some local experiences in Rio in particular, where you give incentives for children to improve their grades, some proficiency you evaluate on a bi-monthly basis. What you're learning, you give, for the poor kids. And one thing that I learned during the pandemic is that there is a greater impact on females.
Mm-hmm.
Not a he session, but a she session, in a sense. And one interesting experience I've been starting to work with are microcredit programs that are for biased towards females. And in the northeast of the country, there is a specific program called Crede Amigo. It's a federal program. And so I would use this to get your point, something not so much focused on the poor, but more on people who are vulnerable or above that. So, and this program also offers life insurance, ease to buy
Why
life.
the greater impact on females?
Sorry?
Why the greater impact on females?
I don't know. It's spontaneous. In the beginning,
Yeah.
Females are 1/3 of micro entrepreneurs in the Northeast, but they are 2/3 of the clients.
Yeah.
And the profit of females rise more, although they are lower, they rise more. And it was not intentionally in the beginning. There was not a female program, but I think maybe because they are Bolsa Familia beneficiaries, 91% are females, so maybe they have a better collateral, a better situation. We don't know. That's a good question.
Terrific. Let me see if there are any questions out in the audience. Yeah, Jeremy.
We'll repeat it.
Can you hear me? Yeah. No.
That's better.
Great. So, German Sattelmeier, Bruegel. So it's been a fascinating panel. I'm still not quite sure what to learn, or let me say, how the experience of pandemic and energy shock has changed our views on how to help people, right? So before the pandemic, I think the consensus was you put in place good social safety nets ex ante, and good means they direct money to the right people that are deserving, but also they provide good incentives, and this is why Bolsa Familia was such a path-breaking program and so forth. And then you sort of sit back and wait for the shock to happen. Now, during the pandemic and the energy price shock, clearly huge amounts of social protection were put in place that were not part of these ex-ante safety nets. So one possible conclusion is that somehow pandemic and energy shock have rebalanced our views of what can be done ex ante, what has to be done ex post. But again, maybe this was just because these were such extraordinary shocks, and because they took a very specific form, like, for example, energy prices going through the roof. And so, it's hard to have existing safety nets address this, but it's specific to those shocks. And if it was specific to those shocks, we shouldn't learn anything from it. I mean, we'll just have to wait and improvise during the next shock. So, or maybe the implication is we should rebalance a little bit from sort of ex ante safety nets to ex post intervention, because we have discovered that we can actually do ex post intervention much more quickly than we thought. So can you just comment on this? So what are the general lessons that we should draw from this episodes, either about sort of the balance between ex post and ex ante, and maybe ideally about the design of discretionary intervention?
So there was a lot there. Interesting questions about the ex ante, ex post. Anybody want to start?
I can start. For me, it's in some ways the pandemic was a reminder of things we were already working on prior to the pandemic, because in the end it was a shock to poor households. It was it was a shock to middle class households. And we knew that a lot of the targeting systems we had in place, they were doing an okay job, but they weren't enough. And we knew that a lot of these programs were underfunded. And so when the shock came in, it sort of, for me, just magnified how important this problem that I already thought was very important actually was. And I think it goes back to that even if you want to do ex post and ex ante, at least in low and middle income countries, you need the systems in place to be able to manage it either way. And so one thing that was very important was the identification to be able to verify people existed. And so the existence of biometric verification was huge, regardless of where you wanted to intervene. And the fact that many countries had introduced this in years was the reason why they could do these kind of programs. So for example, everybody talks about the case of Togo, which did this very innovative targeting when the pandemic hit using the cell phone systems in place, but they were only able to do that because they had recently had an election with the voter IDs and that had a biometric identification built in. And so the second aspect was the distribution systems as well. Countries that were able to move fast and move quickly, they had developed enough banking systems in place that they could get transfers out to households, and we saw it lag behind in countries that did not have those capabilities. And so, there's a lot of debate ex post, ex ante, and how much we should invest in both. But I do think underlying it all, we need systems in place that facilitate these kind of programs.
I have a few comments. I guess one is that this pandemic highlighted for us how vulnerable people are to even just normal level shocks. We saw this giant shock, but I think it underscored just how precarious so many families are in terms of missing a single paycheck or something like that will really push them into hunger, into poverty. So in the United States, we've got a mix of policies, mostly that I think of as being ex ante, not ex post. And many of those are focused on making sure that there's incentive to work. The Earned Income Tax Credit generally is the largest anti-poverty policy for families with children in the United States. Certainly during recessions, incentives that we think are quite important during normal times become less important. And so as I think about, what did we learn from this? I think one thing we learned is that the mix of programs should be different during recessions, during this sort of ex post. We can turn up the dial in ways I think that before the pandemic, we didn't really know. Like we'd never done something so large with increasing SNAP amounts than we did this time. And I think that with some tweaks will be part of our playbook going forward for quite some time.
Anyone else? Raphael?
Yeah, thanks. I think this is an important question. I mean, one of the lessons we learned during the pandemic, including energy crisis, would be just exposed fiscal interventions could be quick, which is a very different experience relative to the global financial crisis. Again, what we learned during the pandemic is that targeting is difficult, maybe because of the nature and the severity of the shocks. But again, during the energy crisis in Europe, we again learned that targeting is difficult. So maybe going forward, much more efforts will be needed to spend on the targeting, how to improve the targeting, not just through the social safety net, but maybe building the social infrastructure that in some cases cover the middle class through the social protection systems. Another lesson is maybe as sometimes for fiscal interventions, particularly the large-scale one, it may be difficult or to phrase out in a timely manner. Again, this temporary fiscal support that we have been advocating may be difficult to unwind given the political economy pressures because people are called on to the government to stay there and to protect them. Yeah, thanks.
This brings to mind before the pandemic when things seemed to be going pretty well and economists were trying to think about kind of what we should be studying in terms of fiscal policy. It became very popular for people to talk about these programs that were automatically linked to economic conditions. They expand automatically when the unemployment rate rises by a certain amount or whatnot. Have people changed their views on the desirability of kind of this, potential shift towards more automatic, tailored programs.
I have not changed my views. I think we came together during this crisis in a way that I think surprised us all, that they were able to respond so quickly to the pandemic, that they did so many smart things. But I still think, we can learn lessons from other recessions where they were slower to act. And I still think that tagging to some economic conditions and making sure that we at least start us toward the expanded response, the expanded safety net, makes a lot of sense. But I'm glad for people to disagree.
Okay. Rima, are these sorts of programs even possible in countries where the data you don't have?
It's very hard
The data.
because of the very fact that a lot of the targeting is done based on assets, and it's done very infrequently. So in some countries, it's done like every 3 years. I've seen countries where it's done every 11 years. You do one of these surveys and decide how to change the roles. I do think there's a lot of hope that we can do that in the future if we experiment more with allowing self-applications on programs in and out, and you see that happening more in more of the emerging economies. And then also for me, I think what's going to be very interesting in the coming years, especially as we have more climate shocks, is trying to think about how do we tie automatic stabilizers to weather forecasts. And so when there's a flooding, when there's a drought, and really making sure that we can think about how we can really get out aid when both to the right places and also quickly when we expect one of these shocks to happen.
Interesting. Paolo, I saw you. No. Okay. Are there other questions from the audience?
Yeah. It was personally, I was very struck by the data that even though support to the poor in Brazil, for example, there was an increase in food insecurity. So also thinking about climate change going forward and the food crisis that you see now, do you see a role for beyond cash transfers, having any other type of programs for food security, or should this be disentangled? My knowledge would be once you give cash transfers, the household you decide to go if they need for food rather than other goods. So the question is this a matter of a supply demand of food, or is it something more structural on the poverty side?
Brazil is a main food exporter, so when price of food goes up, it's not bad for the country, it's bad for the poor in Brazil and everywhere. I think there's an important measurement question. Is that hunger really reaching 33 million Brazilians now, as is the main number? We don't really know that, I think. So I think we should, and I think this is a key question, because we are going back to types of programs that didn't work well. Type of approach or fight against hunger is something that really, moves people, especially in Brazil. And but what I think is that the Brazilian case is not a case where we do have information. We have a lot of information about the poor, more than even middle class, etc., because you have a social registry. And the tricky question is why we don't use this information. And if you analyze these political cycles, I show there, the children are very fragile part, because children do not vote. And in elections, they tend to perform worse, either in terms of income, in terms of safety nets. I think it's we should also build more market-oriented ways, in this ex-ante question, how people, because, for example, it was attempted last year to introduce consigned credit, where you discount directly on the pay bill from social programs. But we try to do that for 40%, allow people to go into debt by 40%. That was too much. I think there are policies that we are just scratching our possibilities. And for me, the big question is why we go back certain technologies where we have the data and the means to do better than that. And I think this is essentially a political question. And I think the hunger question affects a lot politically.
Can I also add? No, so I completely agree with you. I think the political issue is first order. I do want to also just mention, I mentioned briefly in my talk, so I work a lot on Indonesia. And one of the big reforms Indonesia has done in recent years was moved from giving in-kind food programs to giving a digital, these digital debit cards that basically can be used as food stamps. And during the rollout, they didn't have the money to change the whole country all at once and to do all the reforms. And so they staggered it over time and re-randomized the rollout. And so we actually can look at really well what happened when you move from in-kind transfers to basically cash, essentially. And so the first thing that we noticed was that with the in-kind program, a lot was being lost to leakages. A lot was going to people who are not actually eligible to the program. And when you move to the cash transfers, because people were getting the digital, they were getting the digital voucher, they were getting the full amount of the voucher. And they were spending it on food. It wasn't like in many studies we've seen time and time again, people are not necessarily spending it on bad things. And as a result, we were able to use the national sample surveys because it was such a large scale intervention, and we can actually show that just moving from in-kind to cash transfers led to a decline in poverty for the very poor. And it did so at the cost of the program stayed the same. And in fact, the administrative costs of the programs fell because the digital transfers were a lot easier to do than trucking rice around the country. Now, we didn't see increases on average on food prices in very, very remote areas where the markets were, less thick. You saw price increases there, not enough to negate the full effect of the program, but they're there. And so we might be thinking in really remote areas how we treat them differently than other areas. I also think in humanitarian response and in areas where markets are not necessarily fully functioning, we might want to be thinking about in-kind, but at least this was very strong evidence that we could do better simply by just moving, in terms of food security, moving from canning out food to letting the markets work and giving out cash.
Quickly.
For this audience, I want to make sure that I say that food insecurity, at least in the United States, is not interchangeable with hunger, although there's more hunger in food insecure households than we maybe want to admit. But it's important economically because it's an early warning system that is highly sensitive to the conditions that low-income families face. It's also very cheap to measure. It's highly correlated with consumption, et cetera. But it's really salient for people because oftentimes food is the only part of their budget that they could expand and contract when they've got more money and less money. And so, for example, I would think of measures of poverty as a short-term stock measure, and this food insecurity is really flow. And frankly, I think that more macroeconomists should be paying attention to fluctuations in food insecurity as that early warning system.
Thanks. We are just about out of time. I'm going to do I want just a really quick lightning round, 10 words or less. What, as we look, as we get more data on kind of how things are playing out post-COVID, what is the most important direction that the research on helping households through fiscal policy needs to go? So we'll just go down the line. Rima.
I'll do it then. A very quick plug. We started a social protection initiative 2 years ago. We just did a big review paper on all of the literature and all of the open questions. So there's a lot of open questions. There's a lot to work on. It's on our website. I'm happy to share it with anyone who's interested.
Excellent. Marcelo.
I would test more. In the case, I think we do very little testing in terms of RCTs and things like that. We do a lot of monitoring in Brazil, but not so much testing on causality. And I think this would be the main direction to learn really the
Diane.
causal questions.
My answer's got to be about the children. We have to make sure that we ameliorate as much of the damage that we did to their learning as possible.
Yeah, on my side, I think the research questions could be how to make use of the digital technologies to improve the targeting, as well as like how to think about the public perceptions of different programs on the role of the government.
Okay. Well, I want to thank you all. Panel's concluded. We have a 10-minute break before the next panel, but please join me in thanking our panelists.
No, no, that's fine. But I don't want it to be on the online. Yeah. Okay, we are going to resume the conference, so if you could please take your seats.
Everyone, we're going to resume the conference. Please take your seats.
Welcome back to the Peterson Institute for International Economics, and for those of you who are rejoining us online, welcome to this conference on rethinking fiscal policy. It's a joint conference between the PIIE and the International Monetary Fund. This session is going to be about helping firms. It's a very important topic. And one that has certain similarities to the topic of helping people that we have just heard about. We have a very exciting panel of participants. I'm just going to motivate the session for a moment, and then we will go straight into the discussion. So, of course, during the pandemic, but also during the global financial crisis, governments around the world used a wide range of measures to help firms, sometimes at massive scale with very important macro fiscal consequences. And the form has taken, it has been public guarantees, equity injections, public loans, so a wide range of experiences that we can learn from. And there are trade-offs in undertaking these measures: speed versus transparency, fiscal costs versus macro benefits. So without further ado, let me introduce the panel of participants. We will have first Ji-hee Hong from the IMF. She's an economist in the Fiscal Affairs Department, and she has co-led a number of innovative papers on this topic, both reports, but also her own independent research. She will be followed by Gabriel Chodorov-Reich, who's professor of economics at Harvard University. He's, of course, very familiar with the world of policymaking and Washington, having served as an economist on the Council of Economic Advisors, among other appointments. And then Michael Strain, who's the Arthur C. Burns Scholar in Political Economy and Director of Economic Policy Studies at the American Enterprise Institute. So we'll go in that order with Ji-hee first, and the floor is yours.
So thank you very much, Paolo. My name is Ji-hee. I'm at the IMF's Fiscal Affairs Department. I would like to first thank the organizers of this wonderful conference. I'm very lucky to be here. In this presentation, I would like to discuss how governments used policy measures to support firms during the pandemic and what kind of lessons we could take away from that experience. So this talk, I will draw heavily upon several work that has been done at the Fiscal Affairs Department at the IMF, and including my work over the past couple of years on this topic. So in 2020, as Paolo just mentioned, in the face of an unprecedented shock, governments around the world use a wider range of measures to support firms. And the intention was to prevent widespread bankruptcies due to lockdowns and also to help firms rebound after the shock quickly thereafter. The measures used during the COVID really stood out compared to previous crises because of their heavy reliance on below-the-line measures in the chart shown as guarantees, equity injections, and loans, as well as forbearance schemes that are not shown in the charts. And in this talk, I'm going to refer to this combination of below-the-line measures as credit policies or credit programs for the sake of simplicity. And these credit programs will be the focus of my talk today because the COVID experience really urged us to think about how to use them, when to use them, and should we include them as a regular component in a policy toolkit alongside monetary policy or traditional fiscal measures. According to the IMF data set, the amount of credit made available by countries during COVID is staggering at about $6 trillion at the global level. And in the advanced economies, they use more heavily these measures. And some countries relied more, the envelope for these credit programs were even larger than traditional fiscal measures like tax cuts or wage subsidies. And on the right-hand chart, we see that the take-up varied across countries, and this is due to a lot of different factors, including the availability of other support measures or the design of credit programs. And to evaluate the effectiveness of credit programs in future crises, it is perhaps helpful to understand their strengths and weaknesses vis-a-vis traditional fiscal measures. An important benefit or important advantage of credit measures is that they're less expensive in most cases. They put a less direct burden, a smaller direct burden on budgets compared to above-the-line measures or traditional policies. And because of that, we think that governments will find credit policies more attractive going forward because they're dealing with high levels of debt. Credit policies can be powerful when credit markets are disrupted and there's an economy-wide uncertainty because governments provide backstops when financial institutions are reluctant to lend to firms. Credit policies are often criticized for having moral hazard issues, but if designed properly, these problems with ensuring some skin in the game by participants, this problem can be abated. On the other hand, credit policies are opaque and have long-run fiscal implications, exposing governments to uncertain cash flows. For instance, an important disadvantage of credit policies is that, unlike traditional policies, in almost all countries currently, they lack the discipline of budgetary processes. So the cost and the information of credit policies are very poorly measured and poorly reported in almost all countries, a point made in a recent IMF working paper. So with that background, let's turn to the COVID-19 experience to shed some light on these issues. Using some metrics, some could argue that COVID policies or credit policies during COVID were successful. Because as we know, that corporate insolvencies did not jump as we feared in 2020. In most cases, including in the US, corporate insolvencies fell in 2020 compared to the 2019 level. As we see in the left-hand chart, we see that the take-up in the initial months of their rollout were met with high demand, meaning that they were useful for some firms. On the right-hand side chart, we see that credit policies also shielded firms from abrupt liquidity shocks. And what we're plotting on the right-hand side is a surplus liquidity, which is defined as the firm's liquid assets, the distance from a firm's liquid asset to the minimum level of liquid assets they need to prevent bankruptcies due to lack of cash. We're using that. We're using 280,000 Portuguese corporate balance sheets to simulate a COVID-like shock to see the impact of that on firms' liquidity situations using a corporate finance model. The reference line is the blue dotted line, which is the 2019 level distribution of surplus liquidity. A simulated shock like COVID without any shock would shift the distribution to the left in the black line, showing that a lot of these firms will have negative surplus liquidity or a shortfall of liquidity, and they will suffer from bankruptcies. With policy measures, including credit policies, the distribution would actually shift to the right in the red line, actually predicting more firms even having more liquid assets than prior to the pandemic. And these results may surprise you, but with the benefit of the hindsight, these simulation results are to some extent borne out by actual outcome, because the bankruptcy rates in Portugal actually fell in 2020 compared to 2019 level, and a lot of firms ended up with more savings than prior to the pandemic. Credit policies could also have beneficial impact from a macroeconomic perspective as well, by creating a virtuous cycle or blocking a vicious cycle from starting. And this is crucial, especially at the onset of a crisis, because pessimistic expectations could easily become self-fulfilling. So when you have credit policies, it could curb bankruptcies, lower risk premia, which would create more credit in the economy and increase aggregate demand, better outlook, so this virtuous cycle could actually start. A recent IMF working paper makes this point using a DSGE model. An illustrative scenario like a COVID-like shock could lead to an output losses of 7% and investment loss of 12% in the first year of the shock. If you have credit policies, these adverse impacts are significantly reduced. A very interesting point to take away from this paper is that insight on when these policies or interventions are efficient or impactful. They show that these interventions are more impactful during a larger and severe crisis compared to smaller shocks or smaller recessions. The reason is that in smaller recessions, firms may have already buffers to withstand liquidity shock. Thereby, there will be lower bankruptcies, and there will be lower need for government support in those scenarios. So it gives some insight to when would it would make more sense to intervene with such interventions. And notwithstanding these potential benefits, programs that we examined that were rolled out during COVID-19 left a lot of room for improvement in terms of the design and implementation. There was definitely a premium to having these programs be ready in a swift manner, but a lot of programs, like the programs for households, these programs were poorly targeted. Several programs that we examined actually had 100% guarantee with requiring no skin in the game by participants. And this was exacerbated by the policies that governments adopted that mandated banks to approve automatically the loan demands, requiring only minimal self-reported criteria. So this led to a quick loan disbursement, but this raises definitely a concern for adverse selection, because the firms that are ex-ante financially weaker are more likely to apply for these loans. Therefore, there's a concern for adverse selection. Also, it raises fraud concerns because loans were it was just given out to almost all firms that demanded it. A recent IMF working paper carefully examines 13 credit programs that were deployed in 7 large advanced economies. And we calculate the subsidy element, which is the cash flow, present value of the cash flows to governments to these guarantees. You can think of these subsidy elements as something equivalent to the budget cost above other above-the-line measures. And we see that in countries that rolled out very generous credit programs, such as in the US or Japan, this subsidy element is quite high, reaching about 4% of GDP. These untargeted measures and generous measures also have implications for long-run economic distortions, because they could raise concerns for zombifications by locking in valuable assets or resources into inefficient firms that should have exited and should not have received these funding. Finally, with that, I would like to just jump to the takeaways. So the pandemic has given us the opportunity to evaluate the potential role of credit policies and their potential uses. We have seen during the pandemic, in some cases, that credit policies were helpful in preventing firms from going to bankruptcies, and also by boosting confidence in the economy. But as we think about future uses, the bar for future interventions at such a massive scale should be set high for the reasons that I mentioned above. If credit policies are to be made available and governments find it attractive to use such interventions in future policies, whether as a standalone policy or in conjunction with other measures, they should be available. They should build their institutional capacity and be ready to deploy them as they are needed in the future crisis. I didn't go over the details, but the IMF papers that I mentioned in the beginning, they offer a bit more detailed prescription or the checklist and frameworks that we could think about it. I definitely would love to invite the interested readers to take a look at them. I'll stop there. Thank you.
Okay, thank you very much to the Peterson Institute and the IMF for organizing. I think it's a very timely conference and inviting me to be part of it. I am going to exercise what I view as a core principle of the Peterson Institute, which is comparative advantage. And as Jihi focused on the global experience, I will focus a little bit on the US experience, but try and draw some lessons that apply broadly. So I thought I'd start with a chart that at a high level captures what I think business aid was trying to do during the pandemic. Let me start with the left panel and the dark black line, which shows total employment at businesses that closed in each quarter of 2020 relative to a typical quarter during the pre-pandemic period. So what it shows is that in the lockdown quarter, the second quarter of 2020, there were about 1.4 million jobs that were lost at businesses that fully closed during that quarter. And to put that number in context, I added some other years on this graph. So the red line shows 2008, the orange line shows 2009. This is the Great Recession period, also periods of large job losses at firms that were closing, but just dwarfed in magnitude by what happened during COVID. The right panel shows jobs lost at firms that closed and never reopened. And you see there is still a spike in the second quarter of 2020, but it's drastically less. It's about a quarter of the amount of employment lost that was temporarily shut down. And moreover, if you look at the third quarter, the fourth quarter, and then into 2021, there's no bounce back. If anything, jobs lost at permanently closing establishments are lower in those quarters. So if you do a cumulative total over the course of 2020, you get a very small bump. And so at a high level, that's what business aid was about. There was a concern that firms were going to shut down because of the lockdown. They would never reopen. With that loss would go firm-specific capital, employer-employee relationships, and that would lead to a slower recovery because you didn't have the capacity in place to rehire. And that was avoided. The question is, does that mean we should declare victory for overwhelming fiscal support to businesses? Or were there other things going on, and what lessons should we draw? So before I get to lessons, I wanted to detail what I think are plausible rationales for providing aid to businesses. The previous panel talked a lot about targeting. With households, there's a pretty clear objective of avoiding hunger, avoiding people being evicted. With aid to firms, it's a little bit less clear. We're intervening in markets. So I thought I'd lay out what I view as 5 possible rationales for governments providing aid to businesses. The first are frictions in financial markets. So these could be balance sheets constraints on banks that make them unable or unwilling to lend toward the borrowers. They could be asymmetric information about firms, or the fact that firms can't fully pledge future revenue in order to obtain a loan during a period of slack demand or shutdown. A second rationale is also private contracting friction, but this is in the labor market side. It's the fact that wages tend to be rigid during recessions for a variety of reasons. Firms don't reduce wages to incumbent workers. As a result, if firms may end up firing workers where socially that worker would have been happier receiving lower income and remaining at the firm, and that's another source of inefficiency that governments might want to try to address. Those are both private contracting frictions. A third is externalities. So this is, I listed 3. Workers who, with too much unemployment, may congest the labor market, may make it more difficult to find jobs. Too many firms going through bankruptcy at one time can lead to inefficient liquidations. And third, aggregate demand externalities. As workers lose their jobs, reduce consumption, that reduces demand for other firms, and one can have an aggregate demand spiral. A fourth possible rationale is that we're not really trying to help the businesses, we're trying to help the workers, and business aid is just a conduit for getting aid to households. And a fifth is social insurance. So the first 4 you could really apply to many different recessions. The fifth, I think, is a little bit more COVID specific, and Christy and David are here and have written a paper on this. And the idea that COVID was so unexpected that ex ante, if people knew there was a possibility that businesses might shut down during because of a pandemic, they might have had some insurance against that. Ex post, we might want to fill in that gap. So let me turn from that to what I draw as 5 lessons that I take from the COVID experience. The first, not surprisingly given my previous slide, is to be very clear about objectives. And again, it's just more nuanced here than it is in the household case, where it's a little bit clearer what we're trying to do. The second is that policies interact with each other. So in the fog of early 2020, when COVID was happening very quickly, made a lot of sense to do an all of the above overwhelming approach on both household and firm sides potentially. Going forward, we want to think a little bit more carefully about how these things interact. A third is presumptively, to the extent that we are going to intervene and give money to firms, there should be a strong presumption that it should go to smaller firms, both because they are more likely to face financial frictions, so satisfy the rationale for aid, and because it limits the total cost of the program. Larger firms require larger interventions, and that costs money. The fourth is no one policy fits all. The nature of the shock matters to policy design. And the fifth, which I have found very interesting from the previous panel and from Geeta's remarks, seems to be a theme of this conference, and that's a useful conclusion to draw, is that administrative capacity is really important. And so I'll try and come back to that. Here's a list of major programs that were done in the US in giving aid to businesses. This is from a chapter for a book I did for the institution across the street. And what it shows is several programs. I'm going to focus on 2 out of this list. One is the Paycheck Protection Program, which was the largest program of aid to businesses by far in the US. And the second is the Main Street Lending Program, which was a Federal Reserve facility. And I'm going to try and use those 2 programs to illustrate a little bit the lessons that I just drew. So let me start with the Paycheck Protection Program. So this was essentially for givable loans. So think of these as essentially grants to firms of up to 500 employees. The amount was set at 2.5 times pre-pandemic monthly payroll, with a cap at $10 million, and there were some subsequent rounds of this that were reduced. It was originally passed in the CARES Act at the end of March of 2020. So the first question is, what was the objective? And just to be stark about why I think that question matters, the designers, so Marco Rubio, who's one of the Senate sponsors of this program, has said pretty clearly that he was interested in preserving employment during the spring and summer of 2020. When you assert that, that comes immediately to how different policies interact. So in the spring of summer 2020, there were also a lot of workers who were laid off. In April of 2020, there were perhaps as many as 12 million workers who were laid off from their jobs and were subsequently recalled to their previous employer. So, and at the same time, they were receiving, or eventually would receive, enhanced unemployment insurance. So these were individuals who were able to maintain a relationship with their previous employer. They received income support during the lockdown period, and they did all that without being part of the PPP program. So I come down a little bit more where I think Michael, who's going to talk more about the PPP, comes down, that this is not so much about preserving jobs in the spring and summer of 2020, it's about creating conditions for a rapid reopening. And in that case, the rationales are more tightly tied to financial borrowing frictions. Firms who did not have pre-existing committed lines of credit could not easily develop such lines of credit or couldn't draw on their lines of credit even if they had them. And that coupled with some aggregate demand externalities, that if you don't have firms reopening, there may be spillovers to the rest of the economy. And given that rationale, that this was really about overcoming financial frictions, I think you get to a presumption that you want to target to smaller firms who are less likely to have a credit line, more likely to face such financial frictions. And to put some numbers on what that means, their total disbursements in the spring, the lockdown quarter through August 2020, so this is the first round of PPP, there were 5 million of these loans or grants dispersed, for a total of a little more than $500 billion. 80% of those disbursements were of an amount less than $100,000. But a third of the total cost came from the disbursements that went to the largest recipients of more than $1 million. So a lower cap of below $1 million would have saved a third of the cost of the program. Now let me turn to the Main Street Lending Program, or MSLP. This was a Fed program. It was backstopped by the Treasury. And it was for banks to provide loans to firms that were outside of the PPP range. So mid-sized market, the cap was less than $5 billion in revenue. There was a standardized set of loan terms that were promulgated, and banks that made loans under these terms, they would receive some fees, and then crucially, they could sell 95% of the loan to the Fed. So this is a participation, it's sort of a standard syndicate of lending, but in this case, the participant is the Fed, and the Fed took almost all of the loan balance. So the pretty clear rationale here was a concern that banks would be balance sheet constrained and therefore unable to lend to worthy borrowers. So that comes to what I gave as my fourth lesson, that there's not a one-size-fit-all approach to different recessions. This is a policy that I think may have been very helpful in 2008 and 2009 when banks really were balance sheet constrained. It was a policy that seemed like it might be important in April of 2020 when there were concerns that credit line drawdowns by large borrowers and a wave of non-performing loans was going to wreck the banking sector. Ex post, banks remained very well capitalized through COVID and up until they started to face rising interest rates. And that comes to another of my lessons about policies interacting. One reason there wasn't a wave of non-performing loans at banks was because households and firms were flush with cash that they had received through other transfer programs. So in the event, this facility, which had a total authorization of $600 billion, ended up dispersing about 17 billion or underwriting $17 billion of loans. And most of that actually happened at the very end of when the facility was open. So I hope it's now clear that I don't think that means it was a failure. In fact, I think that's a feature of this program. It turned out not to disperse a lot in a scenario where banks were relatively well capitalized. If it had underwritten a lot of loans, that would have been a reflection that the terms were too generous and banks were using this rather than drawing on their own well-capitalized balance sheets. So going forward, it's very much a policy that I would keep in the toolkit. That comes to the last comment I was going to make about administrative capacity. Another reason that the Main Street Lending Program took a while and made relatively few loans was it took 4 months to set up. Banks had to figure out, or the Fed and the Treasury had to figure out what the terms were going to be and set them up. Now, that just highlights the need to think now for what sorts of administrative capacity we might want to have in the next recession. Some of that work has been done. Once you've set up the MSLP for COVID, it's going to be much easier to enroll something similar in a subsequent recession. But I think this is an area, and we'll come back to this in the Q&A, but I'll leave being a little bit provocative. I think this town, and I've been part of this, has been a little too focused on automatic stabilizers in preparing for the next recession and not quite focused enough in administrative capacity. And I would tilt us toward the latter.
Thank you very much to the IMF and Peterson for having me here. There we go. There's something happening on the screen in front of me. It's a real pleasure to be here. I am a very regular consumer of the work of both of those institutions, and so it's nice to have a small role in producing some of their content here today. And it's just been a terrific day. Let me give some lessons and conclusions from the Paycheck Protection Program. I promised I would do this in 10 minutes, so we'll see if I keep that promise or not. I want to just highlight 4 lessons and conclusions. The first is that PPP seems to have worked. I put "worked" in quotes in the spirit of the previous presentation. It's not totally clear what the objectives were, and so deciding whether or not it worked is something of a term of art. But I would argue that it seems to have worked in a holistic sense. Despite PPP's success, I think future efforts should be better designed. There were some design flaws that were apparent at the outset, and I think also some design flaws that we now know from evaluation. I also think it should be better implemented. This is related to administrative capacity. I completely agree about the need for better administrative capacity. This has been a feature of this panel, also was a feature of the last panel. Some of the state unemployment insurance program systems, for example, to take the obvious example, really are about 4 decades out of date in terms of where they should be. That wasn't such an issue with PPP, but it was more an issue of leadership at the Treasury Department and the SBA that I think could have implemented the program better. And then finally, I'll argue that future efforts will almost surely not be needed. I hope that is true, and I also think that it is true. So this is both a hope and a forecast. So PPP seems to have worked. I'm going to actually present some new work. I'm presenting this for the first time, and so this is preliminary. So please don't cite it. It could end up being wrong, but I think it's right. This is joint work with Glenn Hubbard at Columbia. We use Dun & Bradstreet data, which is, I think, a familiar data source. And we take establishments that were active in June of 2019. We assign them to size class categories based on employment in February of 2020. We know whether firms were approved for a PPP loan, and then for some firms, we know information on their profits.
We estimate that that's just a standard event study. And we look to see whether PPP supported employment. And an event study, of course, kind of a dynamic difference in difference. What's the effect of PPP on employment kind of each month after the CARES Act was passed? We control for state by month effects, industry by month effects, so we control for a bunch of stuff. And when I say PPP seems to have worked, I mean that PPP supported employment. PPP supported employment over the medium term. So there was concern that PPP may have supported employment in April, May, June of 2020, but that wouldn't have continued, that you're just throwing money at these firms, you're keeping them alive for a little while, then they're going to go out of business when they run out of that money. That doesn't seem to have happened. Very much in keeping with the previous presentation, we find that PPP had larger effects on relatively smaller firms, which is an important lesson for the future. And then perhaps more speculatively or provocatively, I'll argue that PPP seems to have supported employment among the quote-unquote right firms. And this is a graph that shows PPP's effects on firms of different size, just the kind of standard event study graph. So we estimate PPP on firms with 1 to 250 employees. That's what the circle is. Here we're comparing firms that were approved for a PPP loan in that size class versus firms that were not approved for a PPP loan in that size class, both before and after the CARES Act was passed. The square are firms in the 1 to 10 employee size class, and the triangle are firms in the 1 to 3 employee size class. And this graph kind of shows all 3 points. You see that employment was supported after the program began. You see that effect lasted until December of 2020. So not just 2 or 3 months after PPP started, but 9 months after PPP started. And you see substantially larger effects for the firms with 1 to 3 employees rather than the firms with 1 to 250. We do this, of course, with firms 1 to 500 as well, and the pattern holds. If you look at firms in the industries that were most characterized by in-person interaction, retail establishments, eating and drinking establishments, amusement and recreation establishments, these are the types of firms that experience the largest employment losses in the CES and in the data that underlie the monthly payroll survey. Here as well, you see an effect for PPP. In retail, maybe that effect died out around month 6, but it kind of kept going strong for the other 2. And again, this is in the 1 to 250 employee size class. In the 1 to 3 employee size class, you see substantially stronger effects for PPP. The magnitude of the coefficient is about double, and you don't see any sort of attrition in the effect, in the employment supporting effect of the program. So those are those first 3 conclusions. PPP did seem to support employment. It seemed to support employment over the medium term. And it seemed to support employment relatively more among smaller firms. What about this 4th conclusion? PPP supported employment among the right firms. Earlier in the session, we heard concern about support to businesses kind of keeping firms alive that shouldn't be alive, zombie firms, firms of this nature. Those are, I think, very legitimate concerns that I and many others had at the time when the CARES Act was being designed. Of course, it's hard to know, which are the right firms to be saved and which are the wrong firms to be saved. One measure of that is profitability. For some firms in the DNB data, we have data on profitability, and so we're able to look. This is a kind of a dynamic triple difference in difference where we're comparing firms that were approved for a PPP loan versus firms that weren't, intersected with firms that were very profitable versus firms that are not profitable. So firms in the top 10% of profitability. And here you see, particularly for particularly kind of in that medium-term range, you see that PPP disproportionately supported employment among the firms that were the most profitable. I don't want to be too strong about this. Concerns about zombie firms are I think very relevant, and this does not at all suggest that PPP didn't keep alive some firms that, in some sort of socially optimal sense, it would have been better if they had not been kept alive. It's just to say that the effect was relatively stronger among relatively more profitable firms. So that's at least one analysis kind of what happened, focusing on employment. I want to argue that future efforts should be better designed than the PPP program was designed. Some of these arguments were made by me and by others back in February and March of 2020. Some I think have emerged from subsequent research. This focus on smaller firms I think is really, really important. A 500 employee firm is a large firm. I mean, it's not a large firm, right? It's not like JP Morgan or something, but it is a different type of firm than a kind of small business that we had in mind when discussing the PPP program, a restaurant, a flower shop, something of this nature. And you would save a lot of money on program costs. That probably wasn't the most important consideration back in March of 2020, but certainly I think the bang for the buck was much larger on smaller firms. In addition, I think the kind of basic argument that larger firms have access to credit markets and have more sophisticated finances and therefore don't need this type of support is right. Where to draw that line? I would draw that line, I think, below the 500 employee mark. So a focus on smaller firms. I think a focus on services sector firms would have been better. Manufacturing firms could. I mean, again, go back to when the program was designed. I don't remember the specific length of time, but 6 weeks to slow the spread or whatever. I mean, these were the kinds of things that were being said. If you were a manufacturing firm, you could come back to a backlog of orders. You could fill those orders. It's not clear for a relatively short period where you weren't operating what your revenue losses for the year would have been. If you were a restaurant or a barber shop or a flower shop or a similar services sector firm, a lot of that business was just gone. People weren't going to get twice as many haircuts following the lockdown as they needed. Maybe people were going to go out to dinner more often, but they probably weren't going to make up all the lost restaurant meals. Similar types of arguments. So a focus on services sector firms makes sense. I think a greater focus on revenue replacement and less of a focus on payroll expense. I think this is a good example of kind of political economy, of how politics influences economic policy. We were originally talking about a revenue replacement program back in February of 2020 and March of 2020. And somehow through the political process that morphed into a payroll support program. And I think certainly the original PPP parameters were much too restrictive in focusing on payroll expenses. And I think the program could have done a lot more good for small businesses and ultimately for the economy if it had been less focused on that. PPP was a program where the car was kind of being built while it was being driven. And that, of course, is in part due to the unpredictable nature of the pandemic that we were in. A transition needed to be made as a consequence of that, kind of from this model of, okay, let's freeze the economy in place in late March of 2020, and then let's wait 8 weeks or 10 weeks and then unfreeze it and try and preserve as much as possible. That model needed a transition to a model where there was some allowance for labor and capital allocating across firms and across industries, because the length of the lockdown and what the pandemic did to consumer behavior meant that we didn't want the economy to look identical to the way it looked in March of 2020. There needed to be some evolution. And a program, particularly a program so focused on payroll expenses and not on revenue replacement, there was some tension there. And I think that tension could have been better navigated. Better implementation. It was the Treasury Department that put in that regulation about the share of expenses going to payroll, among other kind of spastic type of implementation measures that I think had two effects really. One effect was making banks not feel comfortable participating. When the program was launched, most of the major banks weren't participating. That, I think, was a pretty big failure on the part of the administration. And there was also a belief that a lot of eligible businesses wouldn't have had access to the program. Last point, future efforts almost surely will not be needed. This is a graph of weekly initial claims for unemployment insurance. And I show it just to illustrate how sudden the pandemic hit the labor market. We're kind of bopping around at a few 100,000 initial claims that week that ends on March 16th. And then the week that ends on March 23rd, we are close to 3 million. And then the next week, we're close to 6 million. That's extremely, extremely sudden. And it's also extremely, extremely severe. And it was that combination of the severity of the labor market shock and the sudden onset of the labor market shock that I think made a program like this make sense. Without a program like this, medium-term labor demand could have been really weakened, and we could have been in a period of severe recession for a long, long time. I don't expect this to happen again, and I sure hope it doesn't. And I think it takes a circumstance that looks like this to justify a program like PPP. Thank you.
Thank you very much to the presenters. That was fantastic. It really gets us started on a conversation. So I wanted to begin by asking you, and perhaps just to change the order, maybe I'll start with Gabe, but you should all feel free to come in on this. To just talk a little bit more about the rationale for these very special types of programs, guarantees, public loans. When I was looking at your slide, Gabe, on the possible rationales, if I had to vote for one rationale, to me, the most appealing one was that of externalities. The way I interpreted these very large guarantee programs in particular, and perhaps I'm more thinking about those in Europe, where we're talking about 30% of GDP in guarantees. To me, that was a way of ruling out a bad equilibrium, where essentially businesses shut down, that has an impact on their suppliers, then the banks get into trouble. So it was really a way of avoiding an economic implosion. And so when I look at these programs, some of you emphasize the role of helping small firms, retaining employment, but I think it is broader than that, because helping households can be done through other means. Likewise, when you're thinking about the types of firms that are helped. You all emphasize the importance of helping small firms, and I understand those are the ones that may be more credit constrained. But I would also emphasize the importance of large firms being more complex and therefore the ones that have more interactions with others and where the firm-specific relationships are more important. So can you maybe speak a little bit more to these trade-offs?
Yeah, I think it's a great question and comment. The first thing to say is the pandemic was uniquely severe, and Michael's last picture sort of showed that. So there are nonlinearities in the economy, and we worry about them, and even beyond the rationales, as things get very potentially dark for the economy, there may be more reason to be a little more aggressive in intervening. And I think that gets to your comment about maybe there are multiple equilibria, and we're trying to rule out a bad equilibrium. One particular program, come back to the US context, where I think that may have been very successful, and there were echoes of this in other countries, was the Fed's corporate credit facility, which was a bond purchasing program of corporate bonds. And so in March of 2020, there was real dislocations in the bond market, and pretty clear evidence of failures of arbitrage, and this made it potentially difficult for large firms to issue. And the Fed basically came in and announced that they were going to buy investment-grade corporate bonds, and as soon as they announced it, even before they started buying, bond prices rose, spreads fell, and they ended up buying relatively little, and seeming to have a pretty important impact on the price. So that's a real example of moving equilibrium, and that's just got to be a good thing to do. Now, in terms of my rationales for intervention, that was a credit market disruption. I mean, there were failures of arbitrage in the bond CDS basis that were going on at that time. Now, even there, it's not so clear how much of the intervention was due to picking the right equilibrium versus ensuring the bond market against very adverse outcomes. And there's some evidence that part of the reason they were able to support prices was because there was now an implicit guarantee that the Fed was going to step in and put a floor under the corporate bond market. And in the equilibrium path we had, that turned out not to be so costly because things turned out pretty well, but it could ultimately have proved very costly if they had to intervene. So I think even there, there are costs and concern. The last thing I'll say is the point that policies interact. So when the financial market is working well or well enough, large firms almost always have pre-committed lines of credit, and they have substantial unused balances on those lines of credit. And that really should be the first place they go to access liquidity. And that's a key difference between large and small firms, is having that backup. And then to the extent that we can help make sure that we're helping workers at those firms and those relationships, it may not be the best place to target the intervention through direct aid. And there may be other targets that are better, which again comes back to having the capacity to do the first best intervention as opposed to the second or third best intervention, which I think in this case we kind of had to do a bit.
Thank you. Maybe let's turn to Michael. I think you made a very compelling case that the impact on employment was positive. Certainly these firms were able to retain employment, and not just in the very short run, but also for some time. My question to you, and I'm coming a little bit from the estimates that Jihi presented, is at what cost? So how do you sort of assess the PPP, but more generally these programs in terms of the costs and benefits? And there are some studies that have come up with very large numbers for the cost of protecting a job. And some authors have also argued that most of the benefits actually went to the owners of the firms and to the creditors rather than to the employees. So just wondering if you have some reflections on that type of argument.
Yeah, that's a great question. I think it's very difficult to answer that question. Um, again, because of the kind of unique nature of the PPP program and the unique circumstances that we were in. I think these costs per job saved measures really kind of miss the point. PPP did a lot of things. One thing it did was support employment. Another thing it did was pick up the slack from the unemployment insurance system. The unemployment insurance system really buckled under the weight of the pandemic. If there weren't a PPP program, it would have buckled even more. Measures of costs per job saved do not take into account the fact that PPP kept millions and millions and millions of workers out of the unemployment insurance system. You see other economists attempt to estimate kind of multipliers to estimate to think about the benefits of the PPP program. But of course, the PPP program wasn't a stimulus program in the sense that we typically think of one in fiscal policy. The point wasn't to reinflate the economy in a Keynesian sense. The point was to preserve the productive capacity of the economy so that when the economy put the pandemic behind it, that productive capacity didn't need to be rebuilt. And if that productive capacity had to be rebuilt, that would have meant a much slower recovery that would have meant an unemployment rate that was much higher for much longer. Cost per job saved and kind of conventional multiplier estimates don't take into account either of those effects of the PPP program. So, I think in economics, kind of estimate beats no estimate, and I don't have an estimate of what the kind of cost benefit ratio of the program was. I think it would be very difficult to calculate one that is credible. And so, you kind of have to rely on, I think, less formal evaluations. It was more expensive than it should have been. It went to firms that were larger than it should have gone to. It went to firms in industries where it shouldn't have. And so certainly, the argument that that there wasn't kind of social waste in the program, I think is clearly wrong. But the estimates that are the most cited about cost per job saved or similar measures, I think really miss a lot of the benefits of the program.
Okay, so absolutely, one has to think about the macroeconomic benefits in addition to the ones that are more easy to measure. Maybe let me ask a final question to you, Jihi, so members of the audience will have an opportunity to come in a moment. You have said, and I think Gita said this morning as well, that the bar for these types of interventions has to be set high. Can we be more specific? How high should it be? Would it be okay to use these types of interventions in sectoral crises or smaller crises? Or where do we draw the line between sort of going all out and instead just using regular types of interventions?
Thank you so much, Paolo. I think it goes back to some of the questions that you asked to earlier panelists. When I think about bar being set high, and I'm really thinking about credit policies, there's this lack of transparency in how the costing of that, and also the benefits. We talk about benefits, especially In Gabe's slide, we talk about the externality. When there's a market failure, the bang for the buck tends to be higher. And we know that, and I agree with Michael, that perhaps precisely estimating what are the economic benefits that needs a lot of judgment. But at the same time, if there's it's a situation of a severe market failure, the bang for the buck or the benefits, economic benefits, will be higher. What I'm coming back to is that even when we decide to introduce these measures, there has to be some kind of cost calculation ex ante. And this really serves the policymakers because you are presented with several different types of instruments in front of you with a budget constraint, and you're really deciding between whether I should do a grant or if I should do a tax credit, or whether I should give grants, guarantees to companies. And then you should make these options comparable to each other. In the current system, in any of the countries, there is lack of that kind of process that enables policymakers to compare apples to apples of these credit programs. So in that sense, that bar of ex-ante costing should be the bar should be set high, where the government should really actively think about to cost it in the most careful sense possible. At the same time, I think both panelists mentioned about the administrative capacity. And even in advanced economies, we saw that is a challenge. And perhaps COVID was a clear case because we knew it was easier for us to define which were the vulnerable firms. These were SMEs in the specific sectors. We knew that pretty clearly. But already in last year's energy crisis, a lot of European countries had to struggle which were the vulnerable companies, because is it the companies that are more using energy, have a higher energy subsidy, energy intensity, excuse me, or are there firms that are smaller? Are there a certain sector that we should target? So even with that administrative data that could actually have a very precise level of information for firms, you have difficulties in defining what vulnerable firm means depending on the nature of shocks. So I think all of these should be something that we should take into account in future crises.
Thank you. And it's actually great to hear the term administrative capacity, which is something on which we at the Fiscal Affairs Department do a lot of work with countries. And it's nice that it comes also from academia and other parts of the think tank community. So definitely a lot of work to be done there. Let me turn to the audience. There's a roving mic here at the front, or there is one in the back. And we would certainly welcome questions. I see David.
Part of the narrative around the PPP program was the sort of unseemly or unfortunate distributional aspect of it in terms of who got the loans. And I'm wondering whether you can comment on that. That it was, according to the narrative, it was the well-connected, those who had pre-existing relationships with established banks. It was people whose CEO was on the board of directors of the bank, that sort of thing. So I'm wondering two aspects. One, can you comment on the validity of that and what could be done to alleviate the bias in a program like that toward those that are already relatively well-connected in the economy? And were there analogs to that problem in other countries aside from the United States?
So I think that narrative certainly has an element of truth to it. This relates to the implementation issues that I mentioned. Banks were treated as conduits for the program, and in order to get the money out quickly, banks were asked not to do any sort of borrower verification. in exchange for that, banks needed to be convinced that they would be held harmless in the event that that a borrower misrepresented their company, and banks were skittish about that. And the Treasury Department and the SBA, in my view, did not do enough to assure them that they wouldn't be hit with fines later on, or there wouldn't be investigations later on, in the event that there was some, really kind of gross borrower misrepresentation that made it into the headlines of the newspapers and that sort of thing, that the government would actually honor the deal. And one way I think that banks responded to that risk was by focusing PPP loans on existing customers. They weren't going to do background checks. They were going to kind of follow the parameters of the program. But if they had customers who they already had done background checks on, that made it a lot easier. And so I think that did lead to, especially the initial roughly $350 billion tranche of financing that was part of the original CARES Act. Remember that ran out a few weeks later, and Congress appropriated another a couple $100 billion. But particularly for that kind of first wave, I think it went to businesses that had existing relationships with banks. I think that this concern can be overstated. PPP gave out like $800 billion. It gave loans to billions and billions and billions of firms. So just the sheer magnitude of the program, I think, suggests that it didn't only go to people who, where the CEO of the company was on the board of the local bank or things of this nature. Though I'm not disputing your characterization in the narrative, but that was an issue that I think really ultimately boils down to an implementation issue.
Just to add briefly on that, I mean, I think the last point you said is really important, that the initial couple of weeks were chaotic because the program was underfunded. Eventually, it was topped up. So there's a period at the end of April where nobody got a PPP loan because there was a little gap. And then everybody who wanted to get a PPP loan was able to, and eventually they didn't exhaust the appropriation. An interesting thing that happened because of that early rollout period was that several state and local governments who had received a lot of money under the CARES Act and were thinking about what to do with it, set up programs that were very PPP-like, but were targeted with allotments especially towards borrowers who might not have access to banks, might be owned by a minority in a poor wealth neighborhood. And again, going back to my favorite theme of administrative capacity, I talked to a lot of these individuals. I mean, these were people who were spending all-nighters for 3 weeks straight trying to figure out how to set up a program. And once they had that capacity, and because of the American Rescue Plan, which gave more money to state and local governments than they really knew how to spend, several of these programs persisted and are ongoing today in giving money to businesses from state and local governments. So this does get also to the element of once you start a program, it can be much harder to stop it than it was to start it.
Because the second part of your question related to other country experiences, maybe I could shed some light on that. So for European countries that we examined, they tend to have a tier system where the conditions for guarantees tend to be stricter for larger firms. So for instance, in France, the guarantee coverage would be 90%, where larger firms like Air France or larger firms would be 70% guarantee. So you would have more monitoring skin in the game. So I think the US case would be a little bit more extreme. I could give another example of the UK. We see sometimes they still they struggle with fraud concerns because there were money that was just pushed out of the door without sufficient filtering. But even in that case, to my understanding, the cap of the loan was much lower than the PPP. So I think it was perhaps an outlier, the US case, in my opinion.
Excellent. Any more questions? Otherwise, I will go to, yes, in the back, please.
David Romer. I wanted to push a little bit more on Paulo's question about costs and benefits. This was not some little experimental program. This was $800 billion, and choose your favorite metric. That's a lot of money. And as Michael said very well, the goal wasn't to preserve employment, so cost per job isn't right. But we have no quantitative sense from anything we've heard about what the benefits were, how many relationships were preserved. And I think one thing that also didn't get mentioned is there's to think about the economics of preserving relationships. I mean, I love my florist and my barber and my local restaurants, but those are really very competitive industries where the idea that there's a lot of specific human capital and relationships that need to be preserved, it's not that compelling. So I guess one question would be, do we have any sense of whether we got anywhere remotely close to $800 billion of benefits out of this? And I think a question for Jihi is, other countries went much more into genuine guarantees rather than the grant component. So does that sort of provide a model where you can provide the lifeline without spending enormous amounts of money?
So I think you should all be very concise because we do want to go to lunch, and I have one more final question that I want to ask everybody.
Okay, I'll be concise, but this time I actually will be concise. I think that's a great question. I think you actually touch on one of the most important economic aspects of this issue, which is there firm-specific human capital for workers in those types of service sector jobs? What is kind of in the black box of production that takes place in a flower shop? How interchangeable are workers there? I think that there's actually some pretty good evidence that from linked worker firm data and estimating production functions and things of that nature. I think there's actually pretty good evidence that that match quality really does matter, even among those types of workers in that sector of the economy. But I think that is an open question for sure. And if the answer is that it doesn't really matter whether or not the local florist lays everybody off, because the local florist could just hire some new people and in 3 days get them up to speed, then I think the rationale for a program like PPP is clearly substantially less. Taking another stab at the kind of costs and benefits of the program, I would go back to Gabriel's observation that these programs all interact. I mean, if we didn't have $600 supplements to unemployment insurance, if we didn't have economic impact payments, if we didn't have all these other things, PPP would have been a lot more valuable because the money it put in people's pockets would have been a lot more valuable. How do you kind of stack that, right? Where, which programs are inframarginal and which programs are marginal? It kind of depends on your ordering for those programs, and that ordering is completely arbitrary. So, it's not a satisfying answer, but I think it's easy to know what is wrong with existing efforts to determine whether or not that was money well spent, but it is hard to know the right way to do it.
Very quickly, just to add to what makes it difficult, I think Michael's work on this is very good in the frontier of what we can do in measuring the employment impact of PPP. But it's a hard question because when 5 million firms got PPP loans between April and August of 2020, that's 80% maybe of eligible firms. You wonder about who are the 20% who didn't, who are in the control group, and why they didn't. And it comes to another thing we certainly could do better in the US. I mean, Rima made this point at the earlier panel about a program that had cash transfers up to a limit, and then they randomly gave transfers above that limit so they could actually evaluate the marginal effect around the limit. Well, gosh, it would have been nice if we had randomly given some eligibility for PPP loans to some firms above 500 employees, and then at least we would have evidence as good as we talked about this morning of randomized trials on what it actually did on the employment front, and then we can get to what were the objectives and what else might have been required.
I'll be very quick. Yes. So yes, to your question, David, we could definitely, when we do these subsidy element calculations for PPP, it's definitely an outlier because it's a grant element. We see about 100%, which is average 33%. So it's an outlier. At the same time, should we just implement the models of Europe and take it in the U.S. in the next subsequent crisis? The answer may not be straightforward because, for instance, Spain, the guarantees had a large take-up and it was considered a success, but they didn't roll out other support programs as extensively as in other countries. So just taking that model to implement, I think what we were mentioning about these interactions between the measures, that needs to be, we need to do a lot more work to understand how to combine other measures together. Yeah.
So let me follow up in the spirit of David Romer's excellent question. Let me ask you very quickly, is there one piece of homework that you would like to assign to the rest of the profession? What's the most important thing that you would be curious about to find out in the next couple of years through more research or more work in administrative capacity or whatever?
Could go. It may sound very trivial, but costing, however unscientific it could be, there's a lot of waving hands here and there, but I think costing of credit programs is something that we should all try to understand a bit better and try to devote our efforts. Yeah.
There were a lot of programs besides PPP that were implemented just in the US and they were smaller dollars, but they received much less academic scrutiny. For example, the US government gave $28 billion to airlines in 2020, $22 billion of which went to the 6 largest carriers. Was that money well spent? I don't know.
I was actually gonna say airlines because I fly a lot and I wonder quite a bit about what they do with all the money we gave them. Certainly they haven't maintained capacity or maintained their employment levels or maintained the number of routes that they travel. I think that there's a lot to be done. Economists hate to study this, but I think there's a lot to be done on the kind of plumbing of these programs. And as I mentioned from the podium, I think the unemployment insurance program gets the most attention on this because of how crazy it was that they couldn't target your unemployment check to equal 100% of your earnings. The best they could do was just add a discrete number to everyone's unemployment check. But I think in a lot of other instances, those sorts of plumbing, implementation, administrative capacity issues are very salient. With respect to the topic of this panel, why did we need the banks at all? Why couldn't the government just deposit some money into the checking accounts of all the small businesses in America? It was determined that would not work. Why wouldn't it work? What would it take to get it to work? That's not the kind of research project that'll get you in a really highly ranked journal, but I think it's the kind of research project that could have massive social benefits for the next recession.
Excellent. So we have a lot of work to do. I'm very happy that we still have our airlines. I'm very happy that we still have our local florist. And now it is time for lunch, but Adam will speak now.
No, I just want to quote Paolo. Thank you. We have a lot of work to do. It's time for lunch. At 1 o'clock sharp, because of her schedule, we will resume with Heather Boucher of the Council of Economic Advisors speech. Thank you very much.
Pretty good. Pulling off that's a pretty high cost for a job, no matter how you calculate it.
Yeah, I agree with that.
Great, thank you. Yeah, that's a lot of fun.
I move.
Yes.
People could take their seats, that would be great. We're going to get started in a moment with our lunchtime speaker. Thank you. Are we good? All right. It's my pleasure to welcome Heather Boucher to the stage. Heather, who I am just delighted to have here participating in this event. I've known Heather for many years. She currently serves as a member of the White House Council of Economic Advisors, where she advises the president on economic policy. Prior to that, she's had a number of important roles. Most importantly, she was the president and CEO of our fellow think tank, the Washington Center for Equitable Growth, which was an organization that she co-founded in 2013. She also served as chief economist for Secretary of State Hillary Clinton's 2016 presidential transition team. And prior to all of that, she worked as an economist at the Center for Economic Progress, the Joint Committee of the U.S. Congress, the Center for Economic and Policy Research, and the Economic Policy Institute. Heather is one of the nation's most influential voices on economic policy, particularly the policy at the intersection of economic inequality, growth, and public policy. She has authored and or co-edited a number of important books, including her latest, Unbound, How Economic Inequality Constricts Our Economy and What We Can Do About It, which was on the Financial Times list of best economic books of 2019. The New York Times has said that Heather is at the forefront of a generation of economists rethinking their discipline. I would agree. And they called her one of the nation's most vibrant voices in the field. Politico twice named her one of the top 50 thinkers, doers, and visionaries transforming American politics. So for all of these reasons, we are delighted to have Heather here. Heather is going to offer some prepared remarks. And then after that, we're going to go up onto the stage and we're going to have a little fireside chat. So welcome, Heather.
Okay, thank you. It is just a real pleasure. It's a delight to be here today. I want to say thank you. Thank you to Karen for that lovely introduction, to Paolo Mauro and David Wilcox for organizing what looks like a really incredible agenda, and to Adam Posen and his team for hosting all of this. So thank you to the Peterson Institute for National Economics for all that you do to inform economic policymaking. So today I am going to share with you this administration's economic framework for how we're thinking about big fiscal questions. In doing so, I will describe the broader shift in thinking that animates President Biden's economic strategy. And I'll lay out how the president's Invest in America agenda has laid the foundation for decades of sustained, equitable growth. For an economy where U.S. manufacturers drive global progress through innovation, where the greatest economic transformation of our lives is a source of strength and not weakness, where the public sector is a partner and not a rival to the private sector, and where American workers can get a high-quality job in their community. The president aims to achieve this through a strategy that focuses on making responsible and strategic public investments in specific high externality and distribution-sensitive sectors and industries. And I want to stress, we certainly cannot do this all on our own. That is why I'm so glad to be able to come and talk to you here today about how together we can solve these pressing challenges. But first, I want to talk about the thing that I know is on everyone's mind, which is the bipartisan deficit-reducing elephant in the room. Rarely seen out there in the wild, but today, here we have it. So now I'm sure that as we've all heard, and I know we were talking about it a little bit last night, there's now a 2-year bipartisan budget agreement that also raises the debt ceiling. This compromise between the Democrats and Republicans gives us more certainty that over appropriations through 2025 lowers the deficit while protecting key discretionary programs, and most importantly, avoids a catastrophic default. I join the President and members of Congress in both parties in urging a swift approval of this budget deal so we can move on to tackling our other long-term economic challenges. And in fact, it's the President's long-term fiscal vision for our country and sustained economic growth that I'm here to talk to you about today. President Biden believes and has shown that we can both be fiscally responsible and invest in America. His policy proposals spend responsibly, as seen in his fiscal year 2024 budget proposal, which would cut deficits by nearly $3 trillion over the next decade. The President's budget also puts forward a concrete proposal to keep Medicare solvent through 2050 without reducing it to a voucher program, the first to do so. And he pays for his long-term spending priorities. He has done this in part by eliminating wasteful spending. This will reduce the debt to GDP ratio and help extend the life of the Medicare Trust Fund. Case in point, Medicare will soon have the power to negotiate certain prescription drug prices so the government doesn't overpay for prescription drugs. At the same time, he's making sure that the wealthy pay their fair share of taxes that they owe by investing in the IRS's human capital and infrastructure. In the budget and elsewhere, the administration has been influenced by the work of Peterson Fellows and others in this audience. There's now a line in the budget for real net interest to GDP, building off of work done by Larry Summers and Jason Furman. And under this budget, we keep real net interest to GDP at around 1% at the end of the 10-year window, which is below their proposed 2% limit. And our forecast for interest rates over the next 10 years stays below GDP growth, which, as Olivier Blanchard and others have pointed out, indicates continuing downward pressure on debt to GDP. Now, already, the President's approach has led to strong macroeconomic outcomes. When he came into office, thousands of people were dying each day from COVID-19, and the unemployment rate was 6.3%. The immediate task was to contain the virus and to put the economy back on track. Thanks to a robust monetary and fiscal response, including the 2020 CARES Act and the 2021 American Rescue Plan, we have seen a remarkable economic recovery. This economy has added jobs more quickly than in any recovery going back decades. The unemployment rate has been hovering at lows not seen in over half a century. The share of Black workers who are unemployed is now at an historic low. The share of prime-age women participating in the labor force is at an historic high, one we've not seen since 1948. And the US economy has seen the strongest pandemic GDP recovery in the G7, weathering repeated shocks, including a land war in Europe and banking turmoil. Of course, inflation remains an important priority. Since its peak, inflation has fallen by nearly half, although it remains elevated. Core inflation is also too high, although harmonized core inflation in the United States is below that of in Europe, in the Euro area and in the United Kingdom. The Biden administration will continue to support a number of policies to lower prices and reduce inflation, including strongly defending the independence of the Federal Reserve. But the pandemic also revealed fault lines from decades-long failure to invest in America. We saw clearly the negative effects of underinvestment in our infrastructure and in industries critical for our national and economic security, of centuries of racial and economic inequality across our nation, of a lack of action on climate change, even as the cost mounted, with extreme weather and climate events costing the United States almost $120 billion per year on average. The President has taken on these challenges, passing and now implementing historic legislation to invest in America. And he's been clear that this reflects a shift in economic thinking. Indeed, the President insisted in his first press conference after entering office, quote, "I want to change the paradigm," end quote. Now he's doing just that. The core principle behind the president's agenda is that investments in America and its people are the best investments we can make. What we invest in and how we invest matters. Our investments must lead to an economy that delivers growth and opportunity. It is with this core idea that we are changing the paradigm. As I will explain, we are building a new, modern American industrial strategy, one that is tailored to our current economic moment and learns from the successes and failures of the past. Our modern American industrial strategy takes a sector-based approach to investing in our national and economic security, where individual companies succeed or fail on their own merits. That means we invest in specific, essential areas of the economy, but still let the market do what it does best, lowering costs, discovering new technologies, and uplifting successful business models. Our modern American industrial strategy is the public sector working with the private sector as a partner, not a rival. It has guided us to the Invest in America agenda that the President, in partnership with Congress, has put in place. And it guides us in how we are implementing these laws. It includes a $1.2 trillion investment in the infrastructure at the foundation of our economy through the bipartisan infrastructure law. It provides over $50 billion in funding for semiconductor manufacturing, research and development, and workforce training through the CHIPS and Science Act. And it includes $370 billion in investment towards building America's clean energy future over the next decade through the Inflation Reduction Act. These laws were designed together, and they are being implemented together. They aim to crowd in private investment. Already, since the president has taken office, private companies have announced $470 billion in manufacturing and clean energy investments across the United States. And our agenda starts from the premise that people and places matter, with commitments to fair wages and training and labor standards, to making things here in America, and to investing in places and communities that risk being left behind. With this modern American industrial strategy, the administration is rethinking the role for government in times of crisis and normalcy, and reassessing certain ideas that have guided economic policy in recent decades. Later in my remarks, I'll outline the theoretical rationale and historical precedents for this, but I'd like to start first with the economic evidence, first for what we're investing in, and then for how we are doing our investing. So let's start with the economics. The President's Invest in America reflects three primary areas of investment that everyone from academics to business leaders has identified as critical: infrastructure, technological innovation, and clean energy. As I'll outline for each in turn, there is rigorous economic evidence for why the government should and indeed must intervene. The most sophisticated approach to economic policy is one that respects the power of these long-term investments to boost our productive capacity. As economists, we know that well-designed investments in infrastructure are some of the best investments that government can make. Improving our roads, bridges, ports, and waterways increases productivity, lowers costs, and in the long run supports overall economic growth. And investments in more modern forms of infrastructure, like broadband internet, can also help promote growth, employment, health, and education. Second, innovation is crucial for productivity and growth. Despite this, since the 1960s, we have seen a striking decline in public R&D funding. Before the president entered office, public R&D funding as a share of GDP was at a 60-year low. Government funding for R&D is important for innovation, as are investments in domestic manufacturing. Consider the example of semiconductors. They are the building blocks of the modern economy and critical elements of products like televisions, refrigerators, cars, healthcare equipment, this computer I'm staring at, weapons systems, you name it. Yet even so, their manufacture has largely moved overseas. Over the last 3 decades, the share of global chips manufacturing production that is located in the United States has fallen by 2/3. Today, almost none of the most advanced semiconductors are produced in the United States. This poses a risk for our long-run economic growth and stability and for our national security. And third, we need to build the clean energy economy. I'm going to assume, for the purpose of discussion, that we all here today agree that addressing climate change is crucial and an imperative. So I'm going to focus on the question of what we do about it. There is no question more relevant to our country's long-term productive capacity than dealing with our nation's biggest long-term risk in the world's. Now, climate change is a classic market failure. Firms emit more carbon than is socially optimal. And as an economist, the most elegant solution to such a failure is market-based. A comprehensive price-based climate policy would let the market deliver new technologies that could power our world. And indeed, I doubt a single day has gone by since I joined this administration where I didn't want to turn back time and see President Johnson or President Nixon or President Carter put in place a carbon tax that would gradually increase over time. But that is not our reality. Our past efforts to enact price-based policies have failed to garner sufficient political support. We cannot wait crossing our fingers for this policy to gain political traction while the planet's biggest challenge grows by the day. Moreover, even if we could, we would still have to confront a serious economic challenge, perhaps more important but more immediate than climate change itself. To lower emissions and maintain our standard of living, we need to build a clean energy economy. We do not have a choice about whether our economy changes in response to climate change. We are already seeing the effects of climate change on our economy in natural disasters, agricultural productivity, insurance markets, and more. Without bold action, the costs of climate change will consume the expected benefits from technological growth, lowering our standard of living in the decades to come. And on top of these effects, more than 700,000 workers in the United States are employed in fossil fuel extraction, mining, and processing. And almost 2 million workers are in jobs manufacturing or repairing gasoline and diesel motor vehicles. Nearly $1.9 trillion of capital is tied up in fossil fuel extraction and processing. Most Americans use gas or oil in their homes and drive gas-powered cars or take gas-powered buses. Our choice is about what building a clean energy economy looks like, and that path will be decided by our economic policies. The President's economic agenda is grounded in the idea that a coherent, whole-of-government, modern American industrial strategy is our best chance for building a clean energy economy that benefits America's workers and communities. This idea is backed by decades of evidence as to what actually worked in the real world, what has driven energy innovation, cost declines, and emissions reductions, and what we know about how to support workers and communities. The answer is smart regulations, smart industrial policies, and a commitment to good jobs. Industrial policies are our best chance to reduce emissions and meet our Paris commitments. They're our best chance to boost productivity and foster stable, shared growth, and our best chance to support workers and communities. We can act now, investing in clean energy technologies that we know are rapidly growing, consistently outpacing projections with steep learning curves. And we believe that this will have global benefits. By one estimate, over the next decade, the Inflation Reduction Act could reduce global clean energy costs by up to 25% for some technologies. So let me summarize where I am so far. The economic evidence is clear that for these three areas, infrastructure, innovation, and building a clean energy economy, markets cannot deliver goods that are critical for our economic and national security on their own. Indeed, strategic public investments in these areas can create good jobs for American workers, make supply chains more diverse and resilient, and support stable, lasting growth. As Secretary Janet Yellen explained in a recent speech, quote, "Our policies are designed to expand the productive capacity of the American economy. That is, to raise the ceiling for what our economy can produce," end quote. And these are exactly the outcomes in the short and long term that economists should prioritize when evaluating a policy agenda. Now, our approach to how we make these investments is built on decades of evidence, which I'm going to bucket into 4 categories. Evidence that investing in people and places matter, that markets must be shaped so as to be fair and competitive, that resiliency is important to long-term growth, and that collaborating with our global partners can foster durable global growth. I'll briefly touch on each. First, the President's economic agenda starts from the presumption that people and places matter. The abstractions of economic theory have too often set aside harms for workers in specific industries and regions. According to groundbreaking research by David Otter, David Dorn, and Gordon Hanson, during the 1990s and early 2000s, rising import competition from China resulted in lasting job and income losses in US manufacturing communities. By 2011, this so-called China shock had led to the loss of 1 million US manufacturing jobs, 2.4 million jobs in total. And there's evidence that these economic outcomes contributed to growing ideological polarization and racial and ethnic political divides in the 2000s and 2010s. Today, income and wealth inequality in the United States is higher than in almost any other developed economy. This follows decades of the gains of growth accruing more to capital than labor, declining unionization, and falling labor force participation. These trends have defined my years as an economist, and addressing them is one of the primary goals of this administration. And we know paying workers fair wages and benefits, promoting unionization, and ensuring equal opportunities for all is good for workers, businesses, and the overall economy. On a larger scale, investing in places that have historically been overlooked is one of our greatest untapped resources. One study found that the economic benefits of policies that add jobs in a given place are at least 60% greater in distressed regions than in booming ones. That doesn't mean we abandon sensible place-neutral policies like progressive income taxation, and this administration has not done so. But it does mean that adding place-based policies to our toolkit is good for growth and equity. This is not an either-or, but a both-and proposition. We can address inequality and we can see the economy grow. Second, our strategy implements with an eye towards strengthening competition. These investments are designed in conjunction with a set of policies that shape markets to avoid monopoly power and build industries that are productive and fair. As the president likes to say, quote, capitalism without competition is exploitation, end quote. Consider the example of ocean shipping, which is critical for the global flow of goods. During the pandemic, the 3 global alliances, 3, that dominate the ocean freight system raised the price of shipping a container more than tenfold. A cost increase that was estimated to contribute to approximately a 1% increase in consumer prices over the following year. In the 2022 State of the Union, President Biden called for Congress to crack down on ocean shipping companies' price hikes, and Congress responded swiftly to pass the Ocean Shipping Reform Act, the most significant reform of ocean shipping laws in decades. The bipartisan infrastructure law includes nearly $17 billion to improve infrastructure in ports and waterways. Since their peak in September 2021, ocean shipping costs have fallen by nearly 90%. This is just one of the many ways we are working to shape markets to reduce rent seeking and promote growth that is both strong and equitable, and give families a little bit of breathing room. Third, our strategy invests in the resiliency and diversity of our supply chains to protect us from future economic shocks. During the pandemic, American consumers paid the price for fragile global supply chains. We saw price hikes and acute shortages in products such as new and used cars, household appliances, medical supplies, and more. We also paid the price for the outsourcing of semiconductor manufacturing. In 2021, a COVID-related shortage of chips affected an estimated 169 industries, raising prices for a range of goods. One could say that globalization of supply chains limited these shocks. And when responses to sudden short-term shocks require long-term investments, that's a mismatch. But here too, the solution is not either or. We need to build up resiliency for future shocks. Looking forward, the many risks of inaction are clear. In large part due to government subsidies, China currently controls over 80% of part of the world's supply chain for batteries used to power electric vehicles. For context, OPEC controls 40% of the global crude oil supply. We cannot let clean energy supply chains become a weapon in the way that oil was in the 1970s or natural gas in Europe in 2022. Such a lack of resiliency threatens our nation's productivity and growth, as well as our national security. We cannot predict all future supply chain shocks, but we have the opportunity now to protect against clear, foreseeable risks. The Invest in America agenda is designed to spur domestic manufacturing of critical goods like clean energy technologies and chips, so unexpected crises and geopolitical tensions do not block our access to critical goods. So yes, friendshoring, but we must all pay greater attention to the totality of the supply chain and where upstream products are coming from. Finally, this administration is committed to working with our allies and trade partners to foster durable global growth. In a speech just a month ago, National Security Advisor Jake Sullivan outlined the president's plan to renew American economic leadership. And I want to highlight one of his points. He said, quote, "We will unapologetically pursue our industrial strategy at home, but we are unambiguously committed to not leaving our friends behind. We want to join them. In fact, we need them to join us," end quote. We can't build everything ourselves, and we need our allies and trading partners to pursue their own capacity building strategies. 3 specific examples of how the administration is acting on this. In 2021, the U.S. announced the Global Arrangement on Sustainable Steel and Aluminum to promote the clean steel and aluminum trade while limiting dirty steel from accessing our markets. Last year, we launched the Partnership for Global Infrastructure and Investment to mobilize hundreds of billions of dollars in financing to close the infrastructure gap in developing countries. More recently, following a meeting between President Biden and the European Commission President Ursula von der Leyen, we established the US-EU Partnership on Critical Minerals to partner on supply chains for critical minerals essential to building a clean energy economy. This is not simplistic zero-sum economics. Instead, central to the president's approach is the positive sum economics of collaborating with our allies and trade partners. Now, all this rethinking, it's not easy. Sometimes new paradigms are dismissed for not conforming to the textbooks of decades past. But when the data and evidence change, our views need to change too. We need to be Bayesian. And that's just the sort of informed evolution the president's agenda embraces. In particular, it revisits 3 basic assumptions embedded in many of America's economic policies over the last half-century. First, these policies too often assumed that unrestricted markets would use resources productively and efficiently, maximizing our nation's long-term growth. Second, these policies assumed that the composition of growth does not matter. The notion here was that growth accruing to the top would trickle down, and that growth in any industry was equally good. And third, these policies assumed that the role of government was best suited to fixing consumption gaps with redistribution after the fact, rather than pre-distributing gains, delivering growth with equity. We now know better. Time and again, these assumptions didn't hold. Of course, we have seen the value of markets, but we also have seen how they can lead to harmful and avoidable costs. Too often, our policies disregarded or downplayed transition costs and frictions, or ignored the political agendas of our competitors. We saw this in the global financial crisis, in the COVID pandemic, in the offshoring of supply chains for critical goods, and in our failure to address climate change. We saw it as monopoly oil producers created energy shortages that rippled throughout the world. We saw it in decades of rising economic inequality, despite many of our best efforts, and in policies that ignored the binds that human beings feel to their communities and jobs. We saw it in economic policies that failed to meet the needs of the moment. Yes, there were benefits. We saw lower costs for consumers, more access to goods produced around the world. Those benefits are not going away. In recent speeches, both Secretary Yellen and Jake Sullivan, National Security Advisor Jake Sullivan, have made this point. The United States always has been and always will be an active and engaged participant in the global trading system. And we welcome healthy economic competition that delivers benefits here and around the world. But the global trading system has not always been fair, not always delivered the promised benefits to our citizens, too often favored large corporate interests over workers' interests. As economists like to say, there are trade-offs. And our assumptions have created an economy of short-term booms and busts, of starting and just to crash. Now we are working to build an economy characterized by growth that is strong, stable, sustainable, and broadly shared. This is not about building for the sake of building or spending for the sake of spending. It's about building the capacity and the potential of the American economy. It's about making targeted public investments in essential infrastructure in industries critical for our economic and national security, where private investment has proved insufficient. It's about investing in workers and communities and ensuring that they benefit from our investments in industry. And it builds on a long American history. Strategic investments are how we got ahead to begin with and how we face tough challenges. Industrial strategy was Alexander Hamilton submitting his report on manufacturers in 1791, insisting that, quote, the public purse must supply the deficiency of private resource to prompt and improve the efforts of industry, end quote. It was President Franklin Roosevelt's meeting of the challenge of the Great Depression with the New Deal, building dams, bridges, schools, highways, and creating Social Security, all while he affirmed the rights of workers to organize unions and implemented labor standards to end starvation wages and intolerable hours. It was President Eisenhower building the National Highway System, a grand plan to improve safety, reduce traffic jams, and provide for the national defense. It was a bipartisan consensus during the Cold War years to invest heavily in science and research and development, with agencies such as DARPA, NASA, and then NIH laying the foundations for America's technological dominance for decades to come. Now, our job as policymakers is to provide for the common defense and promote the general welfare. But the market was not designed to promote the general welfare. On its own, the market does not care about equity, and it cannot build the clean energy economy at the pace that we need. An unrestricted market is oriented around short-term profits and losses, not stable and sustained growth. It doesn't understand that investments in people and places can pay off with improved productivity and shared growth. And it alone cannot adequately take into account our national security interests. Markets are tools for achieving our goals, not the goals themselves. The government, working with the market, must strive towards our goals. That's why we need a modern American industrial strategy, one that uses public investment to spur private investment in innovation to achieve our goals. We are still in the early implementation of this approach, and we know that there are obstacles, such as challenges with permitting, that we need to overcome. But we've seen signs that this agenda is working. To date, the administration has announced over $220 billion in new infrastructure funding, including for over 32,000 specific projects and awards across over 4,500 communities in all 50 states, the District of Columbia, and the territories. We've seen statewide buy-in, as with the electric vehicle charging plans. All 50 states submitted, and the District of Columbia and Puerto Rico submitted their plans on time, and all the plans have since been approved. And private investments are ramping up. According to one analysis, between August of 2022 and April of this year, total announced investments in chips and clean tech manufacturing amounted to almost double the capital spending commitments made in the same sectors in 2021, and nearly 20 times the amount in 2019. This agenda has already created over 140,000 high-quality clean energy jobs. So many years ago, when Jason Furman, who I see here today, was a deputy at the National Economic Council, he told me something that I have never forgotten, and I doubt ever will. He said that when an economic advisor to the president gives advice, it has to be right. Millions of American families will see their fortunes rise or fall depending on the advice we give. And that is a very big responsibility. And the way I see it, this is a shared project. Thanks to the work of so many economists and other researchers, including so many of you in the audience here today, we have a large body of evidence to learn from the past. We will continue to need all of your help, your thoughtfulness, your research skills, and your good economics. These are unprecedented challenges. Building the clean energy economy will be a historic global transformation. And so I ask that we all approach these questions from a place of humility. In this moment of disequilibrium, we need new ideas and new tools. And I hope you will join us in this project to build a better, more resilient, and more equitable economy. Thank you.
It's great to have you here, Heather.
Thank you. What a great audience. So many people were looking at me while I was speaking. Thank you for that. Rather than at your phone.
Turn the mics on.
Oh, there we go.
Oh, we're on. Okay. The debt ceiling?
Let's start with the easy thing. Yeah.
Yeah. So you feeling better?
Relieved. I don't know about everybody here, but you know, going through the debt ceiling without increasing it was really one of the most serious risks this economy has been facing this year. And for a few weeks there, it felt a little sketchy as to whether or not we were going to get through it, especially as the date started moving sooner than had earlier been anticipated. But so I think it's a remarkable achievement that there is a deal. It's hopefully a huge relief. We are still waiting for Congress to vote on it. So this is a live moving target still. And it ain't over till it's over. But having a bipartisan deal is really, it seems like an impressive step forward.
Yeah, so it's a deal. You talked about trade-offs in your speech. It feels like, this was a compromise to get the bipartisan support. What are there things about the compromise that kind of bother you?
Well, so at the end of the day, we knew, in November when we got a new Congress, that this was going to be the art of bipartisanship, which President Biden has been committed to from day one, and it's been incredible to watch him do this, work across the aisle in the way that he's been able to. So we always knew this would be challenging, and we knew that the budget this year would be challenging. So I think at the end of the day, the deal is a good one, so long as it passes, gets everybody to the table, and can get across the finish line. And I think what's important is that the president didn't have to give up any of the things that are so important around in the Inflation Reduction Act for promoting and building our clean energy economy. I certainly had some concerns about that. And so that feels very good and important. That's where our economy's headed. That's what we need to be investing in. I think that one of the most important things we did in the Inflation Reduction Act, of course, was to increase the funding for the IRS to be able to do its job and enforce the laws on the books. So for those of you who don't know, for the past decade plus, the IRS has been starved of resources to literally enforce the laws on the books. And that has increasingly meant that those at the top have not been paying the taxes that they owe. This isn't about new taxes. It's not about anything special. It's just giving them the resources they need. So Treasury has said they can do their job, with the cuts that they've seen as a part of this deal. But I think we all need to be just a lot more attentive to Treasury's capacity. And here's the thing, I work, and I see a number of my colleagues, one of my colleagues here in the room who I work with on this, but at the Council of Economic Advisors, you get to work alongside folks from all over the administration and to see how hard the Treasury people are working and people across government to implement these incredibly detailed provisions of the Inflation Reduction Act to promote clean energy in a way that they've never done before, on top of longstanding challenges. We're asking so much of them, and I also worry a little bit that we're telling them that we don't care, we don't see their needs. So I hope that this isn't the sign of further cutbacks, but time will tell.
Great, terrific. Let's go to the heart of your speech, industrial policy. You refer to it different ways, Invest in America. You talked about it as the president's modern industrial strategy. I'm just going to say industrial policy. So we had a conversation about industrial policy several decades ago in the 70s and in the 80s. I think it was partly, at least in part, a response to a perceived economic threat from Japan. So we thought about it then, but I think most experts concluded it wasn't a good economic strategy. Indeed, it's unclear how well it worked out for some of the other countries that were pursuing it. So I'm just curious about what's changed. Is it that we were wrong to reject it back in the 70s and 80s, or is it that the world has changed in a way that makes it appropriate now, even though it wasn't appropriate before?
I think that it's a great question, and I think even the framing of the question gets at a couple of the answers here. I mean, so on the one hand, the world has changed, and we've seen other countries effectively using industrial strategies in ways that have made it hard for us to compete. So I think that's, and I'll come back to that in a second. So I think that's the first. But the second is that we didn't seem to really focus on how much it actually matters what you're able to make in your home country or among your country and close allies. And I think that the pandemic sort of really unmasked a bunch of these challenges that there were people that were talking about it all along, but it really underscored that, wow, in your moment of crisis, if you don't have the capacity to make things that are important, that puts you at a big disadvantage. And you think of both the pandemic and the war in Ukraine as examples that have just shown us how vulnerable we were in specific ways. And I think there was this sense that we didn't need manufacturing. We could have the engineers. We could outsource all the stuff that could be outsourced. And yet, we still need to make things. You need to have capacity to make things. You need to be able to be connected when you actually do need those physical things. But you don't need everything. And so I think that what we've learned is after decades of experimenting on this, on the path that we've been on, coming back and saying, actually, what we make in the United States and how we make it actually does matter. So we need to think deeply about that. And the truth is our economic competitors are thinking seriously and strategically about it. Just watching China see the writing on the wall in building a clean energy economy and making those investments and making sure that they have chokeholds on core parts of the clean energy supply chain. It's stunning to watch. And we certainly don't want to be in a situation where core parts of that supply chain can only be gotten from one country. It's a monopoly. I mean, it's antithetical to some of our core economic thinking, right? You want resiliency, you want the market to be open, fair, and competitive, and when you're in this kind of environment, we really should be focused more on what we can do to make sure that for our consumers, for our workers, our communities, it's a fair economy.
Okay, so that actually sets me up for another question that I wanted to ask, which is how do we know kind of where to stop the special government focus when it comes to industrial policy? I mean, in your speech, you argued something, I think we know this, semiconductors are very important. You pointed out that they're the building blocks for the modern economy. It's not great to have so much production occurring outside the United States, particularly in places that are at risk in a geopolitical sense. But a lot of goods are important for the modern economy. So how do we decide kind of where we're going to focus this industrial policy and where to stop and leave it to markets? I mean, should we have a special policy for lithium batteries? You know, should we have one or more of a special policy for steel? You know, food is very important to us living. So how do we think about that?
It's such a great question. And once you start going down that road, it really is, it is hard to think about where to stop. I thought about this a lot in the first year when the ports didn't work, and there was a lot of concern that that people weren't going to be able to buy goods for the holiday season that winter, right? It was like, okay, so this is like, where does it end, right? I think that this is a really great question. I actually would turn the question a little bit on its head. That we've spent a long time for economists, we've spent a long time showing that markets can be so efficient and so wonderful and so great at fostering innovation and making new things and meeting demand. And I think kind of taking the step back and thinking about, well, what are the things that if you don't actually have access to them, you're really in trouble? What are the things that you actually really do need? And what are the things that really we can only really do through collective action, like roads and bridges, the basic building blocks of infrastructure, when we call the public goods kinds of things. And I think that there isn't an answer for all time. This is going to change, over time in different technological configurations. But in this moment, we know that we have not made the investments we need to make in infrastructure, including connecting people to the economy. So I think our investments in broadband are so incredibly important. Actually, I did not know until I started working at the White House and was getting a lot of fact sheets, just how many Americans do not have access to sewers or to water pipes in their home, right? So there's those kinds of investments. But then in terms of some of the industry stuff, chips and clean energy are unique, and both of them in different ways. Chips for national security reasons, and because they're embedded in everything, but also having access to that, knowing where they are made does have national security implications, or potentially could. It puts you at risk. And clean energy, and we've been waiting for decades for the private market to do something about this, or for us to put together, some sort of pricing mechanisms, and we haven't done it. And the reality is that now we have to do it really quickly. And so I think the good news is there's actually a lot we can learn from development economics and from industrial policies that have worked that show us, oh, you actually can invest in infinite, you can make this work. But I think that one of the boundary points you have to keep thinking about is we aren't just investing in a widget, a specific clean energy magical technology for everything. We're investing in the whole clean energy ecosystem, right? All sorts of different kinds of technologies, all different kinds of firms. Most of it is through tax credits that you can just get. You don't have to, right? You're not picking winners and losers. But that question of what you invest in, how far up the supply chain do you go? Like, that's an analytic question. Where up the supply chain is actually going to make you the most vulnerable? And so I think these are questions that we are thinking and working on every day. But the point is that we do know that we need to produce the kinds of clean energy that we need, and we need those core technologies that use it, like electric vehicles. So those seem really clear, and then it's iterative questioning, I think, as you kind of get further out from that. Actually, one more thing. I would actually add, because we too often forget that core to the president's agenda, his industrial strategy through the campaign and the first year, and he's still committed to it, is the care economy. And that's another place where markets don't work as advertised, where it's very difficult for these businesses to be able to bring in the right kind of talent at wages that will bring in that talent be able to charge a price to consumers that can actually make that business model work. So that is another place where I think you really do need to be thinking about an industrial strategy rather than just a one-off or something simpler. For care businesses to function, they don't function like regular businesses.
I guess I want you to expand a little bit on that. I mean, I think one of the concerns we hear about the president's particular strategy is that the government's trying to do everything it likes all at once. For example, chips, people have noted, it's not just about producing semiconductors, it's also about childcare, training, other ways in which businesses kind of run their operations. And so even if you think those are the right things to do, by kind of putting all these other things in, do you worry that it's going to take the focus off kind of the main thing that we're worried about, the essential kind of goal of producing semiconductors?
So here's the thing. We're trying to foster an industry, right? Not just one plant, not just one widget, not just one thing, right? And to do that, that business needs to know that they have the resilient, an upstream supply chain that is stable and secure, that they know they're going to get have access to it. They need to know that there is a workforce that they can bring in, that people are going to be trained in it, that that they're going to have that pipeline of workers. But to have that pipeline of workers, you need not just the one, like if you just have this one specialized factory with this special skill, there's not a lot of resiliency there, right? So we aren't just investing in one chips factory, they're around the country. We're investing in a whole bunch of different clean energy technologies around the country. And in each of those, it's an ecosystem, right? It's the community, it's the upstream suppliers, it's making sure that you're creating good jobs. And so it's interesting that people have called this, that we're doing too much, when I'm like, well, but if you're running any of these businesses, these are all questions you're already asking. You're asking about location, you're asking about where you're going to get the suppliers, whatever it is you need, how long it's going to take, whether or not they're going to be stable, secure. You're thinking about your workforce and where it's coming in. We know that monopsony labor markets aren't a great thing for workers, so you want to create that whole ecosystem. You can't just, if you just think that you're going to be successful by putting one thing in, you're not creating that resiliency of that industry. That's why we call it an industrial strategy, because we're trying to build a clean energy industry. We're trying to reshore some of this, not all, but some of this semiconductor manufacturing. So that's the way that we have been thinking about it, that you need workers, and so you need to be making sure that you're offering the kinds of jobs that people will recommend their children get degrees in and go into those fields, and that has that kind of certainty. So you're trying to give certainty to the industry that you're committed to it. So I don't think of it as all the things. It's just, well, those are the things you need to think about if you want to build an industry.
Sure. So it's in the interest of trying to kind of make it easier to pave the way for these industries to kind of grow and thrive. There are people who argue that another important thing we should be doing for that to happen is to reduce regulation. So, for example, the chief financial officer of a major Taiwanese chip maker recently said that one of the big issues is that chip factories in the United States are far more expensive to build than in Taiwan. So, this raises the issue of, to what extent is that the result of regulation, and if it is, should we be reducing regulation?
Yeah, well, and I think in this case, chips are expensive to build, and they're more, Taiwan has created a whole industry around this. So you're not, this isn't an open market in the same way that so many other goods are. But that is why we are investing so much in this sector, to make it possible and profitable. And I've heard from spoken to other leaders in that industry who are really excited about being able to make those investments here in the United States, and are less concerned about some of the strictures. But we're giving them a lot of money, a lot of support for something that we've identified as very important. And we need to we're trying to make sure that they're creating good jobs, that they're bringing people in from the community, and they're not creating more harm in their wake. I mean, that's sort of I think that's one of the themes of the past 40 or 50 years of economics, is that, we think that it might be more efficient in the here and now for them to produce their chips somewhere else. And of course, they have the right to do that. Nobody's twisting their arm, right, to make them. We're providing incentives, carrots, not sticks. But if they are going to produce here, we need to make sure that it's the kind of production that's going to benefit the United States, benefit American communities, American workers, and also make it profitable for the company to do so.
Terrific. All right, so you've mentioned jobs, and I know that's near and dear to your heart. I know that's something you have just worked away at over the course of your career, kind of increasing jobs, increasing better jobs. But I also know another thing you like to emphasize is data and facts. I'm going to combine those two things. You know, a lot of what you were talking about was really manufacturing. And we know historically manufacturing has created jobs and it's created kind of these good middle class jobs. But I want to know, you know, what your view is about whether we can really return to that era in any significant way. Manufacturing employment has fallen sharply as a share of total employment. In fact, now it's only about 8% of non-farm employment in the United States. So the focus on manufacturing, you know, why so much focus, and do you really think it can kind of move the needle in terms of jobs?
Well, I will say that 2021 and 2022 were the fastest years of hiring in manufacturing, going back to the 1950s, I believe, or 50 years, one or the other. I'm getting my 50s, but for decades. So certainly you can make changes there. You know, it's interesting. We are not, so this is not a job creation. This agenda is not solely about creating a bunch of new jobs, right? It is about investing in America, creating investments that will create resilience, that will create the foundation for strong growth. And the president believes in, this economist, one of his economists believes that manufacturing is a core component of that. So it is not that we think that everybody's going to be working in manufacturing, but that we do need a manufacturing industry, and so we need more people in it. And one of the things about the decline in manufacturing jobs in this country is that you now hear a lot of employers talking about how they can't get manufacturing workers because there's no one skilled to do that. And you've got folks that could be doing those jobs, but again, why would you get those skills if you think that job is just going to go away in a year or two? Or if it's the only factory in town, there isn't that ecosystem, right? There isn't that opportunity. So part of what we're trying to do as we build a clean energy economy, which requires that we manufacture things, right? This energy is more manufactured. It's not pulled out of the ground. It's manufactured in many ways. As we do that, we are going to create jobs, make sure those are good jobs, but it's not going to be, you know, every job in America is not going to be a manufacturing job. But it is going to provide that foundation for growth in these sectors and that ability to have a labor pool that hopefully can be bigger and more supported by an industry than it has been in recent decades.
Great. I know your time's limited, so this is going to have to be my last question. I'm going to take you away from industrial policy. Theme of this conference, or a big theme of this conference, is kind of lessons from pandemic fiscal policy. And I know you've thought a lot before you were in the administration, you thought a lot about the best way for governments to use fiscal policy to fight recessions. I just was wondering if you could just, for a minute, just reflect on kind of what takeaways you have regarding the fiscal policy we use to support households and businesses in the pandemic. What are the lessons for next time? What needs to be on our research agenda, you know, as we get further out and we get more and more data? With all these questions, seems like we haven't studied. So just if you would give us a minute on that, that would be great.
Yeah, I mean, this was such a unique recession caused by a pandemic and all the things. I mean, I would say first, I think that one of the best things that we were able to do in this recession is have jobs return quickly enough that we are not seeing the kind of long-term scarring on workers or firms that we saw in previous economic recoveries. So to see those, you know, those charts that we have of you know, job gains in going over, you know, recent recoveries, and to see just how sharp this was, as it should have been, right? This was a policy-induced recession where everybody went home for the sake of us all, and then it should have been easy to bring everybody back. We actually learned how hard it was in many ways, that it's a lot easier to shut things down than to bring things back. It's hard for firms to get back up and running. It's hard once they've lost their employees. Hiring people is difficult. You know, I was able to catch the last bit of the prior panel, and I think that we know a lot about what some of the long-term scarring is from recessions. We know a lot about our, you know, the automatic stabilizers and systems that we have. But I think we don't know enough about how to keep people connected to their employer and what the pros and cons of that are. So I would be, and I think to echo some of the comments that were said in the last panel, knowing more about what the PPP program, the payroll protection program, got right and wrong, and how that did or did not overlay with unemployment insurance. I think there's a lot more that I think we need to know there. I often thought that we could have done a lot more with the short-time compensation program and kind of done a lot more to connect that to something like PPP. Maybe that, I'm not really sure if that would have worked out, but I think that is certainly a big question in my mind. But I think the other thing that we've learned is that we can have a quick recovery. We can get people back to work. And certainly we've seen the trade-off in terms of higher inflation, and time will tell how long this lasts and how much of this was really unique to the supply chain challenges of a global pandemic and a war in the Ukraine that upended global energy prices. But I think the lesson there is the bold and robust action of policymakers on both sides of the aisle over the course of a couple of years really did prevent the worst from happening. And I hope that we're spending a lot of time studying and thinking about that.
Thank you. Yeah, so Heather, just thank you. I know you're busy working on lots of important stuff over at the White House, and I just want to thank you for coming and spending this time with us. So if we could all give Heather a hand, that would be great. We have a 15-minute break, and we're going to pick up again at 2:15. So thank you, everybody.
If you could please take your seats. My name is David Wilcox. I'm a non-resident senior fellow here at the Peterson Institute. It's my privilege to moderate a panel on the topic of sustainability. I do want to begin by acknowledging what a pleasure it's been to work with Karen Dinan and Paulo Moro to organize the conference. Credit due to Paulo for really having the vision of what a constructive conference would look like. I've been impressed today with each of the sessions about how high the stakes are around each of these topics. This has been consistently true through every individual event, and it will be true, I think you will discover, with the sustainability panel. We have the benefit of three eminent experts to address this topic. Francesca Caselli is an economist at the World Economic Studies Division of the IMF Research Department. Previously, she worked in the European Department of the IMF. Her research focuses on applied econometrics, international economics, and trade. Poonam Gupta is Director General of the National Council of Applied Economic Research, which is the oldest and largest independent nonprofit economic policy research institute in India. She's also a member of the Economic Advisory Council to the Prime Minister. She specializes in macroeconomics and issues related to emerging market economics. Jeremy Zettelmeyer has been director of Bruegel since September of 2022 and was previously deputy director of the Strategy and Policy Review Department of the International Monetary Fund. Prior to that, he was our very own senior fellow here at the Peterson Institute for International Economics, among other distinguished appointments. So each of our panelists is going to start with about 10 minutes of remarks. And Francesca, I invite you to the podium.
Okay, so thank you everyone and good afternoon. Thank you so much for having me here today. It's really a great opportunity. So my presentation will discuss challenges for fiscal sustainability at the current conjuncture in a global perspective. And then secondly, I will also, I'm not touching this. I will also discuss how fiscal rules can be reformed to address these challenges. So to set the stage, let me sort of present quickly the two publications that my presentation will be based on. So it's the recent Fiscal Monitor on the Path to Policy Normalization released in April, and the recent staff discussion note on fiscal rules. So let me start with some quick stylized facts on the evolution of public finances around the pandemic and the projections for the medium term. After providing extraordinary support, as we have already seen this morning in several presentations, fiscal policy is now returning to normal. And in fact, as you can see here in the charts, primary deficits are now quickly approaching pre-pandemic levels, but some heterogeneity still remains across country groups. For instance, in advanced economies here on the left, you can see that primary deficits have been falling for 2 years in a row for levels well above those in other income groups. In emerging markets in the middle, primary deficits, when excluding China, nearly returned to pre-pandemic averages. And in low-income developing countries, there was an improvement in primary deficits, but this improvement was smaller. Turning to debt, we observe a notable decline, particularly for advanced economies and emerging markets. But in low-income countries, debt remains elevated at about 48% of GDP, a level not seen since the early 2000s. So going forward, in our projection, this gradual and moderate fiscal tightening will likely not prevent an increase in public debt, which is in fact projected to resume an upward trend. And as highlighted by this chart, this trend is mostly driven by some large advanced and emerging economies, namely the US and China. So in the previous chart, I just alluded to some very substantial swings that fiscal aggregates have been experiencing around the pandemic. In this slide, what I want to focus on is what are the drivers of this unusual movement in fiscal aggregates. So here I'm relying on a simple debt decomposition exercise for the world as an aggregate. And we see immediately that first, the movements around the pandemic is really, significant when compared to the GFC, but in fact is unprecedented even if we go well back into history, with really substantial first increase and then drop in public debt. And there are few economic drivers of the increase and subsequent drop in debt. First, the inflation surprise, here depicted in blue. Second, the end of the extraordinary support deployed by governments during the pandemic, and also, of course, the economic recovery. However, while these forces push that down, actually there are some opposing forces, namely exchange rate depreciation that here are part of the stock flow adjustment depicted in gray, and also higher borrowing costs that are pushing interest expenses up. The second point I want to make is related to the projections. As you can see here, elevated borrowing costs, growth slowing down, and inflation reducing debt less and less will be the main driving forces of debt dynamics in the medium term. What does this mean? It means that, as many others have pointed out throughout the conference, it's that medium-term outlook is quite complex amid high inflation and tightening borrowing costs. Moreover, it's not seen here, but if we were to unpack these trends even further by country or income groups, we would see significant heterogeneity with exchange rate depreciation and higher borrowing costs really weighing on debt in emerging markets and low-income countries, several of which are already near or in debt distress. So given these tighter budget constraints, countries are under pressure to develop credible fiscal plans to ensure debt sustainability. So in this context, several countries are considering the return to fiscal rules. And in the rest of my presentation, I will discuss some elements that should be considered when countries are thinking of modifying and recalibrating fiscal rules for the way forward. So we all know that fiscal rules have been introduced widely by several countries to fight the so-called deficit bias and to impose some fiscal disciplines. In fact, as of 2021, 105 countries had introduced at least one type of rules. However, despite their popularity, they have been often criticized for being too complex and often leading to procyclical fiscal policies when countries were faced by shocks. Fiscal rules also didn't have a really good track record in terms of compliance, particularly during bad time. The first point I want to make here is that despite often not being complied with, there is some evidence that in fact rules influence policy making, and they influence policy making given the right incentives. So here I'm showing a simple counterfactual exercise for the distribution of fiscal deficit in European countries. And here we can show that the introduction of the 3% deficit ceiling reduced deficit for countries that had very high deficits. So in an absence of the rules, these high deficit countries would have had even higher deficits. But at the same time, the rule also reduced large surpluses. So the 3% fiscal ceiling acted as a magnet, reducing the occurrence of both large deficit and surpluses. So even though it did not work in the pure intended way, it still affected policymaking and reduced deficits in countries that would tend to have a profligate fiscal policies. However, even given this evidence, we can all agree that fiscal rules in Europe particularly did not generate enough debt reduction. And of course, this is now posing some threat to fiscal sustainability, and countries are rethinking how to go back to rules. During the pandemic, we know that countries faced with a significant shock, in the large majority, either suspended the rules, modified the rules, or activated escape clauses, leading to large deviation from the rules as seen in the right-hand side chart. So given all these elements, countries are moving forward to hopefully a new generation of fiscal rules, trying to signal commitments to anchor the adjustment post-pandemic. So how can rules be reformed and calibrated? So in our staff discussion note, we argue that rules should be linked more closely to an assessment of fiscal sustainability risks and included in a broader medium-term fiscal anchor framework. The main characteristics of this framework should be three. First, there should be a clear long-term perspective and a fiscal anchor that should guide the longer-term policy should be introduced, and this can be typically thought as a debt anchor. This should be complemented by an operational limit or fiscal rules to guide policy in the shorter term, and this is an example of this is an expenditure rule. This fiscal anchor should have the ultimate objective of promote the build-up of sufficient buffers consistent with a safe, so-called safe level of debt. This is what we show in the left-hand side chart. A safe or prudent level of debt is a debt level associated with the maximum level of a primary balance that a country can sustain for the longer term. Then there should be a safety margin, as shown here, that should be calibrated, taking into account country-specific characteristics, namely the volatility of shocks that the country is subject to and others. And finally, the framework should be complemented with well-defined escape clauses that should allow more flexibility to allow countries to respond to shocks. And this point about escape clauses brings me to my last point, which is the importance of well-designed escape clauses and flexible mechanism into fiscal rules. So as I mentioned at the beginning, rules were often criticized for being procyclical, for leading to procyclical fiscal policies. In our work, we show that when countries introduce flexible rules, defined as rules either with the well-defined escape clauses or with targets set in cyclically adjusted terms, the reaction to shocks, to recession is much more counter-cyclical. So this really stressed the importance of introduce this flexible mechanism into rules. So to conclude, just some quick takeaways. So we have seen that fiscal policy has been on the way to normalizations since the incredible shock of the pandemic. This means that deficit and debt ratios are now returning to pre-pandemic levels, driven by the economic rebound, the inflation surprise, and the end of the exceptional fiscal support measures. However, public debt is expected to resume an upward trend, and this trend is driven by some large advanced and emerging economies, namely China and the US, making the near-term outlook really complex amid high inflation and tightening financing conditions. In this complex outlook, fiscal frameworks, medium-term fiscal frameworks can guide the adjustment, and this could include revamped fiscal rules with a stronger emphasis of risk assessments and some flexibility to cope with shocks. Thank you. I'll stop here.
Great. Good afternoon, everyone. Really happy to be here. Thanks to Paolo for his kind invitation. Thanks to Peterson Institute for its hospitality. The presentation that I'm going to be making is inspired from the Indian experience with public finances, both deficit and debt. It's also based on an ongoing paper with Barry Egan-Green on the Indian public debt, though the views that I'm presenting today may be considered personal, not to be attributed to him or with the institutions that I'm affiliated with. this issue of high public debt and deficits, which got stretched during the pandemic, is highly relevant for India and perhaps for the rest of the world as well. The question is, where will these elevated public debt and deficits go from here? In particular, what would the debt trajectories look like? What kind of factors will play out in determining the debt trajectories? We have discussed a lot about interest rates this morning, but also growth, inflation, primary deficit, contingent liabilities, which still remain important in some of the countries, if not in all. When we are discussing primary deficit, we did not spend as much time this morning discussing revenue buoyancy, expenditure allocation, expenditure management, etc. But in a country such as India, we are discussing all of these. It's a challenge to discuss these issues in the context of the country that I'm discussing, India, because the political classes do not take public debt levels seriously, and it's across the political orientation. And there's a reason for that. As I'll show in a minute, India's public debt has been high. It has been high for nearly 4 decades. It's currently at 85% of GDP, highest within its asset class, close to the level of an advanced economy. And yet economists started alerting about the fact that public debt is high when debt to GDP ratio was 50%. They raised an alarm when it was 60%. They raised a further alarm when it was 70%. During the pandemic, it reached 90%. And guess what? The country continues to grow. It has been among the fastest emerging markets. There has not been any debt distress. India does not have a history of debt default. So when economists cry wolf so often, political masters stop taking them seriously. So this is what has happened in India. So currently, debt to GDP ratio is 85%, and economists quietly raise issues. It's not sustainable, but how do you show sustainability? When again, there is no obvious sign of distress. It's hard to show crowding out. There is no risk as of now of rollover or risk of the debt or risk of run, and country has been growing. So this is the challenge that not just the country, but economists face as well. The question is, at its current level of debt to GDP ratio, how would the emerging priorities be financed, including on climate transition? India has had a fiscal rule. It has had mixed success with fiscal rule. The act under which the fiscal rule was established has been amended twice. The rule itself has been changed a couple of times. And currently, we don't know whether we have a rule or not because it's not met. And there's no implications for not meeting the fiscal rule. So the discussions, I think, has moved in the literature as well, whether there should be a new rule, whether there should be norms, or whether there should be just institutions. Because of the fact that politically the debt level is not taken very seriously, the discussion on fiscal rule is even behind that. So every year in the federal budget, there is some assessment of where the debt is, where it's going to go, but there's no seriousness around doing something about the current level of debt that we have. So India's public debt has been high. It has increased over the last 4 decades. It currently sits at in mid-80s as percentage of GDP. There have been some success at consolidating this debt level in the past, but it has been only a transitory success. There were reversals subsequently. And this is despite the fact that almost all through, R minus G ratio has been favorable. Growth has been higher than the interest rates. And primarily, despite a favorable R minus G, the debt to GDP ratio has increased because of a sizable primary deficit at about 3% of GDP in normal times, 2 to 3%, and contingent liabilities. So there is a risk when, eminent economists around the world, they talk about negative R minus G number, and they declare that debt can be sustainable. And such messages are picked up selectively in countries such as India. And then you have to remind them, there's a primary deficit there as well. Now, under reasonable scenarios, this public debt to GDP ratio is not going to decline significantly. The scenarios are that growth, primary deficit, and interest rates will materialize at the levels of the past decade, so decadal average, or that growth will accelerate, or primary deficit will decline, or contingent liabilities will materialize. Under all of these four scenarios, debt to GDP ratio will either increase, which is the scenario fourth, contingent liabilities materializing, or it will decline very gently in most of the cases. The baseline is a gentle increase. In order for it to decline to a slightly lower level and still very high, to mid-70s of GDP, will require a combination of factors: growth acceleration, as well as a decline in primary deficit and non-realization of contingent liabilities, a tall order. And yet, there is no sign of debt distress, and there is low rollover risk. Bond yields, for most part, have remained steady. They have declined post-COVID, actually. And currently, with slightly higher inflation than has been the case in the past 5 years or so, real yields have become negative. So how has it been possible that you're running among the highest debt to GDP ratios, but you are not paying a price for that? It's because of the composition of debt. Debt is almost all of it is held domestically, nearly 97% of it. The rest 3%, out of the rest 3%, 2 percentage point is to the multilateral institutions, which is very safe. Only 1% is held by the private sector. The domestic debt is held by institutional investors and the central bank. The fraction of debt held by the central bank has not increased. It's about 13-14% of the total. Institutional investors themselves have been owned by the government, a large fraction of them, though this ownership is declining over time. The debt is raised on fixed rates in local currency, and the average duration of the debt has been increased. So when the economists have been crying about the high level of debt, the government has been surely but steadily improving the composition of debt for all of the last 30 years. India had a BOP crisis in early 1990s, and since then, the composition of debt has been improved. There has been significant more improvement in the last 15 years. In addition, domestic savings are adequate for now and are able to finance the public debt without there being any apparent signs of distress. So what other issues and developments are important? So when I said public debt and deficits have been high in India, India has been some kind of an outlier. Part of it is attributed to the fact that revenues to GDP ratio in India has lagged other countries. It's not that India has a larger government. Its expenditure to GDP ratio is comparable to that of other countries, and it has not increased a whole lot. It's the revenue which lags. Now, revenue has been growing rapidly at about 11 to 12% a year, but so has been the GDP. Nominal GDP growth has been 11 to 12%, 6-7% real, 4-5% inflation. So which means revenues as percentage of GDP have remained stable. In addition, there has been a concerted effort to improve the expenditure allocation in two ways. A higher percentage of expenditure is on investments, capital expenditure is what we call it, and better targeted social spending. Household savings traditionally are high, but they have not increased as percentage of GDP. corporate investments actually are less than the corporate's own savings rate, which means that corporates are a net lender to the rest of the economy and perhaps to the government. As I said, there has been mixed success with fiscal rules. Fiscal rules in a federal setup are much more complex because it requires allocation of fiscal space and who can raise how much debt. So there is a vertical dimension to it, and there is a horizontal dimension to it. So where are we now? Before, during, and after COVID, when it comes to public debt in India, public debt has always been high in India. When I say always, I mean in the last 3 to 4 decades. It has increased further during COVID, but alongside the tolerance to debt has increased as well. The earlier fiscal rule that I mentioned and one of the amended rules envisage debt to GDP ratio at 60%. That's unlikely to be met. It won't be possible to come down from 85% to 60%. In that sense, tolerance for debt has increased. So the governments get very worried if inflation increases or if growth slows down or if there is not adequate employment, but they don't discuss the debt level in the same breath at all. Conventional thresholds for sustainable level of debt now seem less relevant due to the composition of debt, due to the fact that there is high domestic savings rate. There has traditionally been financial repression, though the extent of financial repression is coming down now. And the fact that institutions are still holding government papers is also because of lack of other safe assets. So the way forward, where should or will country go from here? And this may be also applicable to many other countries. Somewhat higher inflation may be the least worst and the most feasible option. I'm not talking about a very high inflation which becomes entrenched and which starts impacting inflationary expectations. Under the inflation targeting rule, India's inflation is supposed to be at 4%, which one can argue is low for its level of per capita income. And it's hard to explain to policymakers what is so sacrosanct about 4%. And India has actually a range, 2 to 6%. So why can't inflation be at around 5%? Reducing primary deficit is going to be very, very hard. Growing faster is not something that can happen overnight, and we don't even know how will that happen. So slightly higher inflation might be the least worst option. Increased revenue buoyancy, certainly, but also in countries where it's possible, privatization receipts. And I understand that the IMF or other multilateral institutions may not be able to talk about privatization unless a country is in a program, but domestically we can talk about it. We have been discussing the ways to finance climate transition. So this could be a short-term fix. Privatization and perhaps the receipts can be earmarked to pay for the climate transitions. And continuing to keep the debt composition safe and financing it through domestic savings, there was some discussion and some calls, mostly from the private sector, to let more foreign investment come into the government bonds. And some of us felt that it will not be such a safe thing to do. First, we don't need it. There are adequate private savings, household savings. And second, given your level of debt, you're unnecessarily exposing yourself to potential vulnerabilities and disruptions. I'll stop here. Thank you.
Great. So I take it this is working. So thank you so much, Paulo, Vitor, David, and Adam for inviting me. So this is going to be based on some joint work with Bruegel colleagues and also a former IMF colleague. So the objective of my presentation is to try to give an actual quantitative answer, but a very broad brush one, to the question of how much fiscal sustainability has gotten worse as a result of the combined pandemic and energy shock period. And I will do this mainly based on some pretty simple changes in distributions of debt drivers, which I will take off the IMF's World Economic Outlook and the steady state debt stabilizing primary balances that are implied by these debt drivers. So the idea here is that you have a pre-shock period where there was a certain expectation on where debt would be, where growth would be in the future, where real interest would be. Then we suffer this sequence of shocks. Now, we're not going to immediately look at what happens after these shocks because the environment is still disturbed by the shock itself, right? We still have depressed growth in some cases. In others, we have rapid recoveries. We have real interest rates possibly being high or low for cyclical reasons. So we want to look at the medium term when the dust had settled and then compare two expectations. One is the medium-term expectations on debt drivers before these shocks happened, and then the other one is the most recent one. So I'm going to be using these 5-year WEO projections for both. So it's not so different from what Gita showed this morning, with one big difference, which is I'm going to look at market interest rate projections, not WEO interest rate projections. And the reason is that the World Economic Outlook doesn't actually project real interest rates. At the margin, it projects the average cost of carrying the debt. So it's an average interest rate that, for the most part, still reflects low borrowing costs in the past, right? And what you really want to look at is the marginal interest rate. Then the next question, after I've shown you how these debt stabilizing primary balances have changed as a result of these shocks, is to ask, okay, so maybe they haven't changed by so much, but how far away are we from actually meeting them? Not only from today's perspective, but from the 5-year perspective of the IMF, right? So the IMF does build in some adjustment assumption in its projections. The question is this adjustment enough to get us where we want to be? And then finally, I will show you one indicator of debt distress that I worked on while I was at the IMF, which is a medium-term indicator, which can be very easily done for many countries. And if I have one more minute, I may also show you something on specific European countries, but that is optional. Okay, so this is my main slide on advanced economies. I will have a similar one on emerging markets. I will not go into low-income countries because that would take us too far. And so what you see here from left to right is changes in the distribution of these 5-year out expected debt drivers. So the box in each chart describes the range between the 25th and 75th percentile of the distribution. The blue box is how the distribution looked at in 2019. The orange box is how it looks now. And so the main result, and this is not surprising to you, is that even after the dust has settled, so 5 years out from today, we expect the median debt in advanced countries to be about 6 points higher than the similar 5-year out expectation before the COVID crisis. But importantly, the distribution has also widened. And so at the 75th percentile, so these are the highest debt countries, the difference is much larger. It's gone up by almost 20 percentage points. The next chart, the second one, shows how real growth expectations have changed. And this one is really interesting because, of course, one of the things that we were most worried about in COVID was the scarring, right? But, at least according to IMF forecasts, there has been no scarring effect practically anywhere in the distribution of advanced countries as a result of COVID. So if anything, median growth is slightly higher, it's projected to be slightly higher in 5 years than it was projected to be in 5 years in 2019. The third chart shows where the real action is, and that is expected long-term real interest rates have gone up a lot, by over 1.5%, and it's pretty much across the entire distribution. And then the final chart puts all these three things together, and then the result is that you get a relatively modest increase in the debt stabilizing primary balance, but noticeably, but not dramatic, increase in the order of about 0.7 of GDP. And this is really driven by the real interest rate effect, right? So if you only had the debt effect, remember that for the most part, the I minus G in these countries is negative still, right? Even according to my marginal interest rates. And you can see that from the fact that in the outward column in 2023, you still have negative debt stabilizing primary balances across the entire distribution. So in a setting like that, if you increase the debt, your debt stabilizing primary balances are actually going to become more negative, right? So the fact that they have gone up a lot is really driven by the higher interest cost. Now, same exercise for emerging markets. And the answer is here you have a bigger range. By the way, this is a relatively small sample of emerging market economies. So these are just 21 of the largest. And the reason why it's relatively small is for two reasons. One is we need forward interest rate data. So that rules out the less financially developed ones. But it also rules out the ones that are already in real trouble, right? So there is a bit of a sample selection effect here. So this sample does not include, Sri Lanka, Argentina, Lebanon, so Ukraine, it does not include Russia. So the countries that are sort of in trouble or very near trouble, it also does not include Egypt and Pakistan. But it does include Brazil, India, China, South Africa, and a whole bunch of others. Okay, so roughly similar story on the increase in debt, so something like 10% of GDP median. On real growth, a different story. So here we do see a decline in real growth expectations, particularly among the fast-growing economies, right? So this is partly China, but there are others, right? So if you like, this could be interpreted as a scarring effect. It could also be just a convergence effect. But here, real growth does matter. And on interest rates, essentially the same story as for the advanced countries. So they go up by somewhere between 1.5 and 2%. And then the overall effect is similar, so maybe an increase in debt stabilizing primary balances by 1 percentage point of GDP. Okay, this now talks about the gap between the projected primary balances in 5 years and the debt stabilizing primary balance. And so here the main takeaway is that the gap has widened, right? And this is not completely obvious. So, there is a gap or not, possibly in 2019, you have a big shock, you would then expect some adjustment after that shock. And even if the debt stabilizing primary balances have gone up, it's not clear that the distance between where you're going to be in 5 years and where you want to be has gone up, but it has, right? This is what it shows. And so the gap has widened in the order of about 1% on average, and then 1.5 to 2% for the 75th percentile. Now, in advanced countries, the gap was pretty much negative in 2019. So on average, countries were already, it had higher primary balances than they needed to be in order to stabilize their debt. And that was entirely driven by the rates were so negative, right? RNGs were so negative. So we now move into positive territory, at least at the 75th percentile. So they're about 25% of the advanced countries that would need to raise their primary balances by at least 0.7% of GDP over and above what the IMF already projects them to do by 2028. But then, so maybe not dramatic. For the emerging markets, it looks more dramatic, right? So for the emerging markets, you have at least 25%. I mean, first of all, the median needs to do more work, right? The median gap is 0.4% of GDP, so over half of the countries need to do more work than they currently have in their fiscal plans, according to the IMF. But then for 25% of countries, the extra work they need to do to get to these debt stabilizing primary balances is 2.5% of GDP, which is pretty dramatic. Right? Now, this sort of my final broad brush slide tells you what this implies in terms of the risk of debt distress. So I don't have enough time to discuss what goes into this index, which is essentially an early warning index of debt crises in the medium term. The only thing I want to point out is that the results here are mostly driven by this. Not sure if one can see this. No, one cannot. So the probability that the primary balance in 5 years might be below the debt stabilizing primary balance, which is the first of the 3 bullets that you see on the right. So the way you can think about this index is that it's a stochastic generalization of what I showed on the previous slide, right? It's about the probability of not getting to your debt stabilizing primary balance in 5 years. And that, as an empirical matter, is a strong predictor of debt distress. And so the framework that underlies this is based on an empirical exercise where you check at what levels of this index you start having more crises. And so they are particularly sort of for the purposes of communicating this 2 thresholds. One is sort of a threshold where you go from low to medium risk, and the other one is one where you go from medium to high risk. And the bottom line is here, if you look at the advanced economies, that pre-COVID, the median advanced economy had a low risk of having a debt distress in the medium term over the next 5 years. And so the interpretation here, this is an average probability of debt distress of less than 5%. And now we are 2023, you see that the median line of the yellow box in the left chart is above that green line. So the median economy is now subject to a moderate risk of debt distress, which is still not enormous. It's in the order of 0.1 on average, but it's noticeably higher. For the emerging markets, the median was always well within this moderate risk category, and so was the 75th percentile. And so the main message here is that you now see that the top of the left of the yellow box on the right is above the red line. So more than 25% of emerging market economies in the samples are at high risk of debt distress, and according to this particular indicator. And you would think it's not so many, particularly since this is a very small sample, right? Like I said, we're only talking about 20 countries, so it means that we have gone from like 2 emerging markets being at high risk of debt distress in 19 to 5 now. The thing that's slightly unpleasant is that those 5 economies include Brazil, China, and South Africa. So these are pretty big countries. Finally, I want to say something about Europe, since I'm now there. So this is one way of plotting this type of information for European countries. So the message on Europe is that debt stabilization should be feasible. So I do not think that any European country has unsustainable debt. And sort of one way of making the point is just to look at what these 2028 debt stabilizing primary balances look like. And so on the x-axis here, you see that level. And the result is that even the countries with the highest debt stabilizing primary balance based on marginal interest rates, current marginal interest rates, have, but also reflecting the average maturity of the debt stock. So this is actually based on a much more sophisticated analysis than the simpler one that I showed you before. So Italy and Greece, they have debt stabilizing primary balances in the order between 1% and 2%, which is not a killer. So this is fine. What you also see in the left chart is that most of these European countries are still below in the projected primary balances in 2023 are less than their 2028 debt stabilizing ones, right? So you see this whole cloud of points that's below the 45-degree axis, right? So in order to get to the 28 debt stabilizing primary balance, they have to creep up all the way to at least the blue line. But they have time to do so because these are 2023 projections. So on the right, you see what these countries themselves want to do. So these are no longer IMF forecasts. These are from the country's fiscal plans, the so-called stability and convergence programs. And you see that there are now many fewer of the blue dots below the blue line than in the other. Having said that, there are still about 6 countries with adjustment needs in excess of 1% of GDP. On the other hand, this is the target for 26. So even then, they still have time. Final slide. In Europe, of course, the point is not just to stabilize debt at current levels, right? The point is going to be to reduce debt. And now there's a debate about the fiscal governance framework from the fiscal rules that is essentially being fought on how ambitious are we going to be, right? So just for illustrative purposes, we picked a sort of in a medium ambitious scenario where we looked at the debt reducing primary balances such that debt would fall by at least 1% of GDP per year for the next 40 years, which if you fix the primary balance in 28, sort of in the spirit of having a 4 to 7 year adjustment period that is being discussed in the current fiscal governance reform, means you actually have a faster decline at the beginning. But still, you know, for high debt countries, you would not get to the 60% even in 40 years, right? So in that sense, it's a medium ambition scenario. So if that's the primary balance that you want, then you know, there are 15 countries currently that, based on where the primary balance is expected this year, are not there by more than 1% of a margin. And even given their medium-term adjustment plans, 12 countries would need to do an extra work of 1% of GDP in order to get their debt to start meaningfully falling, right? So this is a more pessimistic view. So basically, I conclude, I'm not going to read out the slide, but you know, the sense here is that the glass is half empty, effectively. So we are not in a dramatic situation, but fiscal pressure is meaningfully higher. And if, you know, several of the large emerging markets that are currently at high risk of debt distress go into crisis, that could be a real issue. Thank you.
Invite our panelists, please come forward. So thank you for those terrific presentations. That will provide an excellent foundation for the discussion over the rest of our time. I'd like to ask you to do an imaginary exercise. I want to take you out of this room of specialists in fiscal policy, and I'd like you to imagine that you're being interviewed by a journalist who's writing for a general audience. And the journalist is interested in explaining the concept of sustainability to a general audience. Can you, anyone who chooses to, can you discuss whether there's a consensus today about how sustainability should be defined, how it can be recognized, how it can be applied in the real world? And I'm especially interested in whether the answer to this question is, in some sense, digital, sort of 0-1, or is it an analog answer, so that there's a whole range of potential answers. And I want to underscore, I want to go back to where I started. This can't be an answer for technical specialists. So in as simple terms as you can manage, can you discuss the concept of sustainability for a general audience?
So I would tell the journalist two things. First, you know, that sustainability depends on things that are uncertain, and for that reason, there is no digital answer. There's a probabilistic answer. But more importantly, I would point out to one distinction which always causes a lot of confusion, which is, you know, the easy definition of debt sustainability is that it's sustainable if the ratio of debt to GDP does not explode. But that question leaves open how one projects these ratios. And so there are essentially two conventions. One is to project this based on current policies, right? This is what the Congressional Budget Office does. This is what Larry Summers did last night. And if you apply this convention, you come to the conclusion that the debt of the United States is not sustainable. If you open an IMF report, you will never read that sentence, not only because it would not be tactful to write this, but because the IMF has a different concept of debt sustainability, which is narrower, and that is that it's not enough for debt to be exploding based on current policy, but there cannot be a feasible policy, politically or economically feasible policy that gets the debt ratio to stabilize, right? That's the definition. And that is the definition that I've used up there. So I've looked at debt stabilizing primary balances, and then the question is, are they plausible? Yeah, could you arguably get there? And so the answer is, and the plausibility depends on several things. It depends how high are they in absolute level, but also how far are they from where you are right now. So those were essentially the two dimensions of my chart.
I can go next. So it's an issue we have grappled with for the reasons that I mentioned. The debt to GDP ratio has been higher than most other comparable countries, but the country continues to grow. R minus G is highly negative, and it's hard to prove the case that debt will explode. So how do you still make the case of sustainability without sounding technical? And so one variable we looked at was interest payments to GDP ratio. Unlike advanced economies, which can finance their debt at very, very low interest rates, in India, the interest payment to GDP ratio is close to 5%. And then you try to sensationalize it by saying, you know what, 5% to GDP is higher than combined public expenditure on education and health. So we had to come up with our own definition of sustainability, that if we continue to run such high levels of debt, then there'll be very little left in the budget to pay for, to finance other priorities. And now we are adding climate transition to that. And that gets attention.
Yes, so I think we heard a lot about the R minus G, the interest rate growth differential, and certainly that's one of the factors that affect that dynamics. But I think also in some of the factors that Poonam mentioned in her remarks about India are also what we, currently normally discuss with authorities when, we go on mission and assess that sustainability. So it's not only the level of debt, but also the composition of debt, the term structure, the currency composition. We saw in the debt decomposition that I showed before that, countries that have a larger share of forex debt did not really benefit so much from the inflation surprise because that was offsetting the reduction in debt there. And then there are also other perhaps more tedious issues that are really, but they are also so important in the way, accounting is done. And this sort of links to the problems of below the lines operation and how state-owned enterprises are included in the assessment of fiscal sustainability. So we don't typically only look at the general government debt, but entire public sectors. And, things can differ there. In many countries, we don't have good data on this. So this is also something that it's very important when we conduct that sustainability analysis in country discussions.
All right. I'm afraid the answer for our journalist is it's complicated. I was struck listening to all three of you by the emphasis that was placed on fiscal rules. In the United States, we had some experiments with fiscal rules through Graham Rudman Hollings. I think was not regarded as a wild success. I'm wondering whether the three of you can reflect on what's different in the countries in which you spend so much of your time focusing compared to the United States that makes a fiscal rule of greater salience elsewhere than it seems to be here. And a fair answer is I'm misperceiving what the situation is in the United States.
So look, I think the debate about the debt ceiling may actually have changed the luck of fiscal rules in the US. I mean, if some completely arbitrary number can force a renegotiation of medium-term fiscal plans because the politics generates that outcome, I think maybe the US is ready for fiscal rules. In the sense that, look at the UK, okay? The UK constantly has fiscal rules, constantly ignores them, and no one cares. And clearly that is not going to happen in the US anymore. Maybe that was the case in the past. And maybe for good reason, and the good reason was that the rules versus institutions point that Poonam made. I mean, rules are fundamentally stupid because they don't reflect the full range of information that you would need to assess whether actually debt is sustainable or not, right? This is why people like Olivier Blanchard and myself have argued against rules and more like for a more systematic use of DSAs in creating norms for fiscal policy, which Francesca alluded to. And I think Francesca's paper on fiscal rules is an attempt to sort of marry these ideas, right, of having more risk-based fiscal rules. And that's probably where the debate should go. But if you have an institution that actually does all these trade-offs, right, it's informed by the CBO projections, for example. The government eventually does the right thing. And of course, for the US, we have this wonderful fact that we have essentially an intact set of institutions for almost 250 years, which is the longest continuous set of institution of any country, except for the UK maybe, but it's unclear what institutions mean there. They're not formalized in the same way. And so, there's a very long-standing literature in the US that basically concludes that whenever debt goes off track in the US, and it has happened several times, eventually there is a political change that forces it to mean revert, right? And so if you have this sort of lucky set of institutions, maybe you don't need fiscal rules. But right now, I think something might have changed about the nature of the US institutional setup that may make it actually more prone to fiscal rules. Fiscal rules may be easier to enforce in the US than they were in the past because they could trigger a political conflict of the violation of the rule could trigger a conflict of the type that we have had for the debt ceiling, but one that's far less risky when it comes to default. And on the other hand, maybe we're not so confident about the quality of US fiscal institutions any more than we were in the past.
So if I may go next, fiscal rules actually have not been much more salient in India for a couple of reasons. First, as I showed in my presentation, it's not clear and it's not easy to prove the case that the current levels of public finances are creating some burdens for the society or for the economy. Second is, there is less clarity and consensus that even if India moves to a new fiscal rule post-pandemic, what should that fiscal rule be around? Should it be around a debt to GDP ratio? Should it target primary deficit? Should it target revenue deficit, which is deficit minus capital expenditure? But the two more bigger points here. One is, how should the space be divided between the states and the federal government? There has been mixed success on fiscal rules. Some states are actually, just like in Europe, there is heterogeneity. Some states on their own are highly fiscally prudent. And some states are not so, and there's politics behind it. So I guess whenever the country is ready for its new set of fiscal rules, it's not going to be easy. The discussion hasn't even started. So we are certainly several years from that. The other is, India adopted a inflation targeting framework in 2016, and it was with the divided house that it did so. And one concern was that inflation targeting will make monetary policy very inflexible and it won't be able to respond to the counter-cyclical response to the economy. So a concern that is tied with that is that you already have an inflation targeting framework, which leaves your monetary policy less flexible. In addition to that, if you also have a fiscal rule, then you may be letting go of all of your counter-cyclical policy tools out of the window. So for all of those reasons in India, fiscal rules are not much more salient than here in the US.
So perhaps a message that I can take from my fellow panelists is that, fiscal rules should be set with very specific country characteristics in mind. So it's very difficult to make broad statement how fiscal rules should, be designed in the US versus other countries. Of course, even in the way we set this prudent level of debt that I was referring to and the safety margin, you need to consider the country you are, discussing with. For instance, you cannot really compare the US to a small island that is prone to a series of, climate risks, or a commodity exporters that needs to be build buffers during, terms of trades boom. So I think, the country-specific characteristics should be the first sort of element to consider. And again, also going back to what Poonam said, that the sort of the different layers of the fiscal rules at the subnational versus national level, that also sort of highlights one of the limitation of the pre-pandemic fiscal rules and fiscal framework setting, is that often there are opposing rules. Rules tend to be very complex. There is a proliferation of rules, and that's certainly something that doesn't help also the communication of policies and, achievement of the, fiscal objectives of governments.
Iraman, tell us a little more about the prospects for fiscal governance in the EU. For those of us who are not familiar with that framework, could you start with an overview of what's in place today and how, in your opinion, that ought to be changed going forward?
Right. So what's in place today is a rather unwieldy system of several overlapping fiscal rules that constrain expenditure, that dictate that the medium-term plans of fiscal plans of countries should be targeting a minimum primary balance over time, and on top of that, there is an prohibition on deficits that are higher than 3%. So this is the overall deficit, unless the deviation is temporary and minor. And so these rules have been not very effective in the sense that they have not prevented a steady ratcheting up of debt, and of course they have not prevented the euro debt crisis about 10 years ago, even though arguably this was mostly because the fiscal rules, narrowly looked at fiscal things, and the debt crisis itself had a lot to do with private debt and a credit bubble in several European countries. So the rules have now been suspended for about 3 years since the pandemic. This can happen within the rules because there's a thing called the general escape clause, that when you're hit by a very large symmetric shock, you don't have to comply with the rules, or at least they're not enforced. There's a sense that we absolutely need rules back because we need this anchor that will help us reduce the debt. But there's also a sense that we do not want to go back to quite this mechanical approach that we had in the past. In particular, because literally applying this mechanical approach would lead us to adjustment for the high debt countries that is just not plausible in magnitude, right? So the rules would be too stringent. And so the European Commission did something very radical. It proposed a system back in November that would essentially look at each country's justifiable debt decline objectives, country by countries, based on a debt sustainability analysis. So the Commission would run these DSAs, and then based on sort of the essentially a risk view, it would argue you need to reduce debt so much over such and such horizon. DSA-based, taking into account all available information. So pretty much what some of us had argued, both Olivier Blanchard and myself in a paper, but also Jean, who's here in another paper, so a DSA-based approach. And once you have this sort of target, you would then enforce the target through a single operational rule, which is an expenditure rule. So you would set expenditure ceilings, country by country, defined on a net expenditure concept that excludes interest rates and also takes out tax policy changes. So this was sort of as pure when it comes to what the academics had wanted, what the think tank community had wanted, as is possible. But it left a few things unclear, partly for political reasons, partly because this was the nature of the exercise. And the main thing it left unclear is how ambitious are those debt reduction paths going to be, and who decides? Well, on who decides what is the level of ambition, the Commission was clear, namely they decide. And so this triggered a bit of a backlash among EU member states that thought that this was essentially a power grab by the Commission, that it would give the Commission too much discretion in deciding the appropriate degree of debt reduction for each country, and then that this discretion would inevitably, with all due respect to the Commission, be abused because the Commission can be subjected to political pressure. And so what the debate has been on is how do we deal with this problem of excess discretion? And so there are fundamentally two ways you can do it. You can either make the debt sustainability analysis itself as non-discretionary as possible. You can really open up the method. You can put it on the web. You can automatize it to a great degree by having, essentially a program that draws shocks and then creates the fan charts. Everyone knows the code. And then the only thing that's left where you can cheat is through the economic projections that generate the debt path. What's your future growth assumption? What's your future interest rate assumption? And those you can make subject to scrutiny. So this is sort of one way of dealing with the problem, the one that I would have preferred. The other way is to tell the Commission, look, you do whatever you want to do, but at the end of the day, we're going to put in some safeguards such that whatever comes out of your DSA still needs to require debt to fall by a minimum X% per year, for example, right? So you treat the DSA as this wild animal that you put in a cage, and the bars of the cage are new rules, right? And that was the approach of the German government in a non-paper a couple of months ago. And so what the Commission has done is that it has essentially acquiesced to that approach. So it has, in its legislative proposal in April, come up with a set of safeguards, which, however, are calibrated in a way that normally, if the Commission does the right thing, the way that they have always argued they would do it, just that the rest of Europe doesn't trust them necessarily, at least some countries, if they do it the right way, those safeguards would not actually be binding in most cases. So it's quite clever. Now, the question is still, have they, in a sense, safeguarded themselves too much? Have they gone too far in accommodating this reaction? We want to have additional rules. Ultimately, we want to go back to a rules system. And the jury is not completely out on that question, and we're actually working on it.
I'm having some sympathy for our mythical journalist who needs to explain all this in simple terms. Poonam, in your presentation, you used a really interesting phrase that I was hoping you could unpack for us. You mentioned that in India, tolerance for debt has increased. And it's such a striking phrase. I think it invites further commentary. Is that increased tolerance because environmental factors have changed in which India's fiscal policy needs to operate? Is it that we economists, I think you also used the phrase cried wolf too many times? What factors do you think contributed to the increase in tolerance for debt in India, and where do you see a limit to that process?
So it's because of both the factors. The last fiscal rule that India had was, I think, around in 2017, which fixed the debt to GDP ratio that India should achieve at 60%. The space was divided between the federal government, 40% of GDP, and states had to collectively not exceed 20% of GDP. And as I mentioned, it has been very hard to attain that 60%. I think there have been perhaps no years when India could hit 60%. The closest it came to was 65, 66%. And meanwhile, the pandemic happened and the ratio increased to 90%. So two things have happened during the pandemic. First, debt to GDP ratio has increased around the world, right? And in a relative sense, now the debt to GDP, the elevated debt to GDP ratios do not look so alarming. You know, if everybody else can live with it, we can live with it too. Second is, you know, because of the composition of debt being what it is, there is actually, I mean, I find it now very hard to point out any risks of this current level of debt. Bond yields are low, real yields are negative, so that awareness as well. Third is the spending priorities remain what they are, and if anything, they have become bigger, with climate being one more of the spending priority that has gotten added. In the midst of it all, the expenditure quality and expenditure composition has improved. So taxpayers are not complaining either. They can see that the higher taxes, tax collection has improved. And everybody can see that these taxes are being put to good use. So I don't see any constituency really crying out for much tighter fiscal outcomes. Now, what will change that? You know, when domestic savings start really being inadequate, when bond yields start increasing, that's what it will, you know, create the pressure. The other is the political economy of it. You know, in a federal economy, every year you have some important elections or the other. There's never a quiet period to think about restraining your fiscal. Restraining fiscal means actually letting go of some expenditures that were being incurred till then. So I don't see that quiet time ever being there. That the government actually, the central, we call the federal government the central government, is being macroeconomically very prudent in a way. It let the inflation targeting framework work very well without interfering with it. In its own ways, it's committed to fiscal prudence. The states that are being governed by the same party, which is at the federal level, are the states which are fiscally very prudent. So the better performing states actually belong to the same party which governs currently at the center. So, you know, it's a very mixed picture, you know. Overall, hard to make the case to policymakers that it's a problem. Harder to make the case of therefore what should be done about it. So my guess is, you know, again, nominal growth rate is what will bring things down a little bit, not through expenditure consolidation, which is going to be very, very hard. So better revenue generation and higher nominal growth, both through real growth rate and inflation, is what will bring the ratios down.
Francesca, I'm going to pose the last counterfactual scenario before we turn to the audience for their questions. And the counterfactual scenario is that you are now the world czar for fiscal rules, but you need to augment those rules to accommodate considerations such as climate, to incorporate that into fiscal rules. How would you go about doing that?
So
I think there's no doubt that we should be doing that to incorporate longer term challenge spending related to longer term challenges such as climate change or aging into revised fiscal frameworks. And regarding the green component, spending, some, for instance, have been arguing for the inclusion of some green rules or green golden rules, meaning that a certain portion of spending, typically public investment with the green component, would be eliminated by in the calculation of the deficit that is subject to the rule. These type of rules have been used in the past for public investment more generally, and the track record is not so great because they can typically lead to some creative accounting. So all of a sudden, everything in this case would be accounted as a green spending or green investments. And there are also some consideration relating to, which spending priority you want to have. If you allow to, have some incentives for green public investment projects, you could perhaps be displacing other projects that could have higher impact. And at the same time, sort of eliminating some items from the deficit somehow is counterproductive to the object of the rules, which is maintain fiscal sustainability. So what we argue is that a broader reform in terms of public financial management should be done, incorporating climate sensitive consideration into the entire budget process. And one way of doing this is, for instance, through green tagging, which is not something simple to do. So not many countries are doing this yet, but it's basically to go through every single step of the budget, to go through every single ministries and assess what has a green component and incorporate that into the assessment of fiscal policy. Not an easy task.
I would invite questions from the floor.
Thank you very much. No, very, very stimulating discussion. I want to perhaps start with the case of India, but then broaden the question more globally. So to be a bit the devil's advocate, one could have interpreted the presentation by Poonam to actually say that it's very clear that India's debt is fully sustainable. There's plenty of demand for safe assets from a very large and growing population, very young population that will want those safe assets, doesn't have a whole lot of alternatives. And I'm almost wondering if Jeremy turned his projections around and he calculated the steady state debt ratio going forward. Where do we get? Do we get to 120? Do we get to 140? And is that the new normal? So the conference is about rethinking fiscal policy, and it seems to me that one of the questions could be, should we rethink the demand for safe assets? Could it be that after these great disruptions, people just are more interested in having safe assets? And so should that factor into our thinking about what is the right level of debt going forward?
I'll actually just take 30 seconds, Jeremy. I don't know a whole lot about the issue. But Paolo, so I moved back to India 2 years ago. I was at the World Bank for 8 years. And so I have been in the US, World Bank, IMF for most of my professional life. So I was used to thinking about the way we all think in this room. The debt to GDP ratio 60-70% means that hell is going to break loose. Except that when Barry and I started writing this paper for a conference that my institution is organizing next month, and when I started digging deeper, I realized that it's hard to make the case that there will be a run on the debt. But in terms of where will this level settle in the Indian case, the excess savings that can still be deployed without there being a stress on bond yields, that room is now very limited. So I'm just looking at the saving investment balance. So household savings, there is a measure of excessive savings, that financial savings. That room is now very, very limited. So I think another 4 to 5 percentage points when bond yields will start reacting. There won't be enough savings to fund government debt. So the way the data is available, disaggregated data, you have public sector savings, household savings, and corporate savings. Corporate investment is less than the corporate savings by 1 or 2 percentage points. Public sector is, of course, the net borrower in the market. And household financial savings, after it's basically the government is borrowing all of the household financial savings, right? Corporate sector is a net saver. That gap is only about 2 percentage point now. So my sense is that, you know, if the debt rises by another few percentage point, there won't be enough savings in the country. And then interest rates will have to react, or crowding out will be apparent. Now, you know, it's very hard to make the counterfactual case that perhaps private investment is low because it's not getting savings at a cheaper rate. So that counter argument I cannot make. But just by looking at the amount of available savings and without opening up the government bond market for foreign savings, that gap, that extra leverage is now very, very small. So at some point it will start hitting. We are not there yet. When you start hitting that threshold, it's very easy then to make the case that economists have been making for the last 30 years.
Jason Furman for the last question.
I wanted to know what you think we learned about fiscal sustainability from the experience we just went through with COVID, and just to flesh that out a little bit, and talking to David's journalist, if they said, why does debt matter? I'd say, you know, you might have a fiscal crisis if no one will lend to you, that you might have crowd out and less investment, less growth. But there's a third thing, which is you want to preserve space if there's a crisis to be able to borrow, whether it's a war, a pandemic, whatever else. In terms of that third criteria, do you think what we just saw was countries could borrow as much as they wanted to, so maybe we don't need to worry that much about that? Or some countries could borrow more than others, and so it really did re-emphasize and double down on the importance of having fiscal space to respond to future contingencies? You know, how did the performance of countries affect your thinking on that question?
So I think it depends on the country. So we have had a few countries where the fiscal stress of the pandemic sort of tipped them into a debt crisis, right? So you can find some evidence for this really illustrates the importance of fiscal buffers, but much less than we thought, right? We thought this would be much worse. In 2020, for the most part, the emerging markets that are in debt distress now are so based on debt problems that were incurred pre-pandemic. But you can still view them as an extreme case of illustrating that, right? They had zero fiscal space, and certainly you need a little bit, okay? Other than that, I think it's... I think the sort of the really interesting case is the US. The European case is a bit special. So in the European case, first of all, of course, several countries had substantial fiscal buffers. Second, the decision was taken to, in effect, put those fiscal buffers at the disposal of the countries that had less so, through the new Next Generation EU funds, right? So this was an extraordinary fiscal support program. And at the same time, we have the European Central Bank taking away all rollover risk during this period. So you have essentially a massive solidarity and central bank intervention exercise that takes away the risk of fiscal crisis. And then the question is, how long is this politically sustainable? And economically sustainable in the sense that of course, monetary support is being taken off. So you have the whole dance in Europe about tightening without actually causing runs in debt markets, which then leads the ECB to create new policy instruments. So I think the broad sense of this is, yes, as an advanced country, or at least if you are, even if you don't have a lot of fiscal space, at least if you're in a friendly environment, you can actually do it through debt. But ultimately, there's a sense that you need to have a plan of how to get out of this. And the big discussion around the fiscal governance framework in Europe is that this is supposed to be the plan. And if we don't manage to line up something credible, maybe there could be a significant problem. Now, having said that, what our numbers show is that the actual fiscal adjustment that countries need to do in order to credibly get on a downward path is not enormous. It's not unrealistic. The question then is, do markets give them the time? The answer is, as long as the ECB is basically there to prevent a run, they will. So I don't know if this was a very clear answer. I think that the real interesting question is, how long can the US get away with this, right? So if you listen to Heather today, you get the sense that, the Biden administration is firmly focused on fiscal sustainability. If you listen to Larry last night, you got exactly the opposite impression. I'm not sure where this is. I don't know how market sees it, but certainly the debt ceiling thing could have been like the straw that broke the camel's back. If it is resolved, it will be seen as yet another proof by markets that ultimately US institutions come through. And then, again, the idea will be, sure, we can borrow in a crisis because, ultimately the adjustment will happen when it is needed, and the collapse will be averted. And if this doesn't work once, then we're going to go back to Paulo's point earlier, which is that, it's well known that in the US, interest rates have been extremely low, in spite of the fact that the primary surpluses that are supposed to repay the current US debt are not there under most projections, which is a bit of a puzzle. And then the answer is, what solves this puzzle? Well, it's the safe and liquid asset characteristic of US debt. So investors like to hold US debt, even if they don't actually get a return on it, an expectation, because it's an essential part of value preservation, liquidity, and so forth. And in India, I think there's a version of that, right? I mean, essentially, that's what's going on. And as long as countries have that reputation, and many advanced countries do, very few emerging markets do. India might be one of them. They actually can get away with a lot, but there is a sense that at some point that privilege can go away. If you test it too far. What we have seen so far is that the pandemic has not gotten us to this point.
On that note, please join me in thanking our panelists. We will reconvene at 3:50 for our final panel of the afternoon.
And welcome back for the last session of our joint IMF Fiscal Affairs Department and Peterson Institute for International Economics Conference on global perspectives on fiscal policy after COVID. I'm Adam Posen, the Institute's president, and therefore it falls on me and my honor to moderate the closing panel. As veterans of these kinds of conferences know, there's always the closing policy panel, and that is this. But we have a particularly outstanding group of scholar practitioners from the highest levels and from around the world to bring together many of the themes that we've benefited from today's presentations and discussions. In alphabetical order, and therefore, as it were, the order they will speak. First, my colleague and distinguished colleague and friend, Jason Furman. Jason is a non-resident senior fellow here at the Peterson Institute, which he joined in January 2017. Of course, he came here after his distinguished service in the Obama administration, including as the top economic advisor, as 28th chair of the Council of Economic Advisors throughout pretty much all of Obama's second term, and as a member of the cabinet. Jason is, of course, the professor of practice of economic policy jointly at Harvard Kennedy School in the Department of Economics at Harvard University, where he and I believe David Laibson are co-teaching the legendary Act 10, the initial economics course, which indoctrinates all of us in turn. Prior to joining the Obama administration, Jason held a variety of policy and research posts, including working at both the Council of Economic Advisors and the National Economic Council during the Clinton administration and at the World Bank. He's been a senior fellow across the street at Brookings and at the Center on Budget Policy Priorities. Most importantly, for today's discussion, he was involved in the both fiscal policy setting and the fiscal policy analysis of essentially everything in the U.S. fiscal space for the last 20 plus years. And he continues to prolifically write about that. Our colleague Heather Boucher, who gave the luncheon speech currently on the Biden Council of Economic Advisors, cited his previous paper with Larry Summers on a guideline on net interest costs influencing discussions to this day. Sitting to Jason's left, sorry, it's a long day, is Vitor Gaspar, who is, of course, the director of the Fiscal Affairs Department at the IMF and graciously the co-host of this conference. He joined the fund, it seems reasonably recently, but actually in 2014. He served as Portuguese Minister of State and Finance from 2011 to 2013, and prior to that held a number of senior roles in important European and Portuguese institutions, including as head of BEPA at the European Commission. Some of you don't know what BEPA is or have noticed it's changed names essentially every time it gets a new director, but it is the in-house long-term think tank Plan B department of the European Commission, and Vitor served there. He also, when I first got to know him, was Director General of Research at the European Central Bank in the early founding days of the European Central Bank. But as implied by this, most of his career has been spent looking at public finance and fiscal policy issues, previously having been Director of Economic Studies and Statistics at the Central Bank of Portugal and Director of Studies, Economic Studies at the Portuguese Ministry of Finance. And of course, as with Jason, this understates his influence and impact in that he was at the Portuguese Ministry of Finance during the Euro crisis period and was an important voice in European discussions at ECOFIN and elsewhere throughout that time. Next, we've reversed the order, but that's fine, is our colleague and friend Masaki Shirakawa. Many of you know Shirakawa Sensei as the former governor of the Bank of Japan. He is currently a distinguished guest professor at Oyama Gakuin University. He had a long career at the Bank of Japan, joining in 1972 and held several positions until being appointed as governor in April 2008. He served the full 5-year term. Every period of being a Bank of Japan governor since 1990 has been a challenging period, not so least during Masaki's tenure. He also served as vice chair of the board of directors of the BIS from January 2011 through the end of his tenure at the bank. Masaki was very outspoken and I think has been proven as wise through recent years. As I said to him, both publicly and privately, there were a number of us in the US who were scoffing somewhat when he and his colleagues talked about demographic influences leading to deflation and disinflation in the mid-2000s. And I at least believe that he has been proven at least partly right, and we should eat some crow, with credit to Masaki for standing up for that. The important point to be made, again, is that Masaki in no way compromised the bank's independence, but has been thinking deeply about monetary fiscal policy interactions and the state of fiscal affairs in the extreme state in Japan, its interaction with monetary policy. And so we're delighted that he made the trip to be with us today. Finally, and very distinguishedly, if that's a word, Professor Christina Romer, the Garth B. Wilson Professor of Economics at the University of California, Berkeley, or rather class of 1957, Garth B. Wilson Professor of Economics at the University of California, Berkeley. She has been in the Berkeley faculty since 1988. She's co-director of the program of monetary economics at the NBER and is a member of the NBER Business Cycle Dating Committee. She is a fellow of the American Academy of Arts and Sciences. And again, for those of us in this field, she and her co-author, David Romer, who's with us here today, pioneered the bridging between economic history and quantitative policy analysis with their narrative interpretations of Federal Reserve policy, later extended to fiscal policy. It so happens today that Christina's speech/paper with David as the president of the Presidential Address of the American Economic Association was officially published in the AER today. And so you can go read that for reflections on her academic career. But she also, of course, served as chairman of the Council of Economic Advisors in President Obama's first term. So I will now shut up, since I hope you're all awestruck with the appreciation we have for such a great collection of scholar practitioners. We've asked them not to use slides, to each speak for just a few minutes on their main takeaways about how they think about fiscal policy after not just our conference, but the events of the last few years. And then we'll open it up for on-the-record discussion with our participants. So with that, Jason, thank you.
Great. Well, thank you for that kind introduction and for this great conference. I guess I'd say a few things that are on my mind. One lesson from the last couple of years, I think, is that you can have too much of a good thing and that output isn't infinitely elastic. And you do need to worry about the productive constraints in an economy. I don't know how often we're going to come up against that problem again in the future. May have just been a sui generis confluence of events, but I think it was quite real. I also think that problem has a pretty simple solution. In the transition, when Christy and I first started working together in November, December of 2008, she was doing calculations of what do we think the output gap is? What do we think the multiplier is? What do we think fiscal stimulus is? If policymakers had listened to those calculations back then, they would have done a larger stimulus and we would have had a less slow recovery. And if they had done those very same calculations this time, we would have done something considerably smaller. So I think it's not complicated to get better answers to that than we got. It's complicated to get those answers exactly right, and we'll never be able to do that. Second, in terms of where we are in terms of fiscal policy, I would distinguish between thinking about it macroeconomically, in which the timing matters quite a lot, and thinking about it from a fiscal sustainability perspective. In terms of macro, we have inflation above target everywhere. I think a decent amount of the inflation above target is persistent. I'm skeptical that the amount of monetary tightening anywhere is going to be sufficient to bring inflation back to within a percentage point of target, which is what I think would be something that would need to happen. And frankly, a percentage point above target might even be ideal, but a 2 percentage points isn't. I think using fiscal policy to deal with that would be a good thing, partly because we don't know which instruments work. Maybe interest rates, maybe the economy is less interest rate sensitive than it used to be. Maybe it never was that interest rate sensitive. Throw multiple instruments at it. It takes some of the burden off of interest rates and thus financial stability, and will alleviate some of those concerns in the banking system. And finally, you can much better handle distributional issues through fiscal policy than you can monetary policy. There's then a separate consideration on deficits, which is fiscal sustainability. Fiscal sustainability, to some degree, the timing doesn't matter quite as much. If you schedule a credible thing to happen 5 years from now, that could work wonderfully for fiscal sustainability. Probably won't help with inflation unless you sort of have John Cochrane's views about how rational and forward-looking everyone is. In terms of fiscal sustainability, how much do we need to rethink the rethinking that was going on a few years ago? I'm not sure that we need to rethink it that much. Interest rates are a lot higher than where they were 3 years ago. Interest rate forecasts by economic forecasters, not by markets, are basically about the same as where they were. Even when interest rates were lower, forecasters were expecting the 10-year in the United States to rise to about 3.5%. Now they're also expecting it to stay at about 3.5%. I used to have the view that forecasters might be overly pessimistic and interest rates were more likely to come in below what they thought rather than above, which is what markets were betting on. Now I have a nagging fear that the opposite is true, that interest rates are going to come in higher than what economic forecasters say. But at the very least, the change in how much you should rethink, I think, is much less dramatic than the change in interest rates, because a lot of this change in interest rates was expected and built into all of it. The last question I have in all of this is, sort of an existential question as to whether anyone cares about anything that I just said, or any of my fellow panelists are just going to say. If this was a conference on monetary policymakers pay attention and sort of rationally update. Fiscal policymakers, if they get the sign right in their fiscal policy, you're happy, and the magnitude is sort of often too much to ask for. And so, there's, I think, less work on optimal fiscal policy, but I'm not clear whether that's sort of a supply problem and we need more of that work, or a demand problem that no one really wants it, in the same way that central bankers are huge consumers of optimal monetary policy work. And what that means for how we do our work and how we communicate it and what biases we think are out there and how we address those biases is something that I don't have an answer to. So I just thought I would share my angst with the rest of you.
Thank you, Jason. Vitor?
Thanks, Adam, for the very kind introduction and for a wonderful collaboration for so many years. I cannot resist but reminisce on how I came to know Masaki Shirakawa. We met more than 20 years ago in Tokyo, and believe it or not, we were discussing how to design the intervention of central banks in money markets when the zero lower bound was binding. That's how far back we go. I want to elaborate on only one point, only one lesson. And it links very closely to what we have been discussing during the day, which is that the amount of fiscal intervention, in particular in the early stages of the COVID-19 pandemic, was truly unprecedented. And that applies not only to the size of the intervention, but also to the speed. And so our idea that fiscal policy was like a slow boat to steer, an image that Gita Gopinath used this morning, did not really apply in the case of the pandemic. And that made a tremendous amount of difference for households, for firms, and the point of resilience, helping people and the economy to bounce back when that was possible, was emphasized through the day. So, in a sense, the pandemic leads us to believe that fiscal policy can be much more agile, can be much more active than what we thought was previously possible. We had already learned that, for example, in the case of financial crisis, like the global financial crisis, the ability of fiscal policy to act as a support mechanism to clean up the financial mess made a tremendous difference in terms of the ability of economies to bounce back from such large shock. Now, if we believe that this is a general lesson in a world which is likely to be more shock-prone, more crisis-prone, we have a situation where fiscal policy can be expected to be more active going forward than has been the tradition in the last few decades. And that brings me back to the type of meetings that Adam was talking about in Europe, where one of my favorite colleagues was the Swedish finance minister, Anders Borg. And Anders would characterize himself as a Keynesian, somebody who believes in the active use of fiscal policy, but he would characterize himself as a surplus Keynesian. That is, his view was that if you really wanted to have the option to use aggressively fiscal policy when needed, you needed to have very ample buffers so that you could do that in the context of stability. Anders Borg would say, if you want to be a Keynesian, you better be a surplus Keynesian, which is a bit the third point that Jason made when he was commenting, when he was warming up for the panel, right? But the point that I want really to impress on you is a phrase that I got from a colleague at the IMF, which was, from great power comes great responsibility.
That's actually from Spider-Man.
Yeah.
Precisely. Okay, sorry. Didn't mean to ruin the joke.
No, but Spider-Man did do an internship at the
Precisely.
IMF, actually.
And the author of this quote in Spider-Man is no other than Uncle Ben. You have to remember Uncle Ben. So what's the story? The story here is that once you realize that fiscal policy is more usable and more powerful than you thought before, you have, in a sense, to make sure that the conditions that allow you to use that power safely are in place. And that's where you need fiscal space. That's where you need fiscal buffers. That's where you need to think hard about how to reconcile activism with stability, a regime of stability. And that is something that I believe we will be working on quite actively in the years going forward. But for you, please, don't forget Uncle Ben.
Wow. Okay. Masaki.
Okay. Thank you, Adam, for inviting me to this conference and kind introduction. I am not expert on fiscal policy. I am not the scholar. And I wonder how best to contribute to this panel discussion. And the strategy I chose was to make best use of Japan, where interest rate is lowest, the debt GDP ratio is the highest, and the population challenge is so big. We have to think more seriously is what we have to think more seriously is why we are now witnessing high inflation not seen in the past 40 years. Many explanations are offered, including the pandemic and the Russian invasion of Ukraine. But nobody denies both monetary and fiscal policy play some role. However, just to say the monetary and fiscal policy was so aggressive, or just to say the monetary tightening was delayed is very superficial. The deeper question is why those policies was delayed, why massive macroeconomic policy was implemented, and why monetary tightening was delayed. And in this respect, I would like to emphasize the subtle influence of mindset of policymakers created by the exaggerated fear of effective lower bound or deflation. In retrospect, in past 30 years, many discussion on macroeconomics was founded on the fear of ELB or deflation. In this case, the overly expansionary fiscal policy was justified because monetary policy was constrained by ELB. Second, monetary tightening was delayed because overshooting of inflation was just to be needed in order to have sufficient monetary policy space in order not slipping into effective lower bound. In this respect, my country is offering many food for thought. Japan was faced with a sign of deflation and effective lower bound far ahead of other advanced economies. And its experience were frequently cited by foreign economists. And purported lessons from its experience profoundly affected macroeconomic policy conduct, and for that matter, macroeconomy itself in many advanced economies. For example, in the speech at Jackson Hole in 2020, just after the Fed announced flexible average inflation targeting, Chairman Powell referred to Japanese experience when he explained why overshooting of inflation was allowed. Yes, Japan suffered from low growth and mild deflation, and many academics simply and forcefully argue aggressive monetary easing was a solution. And the Bank of Japan was often criticized as being not aggressive enough. In any event, in 2013, truly bold monetary experiment was started. This was received with great enthusiasm by many academics, and the regime shift of monetary policy was enthusiastically touted as a possible mechanism for reviving Japanese economy. But several years on, we found nothing has happened. Inflation rate did not change materially, and trend growth declined. Now, nobody is arguing in Japan, we need more aggressive monetary easing. Policy interest in Japan has shifted completely from monetary policy to fiscal policy. In mainstream academics, too, there occurred similar change. It was very rare for fiscal policy to be discussed as macroeconomic stabilization policy in 1990s and early 2000s. But now we are discussing fiscal policy as a stabilization measure. A question to be seriously asked is whether or not the theoretical fear over the effective lower bound is validated by the actual data of the Japanese economy. Yes, Japanese growth rate in terms of GDP was low, but if we look at GDP per working age population, Japan's growth rate is fastest among G7 countries, and much higher than that of United States. So it was demographic trend rather than deflation that brought about low growth. And Japanese deflation, yes, Japan suffered from deflation, but the decline of consumer price index from 1998 to 2012 was just below 4%. So on an annual basis, it was minus 0.3%. But nonetheless, many feared over deflation. And considering these developments, one of the most lessons about fiscal policy as well as monetary policy from the era of pandemic period is to assess how and to what extent we would take into consideration the effective lower bound in conducting macroeconomic policy. I do not have perfect answers, but I believe what distinguished the contemporary Japan from the US in 1930s is the functioning of financial system. In the latter case, unlike the former case, policymakers failed in preventing financial system from collapsing, which resulted in horrible deflation. So in this respect, I have a great sympathy with what Paul Volcker said with respect to deflation, when he said, deflation is a threat posed by a critical breakdown of the financial system. So in that sense, when we conduct monetary policy and fiscal policy, we have to think about what will be the implication for financial system. And that is very critical for preventing deflation, which is worthy of its name. I have something to say about RMS, the debate, but I would defer this to the later session. Thank you.
Thank you, Masaki. Finally, Christy.
All right. Well, sorry. Well, anyway, this has been really interesting, and it's both fun and a little terrifying to go last. But actually, I want to pick up on actually some of the things that have been said because, right, Vitor talked about we need to be surplus Keynesians. Jason talked about if you think about inflation now, we really ought to be doing a fiscal contraction. And though I don't disagree with either of those, I think the chance that we will do either is very low. And so that's really caused me to rethink a lot of what we should be doing with fiscal policy, especially a counter-cyclical fiscal policy. So I think my bottom line, having agonized about this for quite a while, is I think it's what I learned from the pandemic is that it might be time to start moving away from using discretionary fiscal policy for macro stabilization. And that in fact, we should go back to an older consensus, which is to use fiscal policy for the things that only fiscal policy can deal with. All right, so let me just explain a little bit about this. You know, if you go back to the early 1990s, the broad professional consensus was that fiscal policy should only be used as sort of a last resort for dealing with aggregate demand problems. And though back then we talked a lot about the problem of, lags in implementation or in legislating, and as Vitor explained, we've had remarkably few lags, certainly in the pandemic. But I think an even bigger part was the expansionary bias, that what we learned is it was a lot easier to cut taxes and raise spending in bad times than it was to get policymakers to raise taxes and cut spending in good times. And so I think that, and that had the consequence of fiscal policy contributed to booms, to inflation, and to this steady up creep in the debt to GDP ratio. And I think, if we think about the financial crisis, right, that was an unusual time period of a huge drop in aggregate demand. We thought it would last for a while, so those timing issues were fairly minor, and we were at the zero lower bound on interest rates. And that confluence of factors made fiscal policy a no-brainer and an absolute godsend. But if you come to the pandemic, I think what really struck me was just how quickly we spent $5 trillion. And it's just and I think the pieces of it that worked least well were the things that were basically broad stimulus. It was not the things that Diane and her panel were talking about earlier of the targeted, the social insurance, those kind of things were fantastic. And I'll talk a little bit about those in a bit. But if you think about just the PPP and the economic impact payments, that was a ton of money. I think it was misguided in that people said, ooh, maybe we're going to have a recession, we should get demand up, not thinking we were in a pandemic and really didn't want to get demand back up. So we got immediately back to Y bar. And it absolutely, I think, is part of why we are seeing the inflation that we're seeing, is that spending was saved early in the pandemic, as I think many of us would have predicted, and then it came online just as the economy was getting back towards full employment, and we were hitting up against all of those supply constraints. So I think that we ought to be skeptical about what has now become kind of the instinct of, oh, it's a problem, let's solve it with a fiscal expansion. And I think feeding into that is the realization that monetary policy is back in the saddle, right? I think, obviously interest rates will come down if we manage to get through the current situation, get inflation down, but they will still, I feel quite certain, be a fair amount higher than they were, or certainly will still be well above zero, if for no other reason that our debt to GDP ratio is 15 percentage points higher than it was 2 years ago or 3 years ago. So I think we're going to have monetary policy as a tool. So I think going back to the norm of that's our frontline tool, and we use fiscal policy for countercyclical purposes only as a last resort. So that's my negative lesson from the pandemic. I do want to flip it around a little bit and say I think we did learn some positive things, and it's particularly the idea that we ought to use fiscal policy for the things that fiscal policy is the best tool. So dealing with public goods, the money spent on vaccines and vaccine distribution and public health and PPE, that was the best money we could possibly have spent. Likewise, money we spent for social insurance, the SNAP increases that we heard about, the unemployment insurance on steroids, right? That is fiscal policy that solved a microeconomic problem, but made a huge difference in people's lives and how they weathered the pandemic. And then I'd put in redistribution, right? One of the things, again, we learned, I'm not sure that a crisis was necessarily the time to do it, but the child tax credit extension and making it refundable, what we learned is the fiscal policy can do a magnificent job of helping to get poverty down and deal with inequality. So I guess my bottom line is what I take from the pandemic is perhaps fiscal policy should less be the province of those of us up here who are macroeconomists, and I think a much more focus on the public finance aspects. So the solving the problems, using fiscal policy in ways that increase economic welfare and improve the functioning of the economy.
Thank you so much, Chrissy. Before I let Jason in, I mean, do you have a really direct response?
A little bit of a direct one, but whatever, however you want it to work.
I had a couple questions I sort of had in mind that the panel reinforced. So the first one is that two terms that we used, again, going to the aggregate demand side, notwithstanding Christie's very compelling last point and the earlier very fruitful discussions we had at this conference about those public finance aspects of fiscal policy. Just a couple last points on the aggregate demand side, because so much blood, sweat, and tears were spent on it. First is, there were two terms that used to come up all the time that none of you raised. The word fiscal rules did not appear in any of your remarks. Now, personally, I've always believed that fiscal rules would be triumphed over by politics, but it's interesting that not one of you mentioned it, not even Vitor. And second, that, especially in light of Christie's last remarks, but I think everybody, the term automatic stabilizers did not come up. That it's one thing to say, yeah, we want to get out of the discretionary fiscal business, but maybe we can do something that's more automatic. So anyway, if any of you want to remark on those things having been left out of your remarks, whether that was intentional or deliberate. Jason, Christy.
Yeah, so I stuck two fingers up as Christy was finishing, in part because I was going to propose automatic stabilizers as a compromise. I think it's a little bit of a problem that every time the economy goes into difficulty, everyone calls Diane to figure out what to do. It would be way better if the law did whatever it needed to without needing to call Diane or legislate.
You call Diane once, and then you don't have to do
Exactly.
it again.
So I do think trying to get automatic stabilizers right, because I think Christy sort of took the angst I had about no one listening and caring what we had to say, and I think may have gone one notch too far with it. I think we still are in the place where some future recession, we're going to be back at the zero lower bound. We're still at the place where we're not fully sure how monetary policy, how well it can control inflation and what the side effects are. We still, I think that in some circumstances fiscal policy can crowd in activity, not crowd it out. So I think we don't want to unlearn all of what I think those economic lessons were. I think automatic stabilizers are the easiest way to bridge those two. I also, by the way, did want to double tap on the expansionary bias of fiscal policy. I always thought it was sort of more fun to spend money in the present than to not spend money in the present. I hadn't realized, though it's pretty obvious, that precisely when you have inflation and families are having the hardest time, going to them and saying, we're going to solve the inflation by having a policy where you all send the government a check for $2,000, that was sort of the hardest time to do that. And in fact, in Europe, you've seen inflationary fiscal policy as they've tried to ease the energy burden on families and probably increase inflation in the process.
I just want to say that automatic stabilizers were on my notes and I skipped them. So that in fact, so exactly what makes them useful is they deal with any timing issues because they automatically go in, but they don't have that expansionary bias, which is incredibly valuable. And then I think the other, maybe I'll moderate my marks a little bit in Jason's direction to say, if you want to use fiscal policy to help stabilize the macroeconomy, please still call Diane, right? Because we shouldn't be doing the let's just write everybody a check. That is, even in a non-pandemic recession, the effects are so unequal that you really ought to be thinking about social insurance and helping the people who are bearing the brunt of it, not just, let's just float it out everywhere.
Before I go to Masaki and Vitor, I just want to say, with no disrespect to Professor Schwarzenbach, there were, in addition to Diane, some other good speakers earlier today about some of these
I
targeted
know, but she's
issues.
right in my
No,
sightline.
yeah, that's fine. Yeah, no, exactly. I think Gabriel took off, Mike Strain took off, so that's a good conference rule. You're right. Masaki, then Vitor, please.
I didn't talk about fiscal rule just because fiscal rule was no longer discussed seriously in Japan, unfortunately. And 20 years ago, the high debt GDP ratio was regarded very, very alarming by many people. But in the past 20 years, the phenomena which is usually associated with fiscal deficit didn't happen. So nowadays, fiscal alarmists are regarded as a kind of crying wolf. But I have a frustration over this state. And to be more specifically, I do not buy into the argument that the stressing the importance on the basis of inflation or issuing cost or R minus G. When I look at Japanese economy and society, what is happening is a gradual decline in productivity. Minutes ago, I said Japanese productive growth is relatively good, but in the past 10 years or so, it is gradually decreasing. And what we are now seeing is a strange combination. Let me try. First, the effect, the productive growth was declining because of prolonged monetary easing, which was made possible under the low inflation. And second, continued huge budget deficit, which is enabled partly by, again, prolonged monetary easing, tends to lead to inefficient government expenditure by loosening fiscal discipline. This situation is further aggravated by political dynamics due to rapid aging. Aging means dominance of gray-hair democracy, which favors more government consumption or transfer payment for the elderly and less government investment for future, such as education and basic research. And third, underlying demographic change is exerting downward pressure on inflation. And when we talk about the impact of demographic change on inflation, people often talk about this issue along the line of Charles Goodhart. And his argument is, of course, plausible, but he's talking about just one facet of demographic change, that is the aging. Aging means decline in labor force, which produce higher inflation. That is understandable. But in the case of Japan, what is more serious is declining population itself due to low birth rate. And this means decline in both demand and supply. Case in point is the decline in investment. Investment is determined by expected size of the economy, which is determined by future population, while current productive capacity is determined by current population. So as long as population continue to decline, we are always having the downward pressure for investment, which is translated into lower deflation, lower inflation. Then people are relaxed. There's no sign of inflation. So people are relaxed by continuing with monetary easing. People are relaxed with continuing budget deficit. But eventually, this leads to eventual the gradual decline. And this is an equilibrium, and this is a sustainable in a sense. But eventually, this leads to shrinkage. So I wonder whether we call it the equilibrium. It is a sort of a bad equilibrium. Coming back to your question, we need fiscal reform but fiscal rule. But I don't know what is really persuasive fiscal rule for people living in such a country.
Thank you.
Yeah.
Vitor?
Thanks, Adam. Great questions. When I was listening with tremendous pleasure to the intervention by Christina Romer, one of the things that I noted was missing was precisely automatic stabilizers, and I'm quite happy to learn that automatic stabilizers were on the notes, so they were not really missing. Because I do think that when we think about macroeconomic stability, thinking about automatic stabilizers and their design makes a tremendous amount of difference. And one of the things that has been consensual in the fund for many years already is that it's worthwhile to think systematically about automatic stabilizers and how they should be designed with macroeconomic stability in mind as well. But today we learn about automatic stabilizers that one of the things that they do is to provide a basis for the implementation of extraordinary measures like what we have seen in the context of COVID-19. You need to have the administrative capacity and you need to have the information basis so that you can actually react quickly. And one of the recommendations that I took from both the household session and the firm session is that one should think about those things in advance so that one can actually do it well when under pressure. And that makes a tremendous amount of difference, and I think it's worthwhile for us to take that as an important lesson. I did not speak about fiscal rules for two reasons. Number one, I had decided to focus on one issue only. The second was that the session on sustainability, and in particular the interventions by Francesca and Jeromine, have done a tremendous job explaining why going back to fiscal rules is something which is being debated around the world right now. And Jeromine, in the context of Europe, gave the example that at this point in time, it is pressing to rethink fiscal rules. And we put out a paper in October 2022 that contributes to that debate.
To just indulge me a second, back in 2004, I believe, we held a conference here on the 5th anniversary of the Euro called the Euro at 5. I gave a paper, wasn't much of a paper, but it was a paper that argued fiscal rules such as those in Europe would completely fail because they're in no sense binding. You pull on the blanket when you want to be warm, you throw off the blanket when you don't want to be warm. And I'd say the last 25 years of Europe has demonstrated that. So, I mean, it's great to have constructive voices like Jeremy and Francesca, others all well known to us, saying if you're going to have rules or if you're going to make judgments, assessments, analysis of what's sustainable, that's great. And I fully support that. But I got to admit, I think that call I and others made at the time looks pretty good right now. Let me ask a different question, all of you, and then we'll open up to the floor. No. No. I knew not to. I paid for this microphone, Vitor.
I think
the second question is, and this goes very much to something Misaki said and also Jason said. For a long time, elected politicians around the world, at least around the high-income world, have said that sometimes the central banks, if you would only tighten policy, we'd be forced to be more fiscally disciplined. We've heard that from members of Congress. We've heard that from architects of Europe. We've heard that in Japan. But what seems to be described by you all is that when it's a game of chicken, it's the central banks that blink, not the fiscal authorities. And obviously there are people, I guess John Cochrane is a name to invoke. There are people who would say, well, I told you, just like I'm saying I told you so. They'd say, I told you so. That's the way it's always going to be. Is this a fair characterization that A, the central banks aren't able to impose any sort of discipline on the fiscal process, and B, that in fact they cave once there's fiscal pressure?
Yeah, they absolutely can't impose any discipline on the fiscal process. I mean, occasionally the Fed chair will testify and give some obvious common sense view on fiscal policy, and people will listen to them as much as they listen to any of us.
Right.
To continue with the angsty theme. On the cave, I don't quite know what you mean by that. There's a fiscal dominance, keep interest rates low so the budget deficit is sustainable. I think that figures in the United States and in most well-run, good institutions, basically not at all, and would take a big institutional change, a big set of people, change in people to change it. I think there's a second thing, though, that the monetary authority, I think, is almost too shy to undo what the fiscal authority did. I think that's part of what happened in March 2021, when the fiscal expansion of the United States was vastly larger than anything the Fed had built into its forecasts. At the other side of that, it was doing exactly the same thing it would have done as if it had never happened. And I think to come out the day after it passed and say we raised our inflation forecast, lowered our unemployment forecast, and so we're pulling forward the rate hikes would have been the right thing to do macroeconomically. But I think they were in some sense too timid to look like they were in tension with the president on his economic agenda. So I think a little bit less shyness about stepping on and undoing the craziness of fiscal policy would be welcome.
Thank you. Masang Peter.
If I may, on this one, very quickly, I think that you're being over simplistic, Adam, with all due respect, in the sense that even from a theoretical viewpoint, if you think about monetary fiscal interactions, there are many possibilities. You don't have to think about it as a game of chicken, although you may. Neil Wallace did. But if you go to the macroeconomic theory textbook of Tom Sargent and you go to the chapter where he formalizes monetary fiscal interaction, he uses one particular model, which is a shopping time model, and he has, I believe, 14 different types of rules of the game for that model alone. You can think about infinite possibilities. So it's much more complicated than simply saying that the monetary authority caves in. When I started looking at issues of European integration many, many years ago, so some 15 years before the conference that Adam reminisced about, the main thing was to write fiscal rules that in Europe would prevent fiscal policy from creating financial instability or pressure on the European Central Bank to deviate from the price stability mandate. It was a policy mix issue, and it was presented at the need to avoid an unbalanced policy mix that could put price stability at risk. Alexander Lamfalussy was probably the author that most explicitly put this in place. My last remark on this is that, of course, institutions that are developed in societies to deal with macroeconomic problems are the outcome of political processes. So fiscal, monetary, and their interaction will always be coming ultimately from the political system, and therefore the institutions, rules, procedures, frameworks that we will have in place can only be sustained if they are sustainably, politically, and there is no better place than Washington to make this point.
The word of fiscal dominance captures and some reality of the society. But based on my experience as a governor, the fiscal dominance does not capture the full story. When I talk with a politician in private, almost all of many of them fully recognize importance of fiscal discipline. But when they say something in public, they say quite different thing. And in this case, I wonder whether it is good to characterize this situation as fiscal dominance. And I would say this is a phenomena of social dominance or financial dominance. And when central bank raise interest rate, if central bank just when central bank refrain from raising interest rate just because of the negative reaction on the part of politicians or government, then this situation could be called as a fiscal dominant. But actually, what central bank is concerned about is a possible reaction from the market or a possible reaction from general public. In that sense, the situation is more than just fiscal dominance. And yeah.
I just have a quick thing. So Jason talked about, so this question of whether central banks, don't want to stand up to the fiscal, the elected fiscal authorities. There's a project that David Romer and I have been working on sort of about, at least in the case of the Fed timidity, and sort of not wanting to thwart the will of Congress is one of the things that comes up. But bad models and just, bad monetary policy also, I think, comes up. And if I think about, I strongly suggest that the reason the Fed didn't act is not that they were afraid of Congress or the president. I think they had trouble shifting gears at just how quickly inflation had picked up, and they were so used to fighting low inflation in the zero lower bound. I think they just didn't move fast enough rather than being dominated by fiscal.
Thank you. So let us open it up to our in-person audience. Jessica has a traveling mic. There's a standing mic in back. Even if you've already spoken today, please identify yourself when asking a question or making a comment. And finally, we welcome questions and comments on the public goods and micro-targeted and functional aspects of fiscal policy that Karen and Paolo and David assembled for us earlier today. Anyone, please, if Mary, if you could go to the mic there, please.
Mary Lovely from the Peterson Institute. Thank you all for an interesting panel and a full day of ideas. One of the things I've been thinking about is, well, we live in a world with Olivier Blanchard, so R&G. And sustainability now means not just fiscal sustainability, but of course, climate change. And we haven't talked on this panel, at least, about what R&G mean in that world and how we think about fiscal rules in that world. So R, we don't even know what is the social rate of return in a world where we have this enormous externality. What is G when we don't know how to measure GDP? So for example, if we decide to spend a ton from the federal budget to decarbonize, we would certainly increase the debt, and we might actually reduce G so that we would break any fiscal rules that we had, but that actually might be optimal policy. So when we're thinking about sustainability of fiscal policy, I just wonder if you might address that aspect of sustainability. Thank you.
Thank you. Anyone want to address that?
So let me go first. I would say that in Olivier's framework, the main reason to have the G figuring so prominently is that revenues have as government revenues, the tax base is broadly speaking, proportional to GDP. And so when you think about the source of revenues to the budget, you get a good proxy for that. So since we're talking about the tax base, correcting for externalities is not something that's particularly relevant in that context. I would further say that when one focuses, as Olivier does, so much on R minus G, one is likely to underestimate the challenges for fiscal policy because both R and G are endogenous. And if you think about the points that were made earlier by Jason in his 3 points in his warm-up session for the panel, one has that R is endogenous because of financial market developments. And we had earlier in the day the point that financing conditions can shift very quickly, and that is a risk that one has to take into account in the risk-based debt sustainability analysis that Francesca and Jerome were talking about. So that's one important aspect. The other aspect is that you have the endogeneity of G, and if the issuance of public debt crowds out private capital, one would have a responsive G that would, in a sense, point in the same direction. The issues posed by climate are very complicated in this type of frame. And let me make some publicity for work at the IMF. The fall fiscal monitor will be focusing on climate, and one of the areas that we promised we would cover is precisely how does one think about long-run trends in public finances in light of climate, and how would one adapt rules and frameworks to that, to take that into account. So if we can speak again in October or thereabouts, I would be happier.
The only thing to add is you do not need to wait till October. You just need to wait till Monday, when there will be a climate conference here at PIIE and a panel on exactly this topic.
Christy, although that can't be taught.
I think actually, I think your question is fantastic, and especially, I think the discussion, I think why I don't like the discussion of sustainability and R minus G and is it a free lunch, because it acts like what you spend it on or how you spend it doesn't matter. And, or to say, even if it's a free lunch, not all free lunches are the same. And so thinking about going back to where I said that we need to think like public finance economists, right? What are you going to do? You're going to deal with social insurance, public goods, and for God's sakes, externalities. And so this is like a crucial one that we should be, that's where we should be thinking of putting our fiscal action.
Thank you.
I am uncomfortable with R minus G argument. One reason is endogeneity, which Vito emphasized. And as I said in my remark, the under the combination of low interest rate and the demographic change, this rule lowers the both R and G, which eventually leads to low growth. So that is one reason. And the second reason is that it underestimates the importance of having fiscal policy, fiscal space. In the case of Japan, what is the most important reason for having fiscal space is to cope with natural disaster. For instance, 100 years ago, exactly 100 years ago, downtown Tokyo was hit by severe earthquake. And historically, such earthquake occurs more or less regularly. And based upon the past study, the fiscal cost of earthquake is about 30%. So at least we have to cope with extra 30% in case of earthquake. And each country or society has a different contingency. So RMSG argument underestimate the importance of having fiscal space in case of natural disaster and some others.
Thank you. Anyone else? Nope. Another question from the floor? Yeah, German, please.
German Sattelmeier, Bruegel, and formerly PIIE. So I'm still trying to get my head around this question of, should we change our views on what fiscal policy can do as a result of what we have seen in the last 3 years. And so I'm wondering whether the panel would agree to the following compromise formulation, which is a little bit inspired by what Christy said at the end. So I think it may be important to distinguish two dimensions. One is sort of the macro versus the micro, right? Macro stabilization versus social insurance. And the other one is, ex ante or exposed discretion in a crisis or not, right? And so the way I come out of it is that for the reasons that Christy described, we should not change our views on the macro aspect. And the reason is that even though the lags argument turned out to be irrelevant, just because you can do something fast doesn't mean you get it right, and it will still be extremely expensive if you get it wrong, right? So in that sense, we want to go back to the status quo ante. But I think that on the micro, something really has changed, right? Which is you can have a system, a social safety net in place that is simply not designed, not appropriate for the next shock that you're going to get. And then you're going to have to adjust it very quickly. Now you can say the more complete it is, the easier it is to do this within the system, because all you need then is parametric change, like driving up the snap, for example, like Diane argued, right? But I think in that sense, I do think the pandemic has, in a sense, strengthened our confidence in what fiscal policy can do. I mean, it has, particularly to macroeconomists, it has sort of revealed a whole beneficial side of fiscal policy, which wasn't completely on my mind. Discretionary policy.
Thank you, German. Any feedback on that comment?
I came out, I wanted to make the point. Of course, I think fiscal policy in a situation where, if we do end up back at the zero lower bound someday, or if it's a shock that's so big, monetary policy can't deal with it, then of course, that's why it's the tool of last resort. It's not the tool we never use, it's the tool of last resort. And it's actually something I've been thinking again, kind of on the lines of where we go from here, besides the automatic. The one that has been resonating with me is the state fiscal relief, because it's both something, if you want, this is the federal government transferring to the states. If you want fiscal stimulus, it's great as stimulus, just as a macro policy. But actually, what do states mainly spend on? A lot of it is the social safety net. It's the government services for the people in need. And so it's a nice policy there in the space of both good for public finance and good for macro. So thinking more along those lines, I think, would be very valuable.
And just briefly picking up on that, you obviously can make state fiscal relief an automatic stabilizer, and together with Willie Powell, and who's here, and Matt Fiedler, who's across the street, we have a proposal to do that. And I think that would be a good example of where one is needed, because we did $500 billion of state fiscal relief in March 2021, when it was completely obvious that the optimal number was something much closer to $0 billion than to 500 billion. So I think getting that one more automatic would be good too. But Jeremy, I agreed with everything you said.
If I may, I would try to persuade you, Jeremy, that a slightly different formulation would be better. I would not limit public finance to social insurance. I think it's very important to have equity and distribution considerations, but also allocational considerations like those that are necessary for growth, but also for things like the green transition or digitalization, a bunch of other things, right? So public finance, and I believe Christina would agree there, is a broader thing. The other aspect is that quite apart from the need for fiscal to be ready to act in case of limits to monetary policy or extreme financial stability developments, now we learn that even the way stabilization policy works in response to shocks like the pandemic or energy and food crisis depends on what fiscal policy is doing, and I think that that allows for a more active role for fiscal policy, even in less extreme cases. So I would not shut completely the door for that.
Okay, with that, I will let our co-host have the last word. Thank you all to everyone who engaged with us in person. Thanks especially to our very distinguished and thoughtful and willing to surprise us closing panel, Christine Romer, Masaki Shirakawa, Vitor Gaspar, and Jason Furman. Thank you.